put something to cross it out. It's okay. We're not hiring this year. Maybe next year. Well, right.
Yeah, but I think that one is on. Yes.
Yeah, hello. Good morning to all. My name is Mariana Garcia Schmidt. I'm one of the organizers of this year's conference with Sofia Bauduco, who is there, Luciano Villacorta, and Atif Mian, who is our external organizer. So welcome to you all. I'm very glad you're here. Welcome to Chile and welcome to the conference. I just want to tell you if you have any questions, anything you want, you can ask me, Luciano, Sofia, Atif, or also our members of the staff, Daphne, Maria Jose, Pablo, and Daniela. You can all, Dani? So the conference will be held in English. If you need, there's available simultaneous interpretation to Spanish outside. And we'll begin with the opening remarks of our governor, our President Costa. So President, you can come.
Good morning. I would like you to enjoy this conference, these 2 days of conference. Good morning to all the speakers, discussants, the organizers of this event, Atif Mian, Sofia Bauduco, Mariana Garcia, and Luciano Villacorta. Happy birthday. And everyone who is here attending in person, and to those following us via streaming. We welcome you to the 27th Annual Conference of the Central Bank of Chile entitled Medium and Long-Term Trends in Interest Rates, Causes, and Implications for Monetary Policy. Since 1997, the Central Bank of Chile has been convening prominent scholars and policymakers to this conference to discuss major issues in central banking and their implications for emerging economies. Since its inception, this conference has served as a bridge between academics and policymakers. This version is no exception. Fresh and thoughtful research will support the discussion over the next 2 days on a topic that is very much front and center on the policy agenda. We will enjoy the presentation of 7 authors, 7 discussants, 2 keynote speakers, and a policy panel. This year's conference tackles a topic that is increasingly at the forefront of economic discussions: the future trajectory of long-run real interest rates, their potential determinants, and the implications for monetary policy. The timing of this topic couldn't be more relevant, especially in light of the sharpest and most synchronized monetary tightening we have seen in decades. As we all know, central banks in advanced economies have recently started lowering their policy rates, and in many emerging economies, this normalization process has been underway for some time now. Even so, policy rates had risen significantly over the past 2 years from these record lows in decades. This shift has sparked a lively debate regarding the future of medium and long-term run trends in the real rates, specifically whether policy rates will revert to their pre-pandemic lows or will settle at a higher level. Opinions on this matter vary widely among experts, and I think there is not a clear consensus on what the long-run interest rate will look like in the future. On the one hand, there are reasons to believe that the real interest rates are likely to revert to their historical lows, as the key factors that were mainly thought to have driven these rates down over the past 40 years, such as demographic shifts, stagnant productivity growth, increased market power, higher risk aversion, and sustained demand for safe assets, do not seem likely to revert sufficiently to produce a significant and lasting increase in real interest rates in the coming years. On the other hand, recent market indicators suggest that equilibrium long-term interest rates have risen. Also, some new estimates of the natural interest rate, defined as a long-run equilibrium rate after shocks have dissipated, indicate that this rate may have risen in several advanced countries in the past few years. As I will discuss in a while, this shift could indicate that at least some structural drivers of real interest rates have changed direction, or that the natural interest rate is adjusting to a new economic environment possibly characterized by higher levels of public debt. The future evolution of the natural interest rate has significant implications for monetary policy. Accurately assessing the long-run trend of the natural rate is essential for central banks, as these rates serve as a crucial reference point for monetary policy. The difference between the real interest rate and the natural rate provides valuable insight into a central bank's monetary stance and aids in evaluating various policy options. However, the natural rate is an abstract concept, and its estimates often carry considerable uncertainty, particularly in the post-pandemic period. Since the natural rate is not directly observable, understanding its determinants has become vital for effective monetary policy. I am confident that the fruitful discussions we will have during this conference will deepen our understanding of these determinants and clarify where natural rates and other relevant interest rates may stand in the years ahead. In this opening remark, I would like to take a moment to briefly review the key empirical long-run trends we have observed in interest rates, as well as the primary explanations put forth in the literature. Following that, I will walk you through the main agenda of the conference. Over the past 40 years, up to the COVID-19 pandemic in 2020-2021, we have seen a remarkable decline in nominal interest rates across the globe. For example, during the 1981 to 2020 period, nominal return on US Treasury bonds, both short and long-term, dropped significantly. The two-year Treasury bills experienced a drop of around 14 percentage points, and 10-year bonds saw a decline of 13 percentage points. During this same period, inflation also fell, albeit to a lesser degree, leading to real rate declines of about 5 and 4 percentage points for the 2 and 10 years bonds respectively, putting sovereign real interest rate close to zero and even in negative territory for some periods. The decline was not limited to sovereign bond rates. It was also present in the returns on other so-called safe assets. Importantly, this downward trend was not exclusive to the United States. Real long-term rates have declined by several percentage points since the early 1980s in both developed and emerging economies. So this appears to be a global phenomenon. The global downward trend is observed. Risk-free rates over an extended period suggest a significant decline in the natural interest rate, often referred to as the long-run equilibrium rate. This secular decline has coincided with a relatively stable trajectory in the marginal product of capital, a stable trajectory on the return of risk on risky assets, and a stable trajectory in the investment rate, particularly in advanced economies. As a result, these patterns are often attributed to factors that have increased the overall supply of saving over the years, alongside factors that have redirected this excess in saving toward the demand for safe assets rather than productive investments. In recent years, much of the literature has centered on the hypothesis of a global saving glut. This theory suggests that the significant excess of saving from certain countries and affluent groups has led to a marked shift towards safe assets. Consequently, there has been a notable increase in the prices of these assets, accompanied by a decline in interest rates. One contributor to this phenomenon was the increase in saving from emerging economies, particularly since 1990s. Factors such as robust economic growth, soaring commodity prices, and high-risk aversion all fueled greater saving in these regions. As a result, these economies channeled a substantial portion of their saving into global markets, with a significant impact on interest rate in developed countries. Another contributor to this saving glut was the increasing saving rates among the wealthiest households in developed nations. As income inequality has risen, rich households have saved a larger share of their income, further contributing to the excess saving phenomenon. Research indicates that the saving of the top 1% in the United States is comparable to the saving generated by the excess from emerging markets, a trend the literature refers to as the saving glut of the rich. This dynamic has profound implications for wealth distribution and economic stability. Other mentioned explanations for the excess savings are linked to more structural factors, such as the secular stagnation hypothesis, which suggests a persistent decline in potential economic growth that limits investment opportunities, thereby driving saving towards safer assets. Additionally, demographic changes, including declining population growth and longer life expectancy, have influenced saving behaviors across generations and regions. Finally, rising risk aversion, the declining cost of investment goods, and the substantial increase in corporate power over recent years further explain why this increase in saving has been directed toward safe assets rather than productive investment. Over the past 40 years, all these factors have shaped the dynamics of saving investment and consequently interest rates, each contributing with varying significance during different phases. Looking ahead, the trajectory of interest rate will heavily depend on the uncertain evolution of these drivers. The outlook for these structural factors influencing real rates is mixed. On the one hand, several key factors behind the pre-pandemic decline in interest rate, such as low potential growth, rising inequality, increasing uncertainty, growing market power, and longer life expectancy, show no significant signs of changing direction. These forces suggest that real interest rates may revert to their declining pre-pandemic trend. On the other hand, additional factors could lead to a sustained rise in rates. This includes a decrease in savings due to a growing inactive population, substantial fiscal deficits resulting in very high level of debt, potential productivity gains from advancements in artificial intelligence, geopolitical risks, and climate disasters affecting global savings and significant investment in the green transition. I hope our upcoming discussion will help clarify the direction of these drivers and enhance our understanding of where the natural interest rate may be headed in the future. Let me now give a very brief overview of what we will be hearing today and tomorrow. The conference will start with the session Interest Rates and Macroeconomic Policy. In this session, the paper by Francisco Bianchi, Renato Fatini, and Leonardo Velosi examines the role of fiscal policy in shaping the future path of real interest rates. Then, the paper by Gabriel Jimenez, Dmitry Kushinov, José Luis Pedro, and Björn Richter will look at the links between the path of the monetary policy rate over time and the risk of banking crisis from a historical perspective. Then, we will continue with the first keynote speech delivered by Ricardo Reis. He will address the implication of interest rate trends on inflation, as well as the subsequent effects of inflation on these trends. We will then transition to our second academic session, which will focus on theories of natural interest rates. The natural interest rate, an abstract concept, is defined as the interest rate that prevails in the long-term equilibrium once economic shocks have dissipated and prices are fully flexible. As a latent variable, understanding its determinant and refining its measurement is of paramount importance. This session will begin with a paper of Oskar Akinci, Gianluca Benigno, Marco Del Negro, and Alberto Queralto, who propose a complementary concept referred to as the financial instability real interest rate. While the natural interest rate is typically associated with macroeconomic stability, this new concept emphasizes the critical importance of financial stability. Following this presentation, Galo Nuño will discuss the three theories concerning natural interest rates. Traditional theories often highlight the structural drivers as technological advancement and demographic changes. However, Gallo's paper will challenge this conventional view, exploring how factors such as public debt, household inequality, the zero lower bound, and persistent negative supply shocks may influence natural interest rates. To conclude this session, we will hear from Elias Albagli, Sofia Bauducco, Guillermo Carlomagno, Luis Gonzalez, and Juan Marcos Vlasliuk, who will discuss the potential impact of climate change and escalating geopolitical tensions on long-term interest rates. The second day will begin with a keynote speech titled Long-Run Interest Rates, Present and Future by Atif Mian. He will explore the interconnections between interest rate and both private and public debt over time. Atif will first address the role of inequality in explaining the simultaneous decline in interest rate and the rise in debt over the past few decades. He will then examine the dynamic of debt, discussing an appropriate constraint on interest rate to prevent explosive borrowing. Finally, he will discuss on estimating future yields. Next, we will transition to the session titled Interest Rate, Inflation and Transmission to Emerging Markets. This session will open with the paper US Anti-Inflationary Policy and Emerging Economies, 1980 versus 2020s, by Drishan Banerjee, Galina Hale, and Harrison Chi. The paper analyzed macroeconomic data from advanced and emerging economies in the 1980s and 2020s to highlight difference in how US monetary policies has impacted emerging markets in these two distinct periods. The second paper in this session by Francisco Legaspe and Liliana Varela will show how country-specific risks such as political uncertainty and risk on debt repayment explain excess returns from investing in local currency assets in LATAM countries. Finally, a policy panel featuring Elias Albagli, Jan-Marc Nuttall, Boris Hoffman, and Ricardo Reis will offer insights into the future of interest rates and their implications for monetary policy in emerging economies. I would like to especially thank Atif Mian for being the external organizer of this conference, as well as locals Sofia Bauduco, Mariana Garcia, and Luciano Villacorta for putting together such a wonderful program. I also thank all the speakers and contributors and look forward to the conference volume that we will publish in some months with its formatted contents. Let me finish by thanking Maria José Reyes, Constanza Martinelli, Carolina Besa, Daniela Gaeta, Daphne Giloff, Pablo Barros, and both the Public Affairs Department and the Economic Research Department at the Central Bank of Chile for all their invaluable help managing the logistics of organizing this annual conference. I wish you a fruitful discussion over the next 2 days. Thank you.
So thank you, President Costa. We have a short video with today's program that we can show now. Are from the central bank, so we can just feel like if we were there. Okay, so now we'll continue our first session entitled Interest Rates and Macroeconomic Policy. The chair of the session will be Luis Felipe Céspedes, one of our board members, and we invite Luis Felipe as well as our presenter and discussant, Francesco and Juan Pablo, to come to the stage.
Nice to meet you.
Okay, good morning, everyone.
Thank you.
So we start now with the session number 1. We're going to be talking about interest rates and macroeconomic policy. So the first paper for the session is on fiscal policy and real interest rate. It's a paper by Francesco Bianchi, Renato Faccini, and Leonardo Melosi. The discussion will be Juan Pablo Medina. Let me just mention a few words about the speaker and the discussant. Francesco Bianchi is a Louis Maccini Professor of Economics at the department chair at Johns Hopkins University. He is co-editor of the American Economic Journal Macroeconomics and member of the CPR and the MBR. Professor Bianchi received his PhD in economics from Princeton University, and before joining Johns Hopkins, he was professor at Duke University. He has held visiting or teaching positions at UCLA, NYU, Penn, Columbia, and Northwestern. Professor Medina, Juan Pablo Medina, is professor of economics at the Business School of the Universidad Adolfo Ibáñez. Prior to this, he was economist and visiting scholar at the IMF Institute of Capacity Development. He has held several positions at the research department of the Central Bank of Chile. He holds a PhD in economics from UCLA. The rules of the game are the following. The speaker has 45 minutes for his presentation, then the discussion has 15 minutes, and we're going to have question from the floor, 15 minutes for question from the floor. So, Professor Bianchi, the floor is yours.
Thank you. So first of all, this is my second time here, so thanks a lot to the organizers for having me. So last time I was here, it was pre-COVID, so it's great to be back here in a normal situation. So I don't need my phone, I guess. I feel a little bit like Britney Spears. We had this music introducing me. I have the microphone, but that will allow me maybe to move around and show some graphs. So this is joint work with Renato and Leonardo. Renato Faccini is at the Denmark National Bank, so the usual disclaimer applies. So what we want to do in this paper is to think about the relation between real interest rates and fiscal policy. And we want to go through this relation by looking at a model with partially unfunded government debt. So this talk is going to be related to a recent paper that Leonardo and Renato and I wrote on understanding the COVID inflation. And so what we are going to do here, we're going to extend a little bit the sample and to look at the more recent data. But unlike the original paper, we are really going to zoom in real interest rates. So now it doesn't take, I don't have to explain here that there is a relation between real interest rates and inflation. So here the focus is going to be trying to understand how fiscal policy enters all of this. So what are these models with the partially unfunded government debt? So these are models in which at any given point in time, part of the sovereign debt is not backed by future taxation. And so something else has to give. And so what happens in this model is that you get some inflationary pressure that is accommodated by the central bank. And so effectively, that stability is achieved by a mixture of fiscal adjustments and inflation. So now we're first going to explain how these unfunded fiscal shocks work and how you can integrate into your everyday model, your favorite model. And then we are going to bring this model to the data using like a fairly standard tank model. So this is important because effectively what we want to show is that even if you have all the machinery you're used to think about, these unfunded fiscal shocks play a big role. And in particular, in models with nominal rigidities, they're going to generate persistent movements in inflation, and this is the theme of the conference, real interest rates. Okay, so as I was saying, we're going to augment a state-of-the-art tank model. So what that means is that this has the standard friction and shocks. It's augmented with these unfunded fiscal shocks. It has hand-to-mouth agents, so that's important to give a chance to funded fiscal shocks to still have an impact on the real economy and possibly real interest rates. And then we're going to introduce what you could think about a competing force for long-term dynamics of inflation that is technically is a near permanent cost push shocks. If you want to think about interpretation, think about phenomenon like globalization or other forces that can persistently move inflation that don't have anything to do with fiscal policy. So what is the key difference between funded and unfunded shocks in this environment? So what we are going to show is that funded fiscal shocks, they only lead to a small increase in real interest rates, while unfunded fiscal shocks lead to a large decline in real interest rates. So empirically, what comes out of the estimation is that low-frequency movements in interest rates, in real interest rates, are mostly driven by unfunded fiscal shocks. So in particular, if we go through the phases of US history, economic history, you have that in the 60s and 70s, there were a series of large spending shocks that roughly coincide with the Great Society initiatives. These were very big welfare programs that were introduced in the 60s in the United States to fight poverty and inequality and so on. And they were very large and unprecedented. And the other key implication is that they were shifting the amount of spending for a very long time, not just temporarily. So the present discounted value, if you want, of the increase in spending was significant. And I think it's fair to say that it was not exactly clear who was going to pay for this. And this generates inflationary pressure that at the time was accommodated by the central bank and led, we know, to the great inflation, but also to a prolonged period of low real interest rates. Then in the early 80s, we are all familiar with the Volcker disinflation. What we are going to argue is that the Volcker disinflation needs to be understood as a joint monetary fiscal policy phenomenon. So there was definitely a shift in monetary policy, but there was also a shift in the fiscal climate for which President Reagan pushed for lower government spending, a state that is, a government that is focused only on some key task, and so on. After that, you have a period of relative stability of fiscal real interest rates that remain relatively stable, and that in part is because spending remains relatively stable over those years. And finally, we get to the Great Recession, in which real interest rates drop dramatically, the fiscal real interest rates drop dramatically. They don't generate the same amount of inflation that we saw in the 70s, because they're essentially counteracting other disinflationary forces that you can roughly identify with globalization and the zero lower bound. And then brings me to the kind of most recent period that is the most interesting part, because it's, I mean, we ourselves didn't know much about what's going on these days. So if we look at the pandemic, this is the timeline you can put down. In March 2020, there is the first large fiscal stimulus in the US. It's the CARES Act under President Trump. Now, at the time this is implemented, the model interprets this as largely funded. So what is that changes that actually triggers inflation in this model, that basically shifts the perception that fiscal spending will be partially unfunded? Well, in the summer of 2020, there is the new monetary framework of the Federal Reserve, in which essentially the Fed says that it's willing to accept inflation above target. And that translates into through the lens of the model in a significant drop in real interest rates, and this has mostly a fiscal nature. You basically now have a large fiscal stimulus combined with more accommodative monetary policy is going to give you a lot of inflation. Inflation is already on the rise, and then the ARPA fiscal stimulus come in, and you are basically pouring gasoline on fire, and so this accelerates the inflation dynamics and brings you to record low real interest rates. Now, where are we today? So inflation went down. What we are going to argue is that real interest rates are relatively high, okay? Not excessively high when you really think about it, when you look at, let's say, 5 years ahead or 2 years ahead. Fiscal real interest rates that we perceive to be the permanent component, the persistent component of real interest rates, are just back to the pre-pandemic level, and they're lower than actual real interest rates. So what that means is that there is going to be a downward pressure on real interest rates going forward, because historically, this fiscal real interest rate is really what drives low-frequency movements in real interest rates. Now, what is the caveat here is that there is a lot of uncertainty about what's going to happen going forward. And you might say, well, you know, that's all what you guys economists do. We always say, oh, who knows what's going to happen? It depends. Well, I mean, as you know, I guess it's tomorrow. We have it's election day. I think both candidates ran with very bold fiscal plans. We can argue forever who is bolder and so on. I don't want to get political here. Let's say that nobody's really talking about fiscal sustainability. I think that's a fair assessment. Now, you might think this is just a promise talk, sorry, the campaign talk, and hopefully we will be a little bit more reasonable once somebody gets elected. But that nevertheless creates a lot of uncertainty, and I'm going to argue that you can already see that in financial markets. Okay, briefly, related literature. The literature on monetary fiscal policy interaction has been around for a long time. I would say that seminal paper in this line of research, there are other people that look at this in a different way. I would say Sargent and Wallace, and then here you have a list of papers that are mostly related to the fiscality of price level, but not exclusively. This paper is also related to some previous work I've done in which I was thinking in terms of regime changes between fiscal dominance and monetary dominance. As you will see today, the model is at the same time a little bit more complex, but even simpler, in the sense that what happens in this class of models, these two regimes effectively coexist at the same time, and hopefully that will become clear in a moment. And finally, and I want to stress this because it's important for, I mean, how credible the empirical results are, we build on the models that are traditionally used to analyze US business cycle, okay? Okay, so let me start with a very simple explanation of what we mean with a partially unfunded fiscal shock, okay? So I'm going to first talk about an endowment economy, because that's the simplest model I can write down in which I can explain to you what we are doing. And then we're going to argue, well, this is not really satisfactory for two reasons. First, because you don't get persistent movements in inflation. Second, you don't get real effects. And so this is a conference that talks about real interest rates. So it's not really a good start. But it's a very good model to simply see pencil and paper what it means to have a partially unfunded government debt. Okay, so what is the simplest model that I can think of that normally we kind of use, even in advanced undergrad classes? Well, it's an endowment economy. Okay, so there is a representative household that is maximizing expected utility. It's subject to the typical budget constraint. On the left, you have how money is spent. On the right, you have where resources are coming from. The household can save buying one period government bond with price QT that is equal to the inverse of the nominal interest rate that is controlled by the central bank in response to movements of inflation from a desired target. Now, typically, and that's where maybe this is not exactly what we would teach undergrads, typically we stop here and we just say something like, and the government moves a lump sum tax to keep debt on a stable path, okay? That is, we know that it's a pretty strong assumption, even if it's just a line in our papers. Okay, so now instead, let's move away from that very stark assumption, and let's say that the government, the fiscal authority, also has some sort of rule, and here we keep it very simple. The primary surplus, or here it coincides with net taxes, reacts to deviations of the debt to GDP ratio from its own steady state. And here we're going to measure, because it's going to be useful for what we do later on, we're going to measure the debt to GDP ratio and market value. So we are going to look at the market value of debt divided by GDP. And it's an endowment economy, so in every period, consumption is to be equal to the endowment. Okay, so there are the first of the conditions. You linearize around the steady state. So you get a familiar Fisherian equation in which movements in the nominal interest rates depends on expected inflation. There is no real interest rate here because it's an endowment economy with a standard endowment. We are going to get a fixed real interest rate. So there are no fluctuations in the real interest rate. In the ex-ante real interest rate. There are going to be fluctuations potentially in ex post realized real interest rates. So this is the linearized debt to GDP ratio, depends on the past debt to GDP ratio, realized real interest rates, and taxation. Monetary rule, fiscal rule. Now you combine the Fisherian equation with the monetary rule, you get what we call the monetary block. And again, this is what we are used to. We teach undergrads how to solve this forward and so on. And then by also you get this fiscal block that effectively shows where monetary policy becomes relevant for fiscal sustainability, because effectively monetary policy controls realized real interest rates over here. So intuitively, you can keep the debt to GDP ratio on a stable path or by taxing appropriately or by letting inflation move around, but this requires cooperation from the central bank, okay? And so this brings me to the partition of the parameter space that has been introduced by Eric Klipper in '91. So it shows that in this class of models, there are two areas of the parameter space that give you a unique solution. The first one, the blue economy, everybody's happy, is what monetary-led policy makes. The fiscal authority is passive in the sense it passively accommodates the behavior of the active monetary authority. The central bank has perfect control of inflation. So another way to say this is that inflation is isolated from the fiscal block. The red regime is the fiscally-led policy mix. Now, the fiscal authority is not committed to implementing the necessary fiscal adjustments. And so the macroeconomy is not isolated from fiscal disturbances. And we say the monetary policy is now passive in the sense that it reacts less than one-to-one to inflation to accommodate the behavior of the active fiscal authority. Okay, so now this is, again, a very simple model. Let's see what happens if we have a fiscal shock in the monetary-led policy mix versus the fiscally-led policy mix. What does it mean that the macroeconomy is isolated with respect to fiscal disturbances? Well, if I have a primary deficit shock, you see that in the blue world, always monetary-led policy mix, you get no impact on inflation. So pretty boring, okay? So just a flat line. Why? Well, you give money to people today, they save it to buy bonds, and then they repay whatever they need to repay when the time comes. what happens instead if you are in a fiscally led policy mix? Well, you get a jump in inflation because effectively this extra spending is perceived as unbacked, unfunded, and so you get inflationary pressure that is accommodated by the central bank, and you get a jump in inflation. Okay? So in one case, you get full separation between the fiscal block and the monetary block. In the other case, you actually get that all the stabilization of debt is done through inflation. Okay, so this is, I would say, where the literature was until a couple of years ago. Then we started thinking, what if the way policymakers react to shocks actually depends on the origin of the shock? So in the sense, we are used to always write a Taylor rule in which the central bank reacts in a certain way no matter where inflation is coming from. And for central bankers, I think it's easy to understand that it's a bit more complicated than that. Now, they might not be willing to literally say, well, maybe sometimes the monetary authority accommodates the behavior of the fiscal authority, because that would really not fly for a central banker to say that. But, that's the idea that we want to think about here. And the method is very flexible. So if you don't like the idea of, well, sometimes the monetary authority accommodates the behavior of the fiscal authority, you can apply this to whatever you prefer. Maybe you say, well, the way we react to supply shocks is different to the way we react to demand-side shocks. Okay, so then how do you implement this idea? How do you implement the idea that perhaps there are situations in which the monetary authority and the fiscal authority cooperate with each other in a different way? Well, technically speaking, what we are going to do is to introduce we're going to keep track of the amount of debt that is going to be backed by future taxes and the amount of debt that is instead left unfunded. So what it means is that now the fiscal rule is going to have two parts. So the fiscal authority is going to react according to the blue regime, the monetary-led policy mix, not to the overall amount of debt, but to the amount of debt in deviations from this unfunded stock of debt. So think about what happens here. There are some shocks that generate accumulation of debt, and we don't really know how we are going to repay for them. So we're really not going to have a fiscal plan in place to cover them. So with respect to this funded amount of debt, we are going to follow the monetary-led policy mix rules. But with respect to this unfunded portion of debt, we are possibly going to behave differently. And so from the point of view of the fiscal authority, the simplest thing to imagine is that there is a certain amount of debt with respect to which the fiscal authority simply does not react. It doesn't really have a plan to increase taxes. We send checks to the public, and nobody has even a discussion about how exactly we are going to repay for this unprecedentedly large 1.9 trillion fiscal stimulus. Now, again, from a technical point of view, then what you need to do is that every time there is a fiscal shock, you need to label it, is this a blue shock or a red shock? And when you have, for example, a very large fiscal stimulus, it could be that part of it is funded and part of it is unfunded. Okay? Now, what does the monetary authority do in this situation? Well, the monetary authority is going to react to inflation in deviations from fiscal inflation according to the monetary-led policy mix, but is not going to counteract the amount of inflation that you need to keep unfunded debt on a stable path. So with respect to this amount of inflation that has a fiscal nature, the central bank is going to react less than 1-to-1. Now, if you bring it to the extreme and you set this coefficient to 0, meaning that you fully accommodate fiscal inflation, now you can see that my monetary rule looks like a rule with a time-varying inflation target. So it's isomorphic to a time-varying inflation target. The key is that this amount of inflation over here is not an exogenous process that we don't know where it's coming from. It has a specific nature. It needs to obey some cross-equation restrictions. And it's essentially the amount of inflation that you need to cover the amount of spending that is unfunded. OK, so that's the idea. I'm going to skip how you solve the model, but once you figure it out, it's actually pretty simple. You just need to do something very similar to what we do when we track natural output. We actually talked about the natural real interest rate a moment ago. So that's exactly the same kind of idea. But then what you get and that's the last panel I have over here. Now you have that in the same model. So these are not two different parameterizations of the model. This is the same model. You get that if I have a blue shock, if I have a funded fiscal shock, I get the same impulse response that I was getting over here. If the world is always blue, is always monetary led. But if I have an unfunded fiscal shock, I get the same type of impulse response that I was getting if the world is always led, always monetary led. Okay? So the key is that these two regimes coexist at the same time, and that's what's going to allow us to look at US monetary history and fiscal policy in a kind of, I would say, richer way compared to simply saying the world is always monetary led, always fiscally led. Okay, so in production economies, what do production economies give us? We are going to show that if you have flexible prices, you essentially get the same kind of impulse responses you were getting in the endowment economy. And so what really helps you is to introduce nominal rigidities. Okay, so let me show you how this works. So here on the very top, I have a production economy, but I don't have nominal rigidities. So a funded fiscal shock, you can see, behaves exactly the same way my endowment economy was behaving. And again, no effects on the real interest rate. It doesn't change if I have an unfunded fiscal shock. I still get inflation like in my endowment economy, but no effects on the real interest rate. So not very useful for today's conference, no? Okay, now what if, and then of course we don't get any effects on the real economy either. What if I make my Taylor rule a bit richer, and instead of saying that the response to inflation is 0, I make it persistent. Less than 1-to-1, but persistent. Well, now I get some inflation persistence, so I'll say that's progress, but again, no real effects and no effects on the real interest rate. So effectively, here you get inflation persistence, but this is coming from something a little bit subtle, is that your Fisherian equation creates a relation between inflation and expected inflation through the nominal interest rate. And so the persistent effectively coincides with your parameter phi f. Okay? So again, not very useful if you want to think about real interest rates. So finally, if you introduce nominal rigidities, you get that funded shocks still have this macro-fiscal dichotomy for which in these models with non-distortionary taxation, no hand-to-mouth agents, I don't get any effect on output and real interest rate. But now unfunded fiscal shocks generate a lot of persistence in inflation. And most importantly for today's conference, they finally give me persistent movement in ex-ante real interest rates. So here you see that there is a very prolonged period of low real interest rates. And notice something interesting here. So I'm spending more, but the debt to GDP ratio drops. So that's the result of the fact that fiscal sustainability, so to speak, is here achieved by a jump in output and a drop in the cost of financing debt. So convergency, the increase in inflation is front-loaded, and this lowers the debt to GDP ratio. Okay? Okay, so that's the mechanism. So now what we're going to do, we're going to embed this into a state-of-the-art tank model. So again, we are going to have all the ingredients that I discussed before, distortionary taxation, price and wage rigidities, hand-to-mouth households, long-term government bonds. So that effectively is the typical model that we would use to look at the US business cycle. And also means that we have all the shocks that normally economists use to explain the US business cycle. Okay, that's, again, this is important, not because I particularly believe in these shocks, but because I want to make sure that the results I show next are credible in the sense that it's not that there's only one mechanism to explain inflation and real interest rates in this model. Okay, so then the technicalities are similar to what I told you for the simple model. You really need to keep track of this amount of unfunded debt that is going to be stabilized through inflation. And again, in a much richer model, you need to face problems like the zero lower bound. And then you are going to have like a much richer fiscal block, as you can see here. But again, conceptually, it's very similar to what I showed you before. So let's move immediately to the empirical analysis then. So so in the original paper, we were looking at data up to 2022. So now here we extended the sample to kind of think about what's happening these days. What is the outlook for real interest rates in 2024? And so here you see that the estimation is based on the standard macro variables plus fiscal variables plus variables that are indicative of markets' expectations about where inflation and nominal interest rates are going. Okay? So let's take a look at the data before we actually try to disentangle the role of funded and unfunded fiscal shocks. So as you see, if you look at US data, we have a prolonged period of high inflation, high and rising inflation, that coincides with a prolonged period of low real interest rates. Then there is a dramatic jump in real interest rates in the early 80s. And as a result of that, inflation comes down. Now, if you look at the post-Great Recession period, you see that there is a shift down in real interest rates, and then real interest rates really drop even more during the pandemic. Now, what is striking in my mind, that to be honest, not enough people, not enough economists look at these variables, is what happens to variables like, for example, transfer to GDP ratio in the United States. So you have a large acceleration in the 60s and 70s, then relatively stable dynamics, essentially from the mid-70s to 2010, but still upward trend. And then we have a discrete jump post-Great Recession, and then these two incredibly large fiscal stimuli over here. Now, if I were to use a trend as opposed to GDP, if you're worried about, well, of course, you are dividing by GDP, and GDP dropped dramatically during the pandemic. No, even if you take the trend, you would get this massive fiscal stimuli. The other thing that's interesting is the debt to GDP dynamic. No, so this starts in 1960. If I were to add 1950, we start around here, then you would get this magic result that the debt to GDP ratio go all the way down to the historical minimum in the 70s. And what we are going to argue in a moment is that this is just the other side of the coin of this very accommodative monetary policy here. When is that this dynamic changes? Well, when the shift in the early 80s occurs, and now we start accumulating debt. We accumulate a lot of debt during the Great Recession, and then again something magic happens post-pandemic. We spend a lot, and then boom, the debt to GDP ratio drops to a level that is very similar to what we had before. And what is the culprit? Once again, inflation, but accommodated by the central bank. Okay? So sometimes when people think about inflating away debt, I think they kind of also forget that that's just part of the story. You also need real interest rates to drop, because if the central bank were reacting to this large inflation, doubling the nominal interest rate, it would be a very different story. Okay, so then how do impulse responses to funded and unfunded fiscal shocks look like in this richer model? Qualitatively, they are similar to what I showed you before. Quantitatively, they are a bit more interesting. So a funded transfer shock, as you can see, has a very small effect on GDP growth and a very small effect on real interest rates. And it acts exactly as you would expect, in the sense that we spend more, we accumulate more debt. That's exactly what intuitively would seem to be the case. No? If I have an increase in transfers, we start accumulating debt because taxation is very slow to react. What about an unfunded transfer shock? Now, the unfunded transfer shock is perceived as not backed by future taxation. This generates inflationary pressure that is accommodated by the central bank. Then you get a large drop in real interest rates, a much larger effect on output growth, and a large jump in inflation. And the other thing that happens is that the debt to GDP ratio, like very similar to what I show you in the simple model, doesn't really go up. Instead, it goes down because of this jump in this drop in real interest rates and this jump in real activity. So very different responses. And again, qualitatively, they are exactly like I showed you before, so that the mechanism at work is the same. In the sense, the sign restrictions are the same. Okay, so what that gives us is that if we look at the relation between the real interest rate, that would be the black dashed line, and movements in unfunded spending, we find that when unfunded spending accelerates in the 60s and 70s, you have a large drop in real interest rates. When it starts declining, starting from the mid-70s, you have a jump in real interest rate back up. So what that gives us is a very strong negative correlation between the amount of spending that is unfunded and the real interest rate. Now, what about funded spending? Funded spending, as you can tell, has still a negative correlation, but is much weaker. And if you look at the historical evolution, the relation with real interest rates seems much less evident than for unfunded fiscal shocks. Okay, so here what we uncover is a very negative correlation between how the change in spending that is not backed by future taxes and real interest rates. Now, to make this more visible, what we are going to do, we are going to take the real interest rate and we are going to decompose it into the amount of the real interest rate that can be explained by unfunded fiscal shocks, that would be the blue line, and unfunded plus funded fiscal shocks, that would be the red line. So in one case, I only have unfunded, and in the other case, I have both. So immediately what you can tell is that there is not much difference between the red and blue, and so we are going to focus only on the blue line, that is effectively movements in real interest rates that can be accounted for changes in unfunded spending. Okay, so what do you see from this graph is that at low frequency, a very large portion of the real interest rate can be explained by these unfunded fiscal shocks. So in particular, in the 60s and 70s, you have, if you remember, I show you this large acceleration in transfers to GDP. That part of it is unfunded, and this drives down real interest rates. Then starting from the mid-70s, there are no new shocks. And if you remember my impulse response, what happens in response to an unfunded fiscal shock, there is an initial jump in inflation, and then inflation comes down, let's say in around 2-3 years, let's say, but then it remains a little bit above target. And similarly, for a real interest rate, so you see the mirror image. There is initially a large drop in real interest rates, and then a recovery. So what happens in the second half of the 70s, there are no new shocks, and so this effect on real interest rates starts dissipating, and then it accelerates in the moment Reagan is elected, and Volcker is given like full freedom to bring inflation down, and so there is a really large increase in these fiscal real interest rates. After that, you have a period of relative stability. They tend to go down after recessions, but overall, they remain stable until the financial crisis, in which you have, again, a shift down in real interest rates that can be related to unfunded fiscal shocks, and then you have the large drop during the pandemic. So now, where are we these days? If you notice, the real interest rate, this black line, is actually larger than the fiscal component of real interest rates. So one way to interpret this is that if you buy the story that this low-frequency component of real interest rate is mostly driven by fiscal needs, effectively, then what this would tell us is that there is going to be a downward pressure on actual real interest rates. They are going to come down, okay? And so now I want to zoom on this idea. I want to just focus on this idea that real interest rates at low frequency are coming from the fiscal side, and so because of that, in the current situation, we should expect going forward real interest rates to come down even more than what they have already done. And so in order to do this, I'm going to use two forward-looking variables. They are market-based expectations of nominal interest rates and inflation. Now, everybody understands that these variables also have other components, like premia, but nevertheless, they are still good indicators of market expectations about future inflation and future nominal interest rates. So what are these two measures? One is the 5-year break-even inflation expectations, and the other one is the 10-quarter ahead expected federal funds rate based on swap contracts. Okay? Okay, so the first thing you can see is that this market-based measure of inflation expectations, for a long time, it was below target. The target of the Federal Reserve is 2%. These market expectations at a pretty long horizon were below target. Again, part of this might be premia, but in part, this is really reflecting the fact that at the zero lower bound, there was some tendency for inflation to remain below target, and this was becoming an increasing concern for the central bank that actually led to the revision of their policy framework. And that's what I want to focus on, this revision of the policy framework that occurred in the summer of 2020. So now, this is, if you notice, we have that these market-based expectations of inflation are actually pretty low in the beginning of 2020, and then something changes, so the inflation takes off. But if you look at the behavior of interest rate swaps, what happens is that there is a dramatic drop in this expected federal funds rate. And this is effectively the result of the change in policy strategy of the central bank, or the Federal Reserve, that some commentators call the average inflation targeting, that's not absolutely what it is, because it's not symmetric, and Richard Clarida made it clear at that time. And the language, even in the statement, was pretty clear. It was talking about when inflation has been below target for a while, it's fair to let inflation go above target. There is no mention of if inflation has been above target for a while, it's fair to get inflation below target. So it's a very asymmetric rule for which, to counteract the deflationary pressure coming from the zero lower bound, they shifted this, the symmetric policy strategy that they have to an asymmetric policy strategy. Okay, so why that's important? Well, because now there is no discussion at the Fed that we should have inflation at 1% for a couple of years to make up for all the high inflation we had in the past. And that's absolutely correct, because it would be, I don't know, very dangerous to try again to push inflation below target and possibly end up at the zero lower bound again. Okay, good. So the central bank changes the inflation target. It opens the door to inflation above target. What that does, it determines a very large drop in real interest rates. Okay? Inflation takes off, but the federal funds rate remain put for a while, and this determines a large increase in inflation. And when you look at the behavior of the real interest rate, we can decompose the behavior of the real interest rate, that would be this red line, into what is coming from the fiscal unfunded side, there would be these black vertical bars, versus everything else. And what you can see is that it's effectively these black bars that are the effect of unfunded fiscal shocks explain a large fraction of the drop in real interest rates. But again, this needs to be understood through the lens of a fiscal stimulus and a monetary policy adjustment. Now, I always want to mention this, that I'm not here trying to criticize the Fed or other policymakers around the world, because we tend to forget where we were at that time. So there are economists that have written extensively on the fact that if you are at the zero lower bound and you are constrained by what you can do in monetary policy, then fiscal inflation might be your only way out. Woodford mentions this to be something akin to make the zero lower bound fiscally unsustainable. Okay, so you can show that this is qualitatively, this was probably the optimal thing to do. Possibly with the benefit of hindsight, we could have done a little bit less, but that's another story. Policy needs to be done in real time. Okay, so we have change in fiscal spending, change in the monetary policy strategy, big jump in inflation, big drop in real interest rates. So now, remember the impulse response. If you don't keep doing this, inflation naturally gets reabsorbed, and real interest rate naturally increase, but there is a very persistent effect. So there's almost like there is a short-run effect that is very large, and then there is a long-run effect that is very persistent but significantly smaller. So that's where we are now. This fiscal inflation gets reabsorbed, the fiscal real interest rates go back up, and what you can tell is that now what is keeping real interest rates above from this level are other shocks, particularly monetary policy shocks, for which the federal funds rate is temporarily large. But if you look at what happens to market expectations of inflation, we get a reversal over here. So what that means, again, through the lens of the model, is that markets start being a little bit nervous about what's going to happen going forward. If you notice, this expected inflation measure was on the way down as inflation was getting reabsorbed, and now we are back to a drift up. Okay, not massive, but definitely a little bit concerning given that where we were before the pandemic. So what is this reflecting then? This is reflecting the large uncertainty about what's going to happen to fiscal policy, or at least that's the way we interpret it, that the fact that it's really not clear how we are going to sustain already record high level of debt if the fiscal plans are about more spending. Okay, so let me conclude. So let me kind of try to wrap things up, and let me give you a little bit of the overview of what we did in this paper. So we wanted to think about low-frequency movements in real interest rates through the lens of fiscal policy. And in particular, what we argue is that if spending is perceived as backed by future taxation, then the impact on inflation and real interest rate is minimal. So what that means is that if you want to have a large government, there is nothing wrong in itself on that plan. You can transfer a lot as long as it's very clear who is going to sustain your welfare programs. On the other hand, large amounts of spending that are not backed by future taxation, they generate low-frequency movements in real interest rates. As I was arguing, there is a large jump in the short run, and then a much more persistent effect in the long run. Now, if we look at the pandemic, fiscal real interest rates dropped significantly. We've often focused on the fiscal stimulus itself, but it's also the result of the change in monetary policy. Post-pandemic, we get the fiscal real interest rates went back to the pre-pandemic level, while actual real interest rates are a little bit more elevated. So our prediction is what that means is that there is going to be downward pressure on real interest rates. Going forward, they are going to come back down. Now, is that good or bad? Well, it depends how you perceive it, because the problem is spending and debt are currently at an historical maximum. So even small revision in beliefs about how exactly we are going to sustain this record high level of spending can really shift the real interest rates a lot. Now, sometimes I hear this argument that, well, we can always, if inflation takes off, we can always do what Volcker did in the 1980s and again increase real interest rates a lot. Well, it's not that simple, because as we are seeing now, larger real interest rates, when you have a record high debt to GDP ratio, are very costly. So even from a political point of view, it's not so simple for the central bank to keep interest rates elevated for a long time. Another way to say this is that it's not that fiscal inflation was not there before the pandemic. It was counteracting other deflationary forces. What are the other deflationary forces? Well, arguably the most important one is an increasing level of integration of the world economy. So here, again, I want to be precise. It's not just integration, it's increasing integration. That's what generates the deflationary forces. If at some point this process of integration stops, or even worse, reverse, and there are a lot of signals that that's a real possibility, then it's not exactly clear that this record low level of fiscal real interest rates are sustainable, meaning that they are compatible with a low inflation level. And I think that's exactly what markets are concerned about, that things worked out very well pre-pandemic. We could spend a lot without not too much concern about how we were going to repay. It's not clear that we can keep doing that indefinitely. That's it. Thank you.
Thank you very much, Francesco. Now is the turn of Professor Professor Juan Pablo Medina. You have 15.
And the clicker is over there. Yeah, I left it there.
Okay, yes. Oh, let me thank the Central Bank and the organizer for inviting me to comment. It's a pleasure to be here to meet many former colleagues because I work at the Central Bank for many years, so I'm very happy to be here. Where is the presentation? Okay, so it was nice to see many charts because last week I spent working with the Central Bank of Guatemala, and we were struggling with the idea of how to explain this historical composition of many macro variables. So I feel that I were in track because I was trying to do the same that Francesco was doing here. Let me try to summarize the main ideas of Francesco was doing here. My point of view, because I wasn't aware of all this literature that Francesco was mentioning, but I was of the background of thinking of fiscal dominance or not. So you are in two extreme worlds. So here, Francesco and many papers that he was working is the idea that the fiscal dominance is a state-dependent situation. Maybe you're not going to be in a stream or another stream. So and here is a shock-dependent situation, okay? Some shocks transmit under fiscal dominance, and other shocks that does not, okay? The key insight is, as Francesco has mentioned, is expensive fiscal shock in a regime of fiscal dominance generate a rise in inflation, a rise in inflation expectation, a reduction in real exchange rate, in real interest rate, and a fall of debt to GDP ratio. That is sort of very striking for me. In contrast, expansive fiscal shock in a regime without fiscal dominance or monetary dominance, less movement in inflation, and he showed the graph, less movement in inflation expectation, less movement in real interest rate, and the debt to GDP rises, okay? And here, what they're doing is using the standard model extended with this logic, they estimate the role of this unfounded fiscal shock, so in shaping the evolution of the real interest rate, okay? So what is the very simple, because I try to come from the side that I know, so the literature that I know is, there was a literature that tried to, and the paper mentioned that the idea that you have an exogenous time-variant implicit inflation target that is in the Taylor rule that is there, and then you see that this P bar is something exogenous. And there is some paper that did that for US, and here the new bar is now this time-variant implicit target related with some fiscal part of the decision. So fiscal, unfunded fiscal transfers, okay? And this is a nice work, I will say, because I read the paper and I also read the QUE paper, that is a very nice paper as well. So they based this analysis here where the focus there was more on deflation, and here the focus most is in the real interest rate. But the logic is sort of the same. So that is my summary, and I will say that it's a very nice paper, and so I try to go a little further, try to propose some additional question to this, okay? So the first things that the paper does is try to separate, so they have the full model and the logic, but it's very clear and very nice, executed, is the idea that you have a model with unfounded fiscal shocks, okay? And then they solve that model, so like under fiscal dominance, and they bring that result to the model with all the other shocks, including the funded fiscal shocks. So, and then the logic, the transmission goes in one direction. So there is no direction in the end, in the final model that estimate, that something that happened with the funded fiscal shocks or other shocks affects the unfunded part of the model. So, but that is the way that they have a very clean way to do the lognarization, so it's very well executed anyway. But it's still, you have the question, there is no correlation between the realization of unfunded fiscal shock and realization of funded fiscal shock when the debt to GDP ratio in a country is big or US is big. Probably you don't have the backing of the future fiscal adjustment to know exactly what is going on. So in the end, you don't have, for example, something like here in the bottom. I try to say that what happened is you have that this unfunded fiscal transfer depend on the debt of the country and not only from the unfunded part of the model, okay? So the other thing that struggled to me was see if there is a way to connect the fiscal multiplier implied by these shocks, okay? So what are the sides? So Francesco presented a chart with the effect on GDP growth. So what is the fiscal? I couldn't track exactly what are the sides of the fiscal transfer as percentage of GDP in the state to come up with the number in these two sides of funded or unfunded to try, because presumably they are small, all the fiscal multiplier in this model, because the amount of the estimated amount of hand-to-mouth consumer is very small. So this kind of cognition channel is very small in the end. Also, I would like to see the comparison because there is many papers that try to make this state-dependent fiscal multiplier, and they base on the idea that in recession is very huge compared to expansion. So I try to see more of that. And the other thing is, and the paper, I will say that it's very clear, who determine when a fiscal choice is founded. So the model is what the model said, or is what the market believes. So I don't know if the market believes that there's not going to be a fiscal adjustment in future, and that is enough just to make all the channel going on with the unfunded fiscal transfer. So there's no discussion on that respect, because I will say that just with expectation, if the market doesn't expect that there is going to be a future adjustment, everything is going to hold anyway. So could be other, you can think of government spending shocks, unfounded. You can see that as well. So for example, the size multiplier was related with this. So what is the size? So it's very small, the size of funded transfer, okay, compared. So the extension to open economy setting, okay? So the role of the exchange rate, the role of what is the size of the debt denominated in foreign currency for the public sector. So I would say could be mitigation, because the exchange rate in a flexible environment would be a shock absorber, so it's going to be a shock absorber even for the unfounded fiscal shocks. But also could be amplification, because unfounded fiscal shocks operate more intensively if there is only a fraction that is denominated in nominal currency, and not all the debt is denominated in nominal currency, okay? And not in Chile. So we have a huge inflation surge, but with funded transfers. So I could imagine what could be if this unfounded transfer would be even higher the inflation that we observe. So that is one thing to think of. And also coming back for a very technical point is identification within the model. So in the end, although Francesco present something in the very simple model, so you don't have for example, in the case of monetary policy rule, you don't, in the estimation model, they stick with the idea that the central bank is passive, completely passive to the inflation, fiscal inflation. But you can still have a zero value, but below 1, okay? You can think of the same for the fiscal rule as well for government. And you can see that it can be estimated, these additional coefficients, and make the identification differently. So there is something that I could think of, because the model estimate imposing these zeros, okay? But there is a continuous possibility. So it could be identified, this other coefficient, in addition to this channel that unfounded transfers. Simple, okay? So, so a final point is, I would like to see, to make sure that the blue line in one of the figures corresponds exactly with this fiscal inflation. So I understand that this blue line here is the fiscal inflation, but I'm not sure, but because it just said the variation due to, but I will say that is that variable because it's an observable variable that you infer from the model, okay? And the same, I would like to see the plot of this, what is the size of the debt to GDP ratio, the proportion that is unfounded, okay? Because it's a latent variable that you infer with the model, I will say how to compare with the whole debt to GDP ratio in US. And also, a final point regarding this is identification outside the model. It could be possible, since I said that it's the belief of the market if the fiscal expansion due to transfer is back with future, or is the market knows. Could be some narrative way to see how different laws pass and there is some backing or no backing on that expansion with future adjustment or not. So this is one way to build some narrative. So again, something that, that you can think of this. So that is the idea, blue line is that, and then just to finalize, I will, as the governor of the central bank mentioned at the beginning, there is many reasons regarding the low frequency trends in real interest rate around the world. So I understand the model have this idea, but I didn't see if the model accommodate these other forces for a long period of time, so that there are changes in the productivity growth. So the model have productivity growth, but it's not very persistent. Okay, the saving rate of emerging economies is always a slowly moving process. The role of unfunded fiscal transfer. When you see the graph, you see that the blue line here. The blue line here is sort of smooth, but here after 2010 is not just smooth. So it's many shocks in one direction, shocks in the other direction, so it's not necessarily a slow-moving trend after that. So the effect of, I agree that it's important to understand what is the cyclical or medium-term position of the real interest rate besides these other factors, but I will say that this is something that is more in the medium or short-term feature. So try to compare with regarding the trend factors, okay? So just a minor comments. I was puzzled, just to finish, just a minor comment, maybe I wrong, but I just saying anyway. So all the response of GDP unfunded is just almost permanent, or is really a peak very low in the past and then reduce later, I don't know, 20, or 100 quarters, I don't know, but everything looks permanent. And I understood that the model was, in the end, stationary in that dimension. I was confused, but maybe because I dumb, and the idea that with this subscript of M, that meant monetary-led policy regime, and the F, fiscal-led. So with the idea of funded fiscal transfer, so it make me a little confused for me, but maybe it's my bad in that dimension, so there is something. And the dynamic transition, the median of the state value of estimated the model, because the estimate for US is 245. So I would say that this is a transition dynamics, because you see that this below that. So there is a transition dynamics in the model implied on that. So with that, just I finish. Very nice framework to analyze macroeconomic impact of fiscal shocks with no bucket by future fiscal adjustment, natural extension of the paper that they wrote in the QE to understand the role. To many avenues that I mentioned, for me, was very interesting to read, to refine and extend the analysis. Many thanks. Okay.
Thank you very much, Professor Medina. Do you want to have 3 questions?
Sure, yeah, whatever, you're
Okay,
the
so
moderator.
we are going to have like 10 minutes for questions from the floor, and then, so, Ricardo.
Hello. Oh. Can I ask Francesco, when you say that the central bank is pushing for these real returns that are persistently low, as you said in the past and the future, help me out a little bit here with the persistence versus trend, because ultimately the real returns are going to end up equating some real interest rate determined by real factors, say a subjective discount rate or something like that. So the central bank can do this temporarily, much like inflating the debt, as you well put it, letting the debt fall through a real return, but that's always going to be somewhat temporary, and at some point that's going to backfire when the expectations adjust and you can't do it anymore. So can you make this distinction here between the persistent versus permanent? Usually I would think that unfunded fiscal transfer, the central bank can initially cause, like you said, low real returns, but ultimately only financial repression would allow for any kind of persistent low returns on debt. Monetary policy would not be enough, but
Very nice paper, Francesco. Just a couple of quick questions. The first one is just on the empirical. I didn't fully understand the definition of unfunded transfers empirically when you look at the data, how you're defining it, because when I think about it, it's a bit hard to figure out what is funded, what is unfunded. The other question is, I think, related to what Ricardo was saying as well. It's a question of how I should think of financial repression in what's going on, and I think it's we expect more of it given the way things are going in the future, but we lack a micro foundation of how to think about it. And so if you have any thoughts on that, thanks.
Yes, also a very nice paper, Francesco. And I have I guess a related question, because it seems to me you're talking a lot about expected real interest rate, but you know, we have in mind a different concept. And I was wondering, in your analysis, what would happen to the underlying natural real interest rate, which is probably what I guess also Ricardo was hinting at. And the other question is a little bit broader in terms of the approach underlying your analysis, and you refer a lot to fiscal sustainability, but I don't understand what is the concept of fiscal sustainability that is underlying your model. It seems to me that it's a totally arbitrary setting of debt to GDP ratio underlying your fiscal rule, but there's nothing that's pinned down in the model.
Okay, just one more question myself. Let's leave aside the pre-Volcker period. Okay, so let's assume that after Volcker you have a regime change. Monetary policy is conducted in a different way. That coincides also with the fact that you have a lot of changes in institutional frameworks around the world, independent central banks, inflation targeting, and so on. So the logic of fiscal dominance here, it can be interpreted as monetary policy strategic behavior, in the sense that if you have a negative shock in the economy, you're going to miss inflation target, then this policy can help you to basically reduce the real interest rate to give this sufficient stimulus to the economy. So more than fiscal dominance is a logic in which you have that monetary policy strategically wants to have that sort of unfunded shocks. And in terms of, imagine that the story is unfunded shocks, and that basically you have the fiscal side dominating the monetary policy side. So in terms of the consequences for the real interest rate, thinking in terms of the second moment, is that if I'm an investor, I know that under certain situations, you're going to have these unfunded shocks, and I know that monetary policy is going to respond with higher inflation, so therefore you're going to have a premium there, so you should expect interest rate, nominal interest rate long term, to be higher. No? So that's, okay, so now you have 5 minutes or more.
Right, okay. I mean, these are a lot of great questions, so I'll try to do my best to address all of them. So let's start from the end and then go up. So I think this is an excellent question, and again, you might have noticed that the Fed cut rates by 50 basis points and it surprised markets to some extent, because in reality somebody must have leaked to them that was on the table, but that's another story. And mortgage rates didn't come down. Long-term interest rates didn't come down. In fact, they went up. And so I think that really speaks of some concerns that financial markets have of fiscal sustainability. And that brings me to Gianluca's question. No, you're absolutely right. So debt is always sustainable here. It's just a matter of how you're going to repay for it. It can be through inflation or through taxation. Now, normally, I would say when maybe loosely speaking, we use fiscal sustainability more to refer to the fact that the government, the fiscal authority to be precise, has a plan to repay any program that he has in mind. But you are absolutely right that here the concept is loose. That is always sustainable. The question is it going to be sustained through increases in inflation or taxation? So Atif asked a very good question about, okay, how do you exactly define unfunded transfer shocks? And so I think this is related to identification in the model. So, so here you can think about that at the high level, you can think that effectively these shocks are identified through sign restrictions. So you could do a very similar exercise to the one we did into a VR, in which you say, well, if I see an increase in spending that moves in a certain way with the macro variables, I label it funded, otherwise I label it unfunded. And so the key here is that the shocks are identified through the lens of this particular DSG model, but in the appendix we also show that you get very similar results if you do the VR. And I would say not surprisingly, because if you look at the history of this literature, effectively these models were reverse engineered from a VAR. Financial repression, that also incredibly important. I think only recently, and at Princeton, there is definitely somebody that's working on it, Payne is working on it. They are trying to bridge the gap between these two literatures, the one on essentially fiscal dominance, fiscally led regimes, monetary fiscal policy interaction, and financial repression. It seems like a very natural thing to do. It's just that it's relatively recent. I mean, they're not the first by any mean, but it's definitely like getting more attention now. So now, how would that show up in our model? Well, effectively, suppose that in the background, in reality, there is some spending that is sustained through financial repression. Then in our model, that would show up as a funded amount of spending, because it wouldn't be as inflationary as it would be if financial repression were not there. Now, where things get a little bit more subtle is what happens if financial repression is so large that you can have persistently R less than G, and then that is simply always mean reverting thanks to that dynamic. So that's a little bit different. So the assumption is to be that at the end of the day, you cannot simply sustain any amount of spending only exclusively through financial repression. And I think, again, the recent literature on this topic is going in that direction. So this also brings me back to something we were discussing before about what if you do this systematically. Okay, so that's another important aspect. So what allowed the United States and arguably many other countries, many other OECD countries to actually boost the economy through these very large fiscal stimuli during the pandemic is that they had established some reputation for not exploiting this mechanism systematically. If you do that, then of course you cannot fool markets forever, no? So now this is related to the very first part of my talk, in which I was showing the difference between nominal rigidities and not nominal rigidities. If you are systematically playing this game, then nominal rigidities are off the window, and then you don't get any benefit in terms of real activity, and you don't even get persistent effects on real interest rates. And so going to Ricardo's point, how permanent or how persistent these effects are, yeah, this is very much driven by the level of nominal rigidities you have in the model. And yes, you cannot, so we estimate this to be very, very persistent, but the peak is very large, so the very persistent effect gets much smaller. Okay, so we're done. This is related to your question. First of all, thanks a lot for the great discussion. I mean, you gave so many good comments that I'll try to address as many as I can, but you made a lot of very good points. So yes, everything here is stable and stationary. Everything is mean reverting. Is that, again, we estimate this process to be incredibly long, and again, this is related to Ricardo's point, because if you look at the data or the debt to GDP ratio, I mean, if you were to do a unit root test there, you cannot reject the idea that it's a unit root. That doesn't mean, economically, we know that that's not the case. It can't possibly be, but yes, that we pick that persistence from the data. So narrative evidence, great. I'm a big fan of that. So I have a research agenda on this, and in some papers we dig way more, including the QJ paper. But if you really want a paper that really goes into the details of the narrative evidence, it's a paper I have with Cosmin Ilut that I think is going to be soon my most cited paper, even if it's not my best published paper. But that's sometimes the way it goes. But I'm very proud of that paper exactly because it combines the econometrics with the narrative evidence. And you can really go back and see how the political climate changed over time in the US, but you could argue this for many countries. We wrote a paper for the IMF that does a similar analysis of the QJE paper for the UK, and there, in some ways, you find a lot of similarities for the 60s and 70s versus the 80s. Then the two countries start diverging a bit, but over the early part, they are similar. And I think, like, you know, an interesting topic going forward would be to bring a little bit more political economy into this literature. So again, something that I think researchers are starting to think about. So you mentioned about, could you have some partial adjustment coming from other sources, like G, for example, government purchases, to be precise? Or could you have, in the Taylor rule, some response to inflation, but less than 1-to-1? Absolutely. We tried. In the end, we felt a little bit uncomfortable in going with that as the baseline, because you know, when you estimate these complex models, sometimes you find multiple peaks of the posterior. Now, qualitatively, they were all giving the same result, but then it was like, okay, you know, here the difference is like 5 log points. Which one seems to be more appropriate as? Where should I center my analysis, no? So in the end, we prefer this specification that is more parsimonious and returns a better fit to the data, and it doesn't create this problem of identification of this additional parameter. Excellent question is, what about small open economies? So that's, again, something that I've been thinking for a while, and I'm trying to write something on it. My international macro goes back to the great professors I had at Princeton, including Helen Ray, that we partially used to motivate this paper. And so I'm not an expert, so I'm trying to team up with some people that are a little bit more up to speed with the current literature. But it's actually very interesting there, because what really matters is this concept of nominal rigidities. The interesting thing is that, contrary to what you might think, having indexed debt is going to give you more inflation instead of less inflation under nominal rigidities. And the reason why is because the amount of inflation that you need to actually stabilize debt is larger. Okay, so and again, maybe this is what was obvious to you. To me, I thought I discovered something pretty cool. Then I think I talked with Manuel Amador and was like, well, that's obvious, but okay, fine. So for me, I thought it was very cool. But I think, like, for people that are not in the literature, it's not immediately understood. And the reason why it's not immediately understood is because the fiscal theory of price level in the early days was derived in a frictionless environment in which this mechanism would not work. And okay, so this brings us back to the idea that if you do this systematically, then you don't get any benefits out of it. You just get hyperinflation. So then, of course, the exchange rate is I agree with you that it can actually play in the opposite direction. So yes, so here fiscal multipliers are significantly larger under this unfunded specification when essentially the monetary authority is accommodating the fiscal authority. And there are papers, there is a very nice paper by Guido Ascari that focuses on the 60s and 70s versus the post-millennial period. So now if you notice, this is a model in which it's a model with fixed coefficients. But if you, I think you correctly pointed out, if you look at the amount of fiscal inflation, and yes, the blue line is literally fiscal inflation, it varies a lot. In the sense, in the 60s and 70s, it's very volatile in the sense that the unconditional variance is very large. If you were to compute the unconditional variance, you have all this upward trend that we don't see later on. And similarly, at the zero lower bound is more volatile. So ideally, probably what you would want is a model in which the amount of fiscal inflation can change over time. I mean, the risk of fiscal inflation can change over time. And I think this brings me back to the last thing that was the first one you mentioned. The idea that, yes, here it was our first stab at this problem. So we went with, okay, we're going to call this shock funded and this shock unfunded. The natural next step that is something that as Metz and Wouters are working on is, well, maybe when you go for funded and unfunded is related to something else that happens. Maybe when you have, I don't know, a severe supply side shock, you might want to mitigate it and use a little bit fiscal policy. Maybe when you're at the zero bound, you might want to trigger unfunded fiscal shocks and so on. Thank you.
Thank you very much for this excellent presentation and discussion. We're going to have now a break.
Until 11:05, please.
Okay. Thank you. Thanks a lot. That was great. Yeah, yeah. Can you send me the slides?
Chris?
Okay, welcome back. We're going to start with the second paper of this session one. The title of the paper is Monetary Policy, Inflation and Crisis, Evidence from History and Administrative Data. It's a paper by Gabriel Jimenez, Dmitry Kupchinov, José Luis Pedro, and Björn Ritzler. The discussion will be Alejandro Vicondoa from Universidad Católica. Professor José Luis Pedro is professor of finance at Imperial College Business School. He is a member of the Advisory Scientific Committee of the European Systemic Risk Board, an advisor at the Bank of Spain, a consultant at the European Central Bank, and a researcher professor at Deutsche Bank. Bundesbank, I'm sorry. Professor Pedro received his PhD in finance from INSEAD. He is a leader economist on the issues that he's going to talk today, so we are very happy to have him. And the discussion will be, as I mentioned before, Alejandro Vicondoa. Alejandro is an assistant professor at Pontificia Universidad Católica de Chile. He holds a PhD in economics from the European University Institute, and he's also associate editor of Oxford Open Economics. Professor Pedro, the floor is yours. You have 45 minutes for your presentation. Thank you very much again for being here.
No.
December 2005, when the ECB started raising monetary policy rates, this could have potentially led to a banking crisis. In Japan, for instance, the turning point was the Platts agreements in 1985 that led, because of the exchange rate, to compensate the Bank of Japan, lower the monetary policy rates. Potentially that created another credit boom and asset price boom, and then the tightening led to the banking crisis. I have even quotes, famous quotes by Bernanke and other people on the US 1930s crisis, and et cetera, et cetera, et cetera. Okay, so there could be, even in the United States 2007, some people argue, and the Fed argue that, you know, there could be a fear of deflation that motivated the lower interest rates, et cetera, et cetera. Okay. Now, in this paper, we don't want to analyze some selected crises. We want to analyze, in general, for many crises, what is the impact of monetary policy rate dynamics of banking crisis. So what is the full path of monetary policy before a crisis? And whether in an environment like in the last 2 years, whether raising monetary policy rates after a long period of cuts, of monetary cuts, whether that increases banking crisis risk. And not only that, but what are the underlying mechanisms? We're gonna use two types of data. I'm gonna concentrate today mostly in this one, which is a panel of historical crises to establish the results and the mechanisms using 17 countries, including, for instance, just to put an example, United States, Germany, United Kingdom, Spain, Australia, Japan, with more than around 150 years. It covers a bit more than 80 banking crises and hundreds of non-crisis recession, even deep non-crisis recessions. Okay, if time allows me, I will also talk about credit register data for my country, Spain, for the boom and bust after 1995. And we will use a monetary policy rate, which is going to be a shorter interest rate. This shorter interest rate will be the monetary policy rate. And if there was, in some periods, for some countries, no central bank, we will take the shorter interest rate on government debt or the interbank market interest rate. But in general, it will be the monetary policy rate, and this will be either raw or relative to GDP, inflation, and other key macro variables, including lags. We will also use, in every regression, one way to instrument this interest rate through the international finance trilemma that I will talk more later. Okay, so this is the paper. And let me just tell you a bit on the findings, a bit on the contributions, and then I go to the details of the paper. So the findings of the paper, and they are very robust in the sense that we have been doing lots of checks over the last, we presented this paper in November 2022 for the first time at CREI in Pompeu Fabra in Barcelona. So since then, we have been doing a lot of robustness. So it's a very strong, robust result in which the U-shaped monetary policy rates raise the banking crisis risk. The effects, so if you lower rates, you stay low for long, and then you increase rates, then the probability of the banking crisis increases, and I will tell you some numbers. So the numbers will be, it's not a question of statistical significance, it will also be a question of economic significance. These effects will be stronger if these rates are over and above a proxy of the systematic part of monetary policy. Now, something important is that even the worst recessions, which are non-banking crises, non-financial crises, they behave differently. And I will tell you exactly how they behave, but they behave differently. So monetary policy, it doesn't matter this period of lowering rates and staying for a long period down. What matters for non-financial recessions is whether you increase interest rates only, independently of the previous periods. So which tells us that there must be something about financial mechanisms. So if we talk about mechanisms, what we are going to find is that as the monetary policy rates are cut for a long period, then credit and asset prices, there is a boom in credit and asset prices. And then after monetary policy raises, there is a very strong reversal of those credit and asset prices. I will want to tell you a bit more on these mechanisms here. It's going to be much more clear in the presentation and in the details of the paper. But let me just explain you a bit on this mechanism. Now, it's always very difficult to say what is high credit and asset prices. There is a paper by Greenbaum and co-authors, including Andres Leifer, in the Journal of Finance, in which they define red zone booms in a particular way. So we take that definition, so we don't touch we don't, in a sense, data mine and say exactly what is a very high level of credit and asset prices. We take it as given from the literature. And what we find is that after a strong monetary rate cuts for a long period, you enter into this red zone of very high credit and asset prices. Now, this could be because maybe the productivity is much higher. For companies or in the economy. So more a demand channel, or it could be more that the banks want to expand the supply of credit. And so our evidence is going to be consistent with a credit supply channel, including risk-taking. And we're going to compare prices, quantities, ex-ante prices, both credit prices, asset prices, and exposed outcomes. And we will tell you that there is also evidence on mispricing, both on the credit and on the stocks of banks. Okay, so this will be the kind of boom. So monetary policy is important for this credit and asset price boom. Then the next part is that once you are in this red zone and you raise interest rates, this is going to imply a substantial increase in the probability of a banking crisis. And this will be partly driven by problems in the banking sector, but also a strong reversal in credit and asset prices, a very strong reversal. So, as lower monetary policy rates, there is a credit boom and asset price boom. And after, there might be a mean reversion, but if the monetary policy raises the interest rates, and especially raises over and above the systematic part, this will be a much stronger reversal in asset prices and in credit. A result that we think that is interesting, and I will talk more a bit on the next page, is that there is a huge literature that talks that credit and asset prices are important for banking crisis. And what we find is that credit and asset prices are not crucial for a strong crisis risk unless monetary policy follows the U. That is, you need both this monetary policy U and these credit and asset price booms in order to create a strong increase in the probability of a banking crisis. With just red zones of very high credit, is not enough to have a strong increase in the probability of banking crisis. And this goes to the point that the banks are central in these dynamics, and monetary policy is central for banks. We find another potentially interesting mechanism in the data is that this bust in bank performance after this increase in monetary policy rates, after these rates were lower for a long period, the increase is driven by credit risk, by non-performing loans. In the data, it is not driven by interest rate risk in these 150 years, not on deposit withdrawals in this period. Okay, I will go more to these details. But the main mechanism in this part will be credit realization of credit risk. And the final part that we do is we find consistent results both on credit risk and credit supply and risk-taking with credit register data. And this allows some strong identification through loan level data and some fixed effects. And so these are the main findings, and I will go and explain to you throughout the presentation. Before I go to the details of the paper, let me just point to the contribution of the literature. So the first contribution is on monetary policy and financial stability. There has been lots of papers, and I have been contributed on this, that just say that monetary policy rates cuts, they increase credit, risk-taking, asset prices, and that's kind of bad. But then there are other papers on hikes that, they're associated to crisis. So on the one hand, cuts are bad. On the one hand, hikes are bad. And so if you go to banking crisis, on the history, it's very difficult to find like monetary policy matters with these cuts and hikes. And what we show in this paper is that is the full path of monetary policy what matters. And this is just because with the strong cuts follow for a long period, you create these credit booms driven by supply and risk-taking. And then when you raise monetary policy rates, then there is the realization of credit risk and the strong decrease, a strong reversal on credit and asset prices, which creates the banking crisis. And our paper is, in fact, very consistent with models, with two models, and especially one by Boisset et al. On loose monetary policy and subsequent tightening that I can explain more in the Q&A if you want. The second contribution to the literature is also has been a long literature on financial crisis and driven by credit and asset prices booms. So basically, there is a credit and asset price boom. There is a financial crisis. There is, I put some papers here, but there is other papers contributing to this. And what we are finding in the paper, a very robust finding, and you will see the numbers, is not only going to be regressions. I'm going to give you frequency tables. You will see in the frequency tables that, if you have these credit and asset price booms, like let's call it red zones, without the monetary policy, these red zones, they do not imply a strong banking crisis. That is, you need the monetary policy. So the monetary policy kind of is central to the dynamics of monetary policy, is central to banking crisis and to this, potentially excessive credit risk, excessive bank risk taking and credit supplies. And then when you tighten monetary policy, those financial vulnerable red zones, they imply a banking crisis. Okay, and this is the paper. I will talk a bit at the end in the last 2 minutes about potential policy implications that might be consistent with our paper and consistent with the theory which is related to our paper. And now in the rest of the 28 minutes that I have, I would like to talk a bit about the details of the paper. So these are 17 advanced economies over 150 years. How is a banking crisis? There is a narrative definition, with whether there were bank runs, defaults, forced mergers, but also you can bring it in, and we bring it in also bank stock returns, like sharp declines over 30% of bank stock returns. There is also the monetary policy. I already explained to you that we are using in general the central bank, unless that there is no central bank interest rate, in which we use the shorter government debt or the interbank market. Now, I show you here the definition for some, I show you some case studies here for 6 crises. If we take all the crises in our data and we check what is the monetary policy rates before, and even the strongest monetary policy rates, for instance, here, after the Second World War or before the First World War, you see like a U in monetary policy rates. These are monetary policy rates on the y-axis. The line is the banking crisis, the start of the banking crisis. Negative numbers mean years to the crisis. So on the left of the banking crisis, you can see that the monetary policy rates follow a U. You can control, so here, this is without any control, like in the initial figure. If you control for stuff like, I don't know, like country fixed effects and other things, you can find the same U, and this will be even stronger with residual rates, which I will talk later on residual rates. It doesn't go to the residual rates here. But you have also the U if you follow like controlling for some fixed effects. Another way to see this, so previously was completely non-parametric. Let me parameterize a bit the results. So suppose that we put 4 figures, and these 4 figures will be, you have a period of lower rates, and then a period that can go rates up, or a period in which rates go up and then down, or vice versa. And this, so basically you create 4 possible paths of monetary policy, like the U, like more rates over the period, more like the inverse of the U, and the cuts. All these things in column 5, you can see in the unconditional probabilities, all of them have 25%. So in the data, we see that 25% are U's and 25% are, say, the inverse of the U, etc., etc. Despite of this, 100% of all the worst crises, banking crisis before the Second World War, were preceded by the U. Whereas for non-financial recession, even the deep ones, even column 4, which are the deep ones, the worst non-financial recessions, truly speaking, what matters is that the interest rates are raised. It doesn't matter so much whether previously there was a cut or not. And you can see different numbers for different columns, but the bottom line is that this U is very particular for banking crisis, but is not for non-financial recessions, even the worst non-financial recession. This is after, so this is as I've been doing before. So we take the crisis and we look before the crisis. Now let's do the opposite. We take a monetary policy figure. Okay, remember this is 25, 25, 25. And then we look forward, what is the probability of the crisis over the next 3 years? And as you can see, for instance, in this one, is that after the Second World War, 13% of the crises are, 30%, sorry, of the U shape is followed by deep crisis. This can go to 18% over the whole period for all the crises, while the numbers are a bit different, no? If you take these 3, if you take this one, are a bit different for the other. Okay? So it's not only looking before the crisis, but it's looking at the monetary policy and looking forward to the future. For recessions are different, as I said before. For recessions, what matters, sorry, I put too many, but for recessions, as you can see here, for instance, in the first two rows is 4% and 5%. So what matters is the raise. What matters is the raise. It doesn't matter so much the previous stuff, which will tell us something on the mechanisms. And because this is even for the deep non-recessions, it must be something about financial mechanisms. Now, so far I showed you non-parametric figures. I showed you some controls, and I showed you also frequency tables. So let me show you a bit of regressions. Before I show you the regression, which is going to be OLS and IB, let me tell you a potential instrument. This instrument follows this, the Mandel, from his experience in Canada with the United States, in which suppose that, we know that if you have a somewhat open economy for capital and you are pegging the currency, then your monetary policy is not going to be independent. So it will follow the base country, B for base country. We follow this paper by Jourda et al. In the Journal of Monetary Economics, but it's the same idea that I used in a paper with Angela Magaloni for the whole Europe, or in some papers with Jimenez and co-authors in Spain. And this residual of the base country can have not only the GDP and inflation, but can have global, so it can have global GDP, global credit, global inflation, and a base macro of the base country, for instance, inflation, GDP, current accounts, consumption, investment, etc. So it's kind of over and above the fundamentals of the global economy and of the base country. Then we do the following. We try to analyze what is the crisis in over the next 3 periods. We can do 1 year period. We can do lots of different robustness on this. And then we analyze whether if you were cutting the monetary policy for a long period, and then you increase the interest rate, do you get a higher probability of a banking crisis or not? And what we find is that indeed, you get this view of monetary policy, that is, you cut for a long period and then you raise monetary policy rates, and then this increases the probability of a banking crisis. As I said, this is robust across many different themes. I can go over the discussion on these issues. Now, if you do for recessions, this thing here is insignificant. So the U doesn't matter. So this cut for long doesn't matter. What only matters is that you increase interest rates over the previous 3 years. Okay, what matters is that. So it tells you something, as I was saying before, about the mechanisms. And even this is even for the deep non-crisis recessions. Another result that we have is that if so this is 150 years. So one way to do this, one way to analyze whether rates are relatively high or relatively low is over and above macroeconomic dynamics that props in a sense the systematic component of monetary policy. And we can do this for different periods, like the pre-war, Bretton Woods, post-1973. And we can have many different key variables as the ones that I was explaining to you before for the trilemma. So if we take the residual of that, what is very strong is the residual. So if you take for all crises and you have this deeper U of going down for a long period over and above what the macro dynamics tells you, and then you raise monetary policy rates over and above the systematic component, then the probability of a crisis jumps to 28%. The systematic, if you follow the systematic is also high, it's 12%, much higher than the other ones, but is weaker, at least half of this, of the over and above the systematic component. Okay, systematic is also significant economically speaking, but is much stronger the over and above the monetary policy. You can see these in frequency table, or you can see these in a regression. Here are residual, 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 and so you find these in the residuals. Okay. So basically, in this first part of the paper, so still I have 18 minutes, 17 minutes. So what we find so far is that the U shape of monetary policy increases banking risk. Results are robust and especially stronger for effects over and above a proxy of monetary policy, of the systematic part of monetary policy. Results are different from non-crisis recession, even the worst ones, which suggests that financial mechanism might play a role. So in the second part of the paper, we go to this understanding the mechanisms. Now, there is a huge literature that says that low rates could create some financial vulnerabilities. But it's very difficult to say what is high and what is low. So we took this paper to simplify our life, in which they define a red zone in a particular way. They define a red zone whether the credit over the last 3 years in a country has been over and above the 80 percentile, and the asset prices has been on the top tercile. Okay, so they take the top quintile and the top tercile to say this is high credit, this is high asset prices, and if you have both high credit and asset prices, then you have the red zone. And we take it as given this definition. We don't need it, but in a sense, it's a way of not defining ourselves what is too high credit and asset prices. If we take this variable, which is to enter into the red zone over the next period, okay, so this will be the left-hand side variable, and then we have different monetary policies, which could be the change in monetary policy rates, a cut over the residual, or a large residual cut. What we find, let me just put you this one, and this one is that if you cut a lot nominal rates or nominal rates over and above the systematic components, then you enter into this red zone. And this doesn't work if the cut is over 1-2 years. It becomes especially stronger after 3 years. Okay, so you also need the long cut, and we have this in the appendix. Okay, so you go to this red zone, and then you might say, is it supply or is it demand? It's always very difficult with this data. We follow a paper by Millan et al. On putting volumes and prices. And then here, so we have in this panel A, a credit boom, a credit volume boom. So a boom in credit volume. At the same time, you have low spreads. And what we find is that if you soften monetary policy, remember here the signs are different because this is the signs are different in column 1 and 2 and 3 versus 4, because one is the increasing rates and the other is like a dummy, okay? Increasing rates and a dummy. But what you find is that no matter what you look, it's going to be that if you lower monetary policy rates, you are going to get this low spread credit boom, but not the high credit spread boom. Here it goes to the opposite or zero, okay? Which is more consistent with credit supply, because at the same time, you have more credit volume and lower spreads. At the same time, and let me not go to here, I can go later, but the way I have my PDF, it doesn't allow me to go to these links, but these are ex ante, but expose these low credit booms, low spread credit booms, they turned out that they have worse exposed outcomes for banks, like crash of bank stocks and non-performing loans and profits. So both, if you look at this ex ante volume and spreads and exposed outcomes, this is consistent with credit supply. Okay, let me explain another one. It's always a bit more difficult to explain this one, so I started with the quantities and prices ex ante and with exposed defaults. So here, this line here, the line in the red is, so T0 is the enter into the red zone. And enter into the red zone means that on the previous 3 years, you have a credit boom in asset prices and in credit. As you can see in the top left, in the monetary policy, before the red line, monetary policy rates were going down. Then what you see is that the bank stock returns before the red, on the left, before the red zone, that is on the boom that defines the red zone, the bank stock prices were going up, even a bit higher than non-financial returns, even a bit higher than non-financial returns. Even a measure over and above dividends and other variables, a measure of equity sentiment over and above what the bank is given, is also positive, and also a measure of book value of capital. So all of this is consistent. All of this is consistent with credit supply as banks are increasing credit. And banks are increasing credit in such a way is, since the total assets, that is the equity is also going up, is the credit, sorry, is going up in order to keep on the left of capital to assets, which is constant, as you can see in this one, as you can see in the last one, in the bottom right. In order to have that, is you increase credit as the capital, as the book value and the market value of capital goes up. We have here some mispricing evidence that I can go more on the discussion, both on the bank equity sentiment. We find some mispricing as well in this other, sorry, I cannot, in this here table in which we find low spreads and worse future outcomes that I explained you before. Okay, so we have that the lower monetary policy rate period is increasing credit supply, is increasing credit and asset prices. Results in different ways suggest that it's driven by credit supply. There is a risk taking and some kind of mispricing in the sense that ex ante you are taking risk with low spreads and exposed the realizations are bad. Okay, so this was the first part of the mechanisms. Then we have that we are in the red zone. This is what the literature finds, that if you are in the red zone, you get more crisis risk. But what we find, if you are in the red zone and you increase monetary policy rates, is when the moment in which this is much stronger. And especially results, as you can say, from here to here, from column 5 to 6, or column 4 to 6, is especially stronger for residual raises rather than systematic raises. And we also find that this red zone especially gives you more crisis alone and in combination with higher rates if the red zones were coming from lower monetary policy rates that is associated to credit supply booms. So another thing that you can see here is that red zones alone are not strongly associated to credit risk, to crisis risk. So now I prefer these frequency tables. These frequency tables, as before, we have the four different. So we have the four different shapes. So let's take only the U shape of monetary policy versus the rest. Okay, and let's take red zone. Look at, for instance, here. Out of the 33 instances in which we had a red zone and a U shape of monetary policy, 1/3 ended up in a deep financial crisis. Okay, this number could be stronger in just if you don't take the dip, and it's stronger if you take the residual U over and above the proxy for the systematic component together with the red zone. Okay, now let me just tell you, because there has been a huge literature on this. If you have a red zone, for instance here, sorry, no, here, do you see here, out of 71 red zones, only one end up in a crisis if you don't have the U-shaped monetary policy. So basically, this is a very clear table that you need these red zones and U monetary policy rate. And this is telling us the mechanism, because as I was telling you before, with this softening monetary policy for a long period, you are creating this credit supply boom, especially with including risk-taking and some mispricing. And then you raise monetary policy rates, especially residual over and above the systematic part, and is what it causes the crisis. In the final part, in the long-run data, I wanted to tell you another thing is why, if you have these raises of monetary policy, so the final part is to say, if you have these raises of monetary policy, strong raises of monetary policy, why do you get the crisis risk? The first thing is that we saw that before you were creating this red zone with a lot of risk-taking. So one test that we could check is whether you raise monetary policy rates and you are in the red zone, whether you are increasing stronger the reversal of those vulnerabilities, financial vulnerabilities that you built up in the period of lower rates for long. The second thing that I would like to show you is what happens to the banking system. So first, this one. So we analyze the future credit and house and prices, both house prices, equity prices, business credits, household prices. So we analyze if you are in a red zone. This means you are in a red zone, and you say increase the rate. So it might be this coefficient might be potentially negative, beta 1, potentially beta 2 might be negative. But what we want to see is whether there is like an over and above effect on the beta 3. And this is the beta 3. This is showing you the beta 3. I have here on the link all of them, but here on the link. But what you see is that there is a much stronger reversal if you tighten monetary policy rates, especially if after there was a period of a red zone. That is raising rates, for instance, in house prices, when house prices are elevated, the results will be a much stronger reversal on house prices. And the same for credit, equity prices, etc. The last thing I want to tell you on this long-run data is that there is this, what happens to stock prices. of banks, profits, and loan losses. And what we find is that if you raise, if you have the U of monetary policy, what you're going to find is that credit losses are going up. Credit losses are going to go up. This is going to decrease the return on equity. This is going to increase the stock returns. So the profits, column 1 are accounting profits, column 3, 5, and 6 are stock prices. And this is going to increase the crash of a bank equity following the measure by Baron, Werner, and Sean. And I cannot show you here in this moment. I could show you later. So credit risk is fundamental, as we can see in column 3 and 4. But if we go to these other tables here, tables after this ROE decomposition, and market decomposition, and deposits, we will see that results are not consistent with interest rate risk and with deposits outflows after this view of monetary policy. There is 4 minutes left. I don't want let me just skip since this the Spanish case, just to briefly summarize the result and go into the policy conclusions. So basically, what I told you is that there is a U shape of monetary policy rates before a banking crisis. This is for banking crisis, but it's not for non-financial recessions, even the deep ones. Which tells you that it must be a mechanism which must be related to finance. And the mechanism that we find is that you increase credit and asset prices, bank credit and asset prices. You get this red zone of very high credit and asset prices after a period of low for long in monetary policy. This is consistent, our evidence, all the different evidence, looking at asset prices, bank stock prices, non-financial firms asset prices, ex-ante credit boom, in volume, in spreads, and exposed bank outcomes, is consistent with credit supply, including risk-taking and some mispricing. After you are in this red zone, and you increase monetary policy, you will go to increase the crisis risk, and this will be in part driven by a reversal in credit and asset prices, a strong reversal. So our evidence, and I show you very clearly on the frequency table, also in regressions, but also clearly in the frequency tables, is that red zones are not enough. And in monetary policy, U is not enough. You need a combination of the two. So this monetary policy U is giving you this credit supply, risk-taking, to get this credit and asset price boom. And when you are there and you raise monetary policy, you will have a bust in bank performance driven by credit risk, and not, as we have in the appendix, not driven by interest rate risk and depositable withdrawals. In the credit register data I didn't show you, we find consistent results on credit supply, risk-taking, and loan defaults, but with a stronger identification. But it has the issue about external validity, which gives you the other thing. As I said, our big contribution is on monetary policy and financial stability, but also on financial crisis and credit asset prices more. It's not just cuts or heights, is the whole path rate that matters. And it's not just purely these asset credit booms, in others also the monetary policy. And this is because of the mechanisms. It's not only a question of econometrics, which is for sure, but this is also a question of mechanism. In the last 1 minute and 10 seconds, let me just, in the last slide, let me give you potentially implications which might be interesting for the conference and for the Central Bank of Chile. So monetary policy, it matters the path dependent. So one way which is consistent with, for instance, this paper, could be that, like you don't lower monetary policy rates a lot for a long period, because you might create this financial boom. And if you need to raise interest rates, you might raise interest rates before this red zone. But if you are in the red zone and you need to increase rates, increase it based on the systematic part, not over and above. That will be consistent with this paper here of Goldberg and Lopez Salido. And if you are in the red zone and you need higher monetary policy rates, and even stronger over and above the systematic part, you know, there is going to be a component of credit risk. So banking supervision is crucial. Of course, also ex-ante macroprudential policy that we have it here on top. And that's it. Thanks a lot. It has been a great pleasure to present.
Thank you. Thank you very much, Jose Luis, for an excellent presentation. Now we have the discussion. We have 15 minutes.
Can you hear me? Yes. Well, thanks to the organizers for inviting me to discuss this very interesting paper. I think Jose Luis did a very clear presentation, so I will try to focus on my discussion on the contributions of the paper. So, can I move to the... How do I move the slides? Thank you. So just a summary of the paper. So the main question of the paper is, how does monetary policy affect the probability of a banking crisis? I think this is a crucial question and very, very important. The analysis is based on characterizing the monetary policy path before the banking crisis. And then he's using this historical macro-financial data set that has been put by Jordan et al. In other papers as well. And then he uses credit registry for Spain, which is he manages to control better for micro factors, like characteristics of the firm and the bank. But on the other hand, it's like the validity, the external validity, as Jose Luis was explaining before, the external validity is more limited. So as I said before, the paper is based on the macro-financial database. So this covers 17 advanced economies between 1870s to 2020. It's a very rich data set, considering that it spans a long period of time. So it has like data on GDP, credit, investment, interest rates, bank data. So it's very, 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 very rich. Then he combines this macro-financial data set with different definitions of banking crisis. One is the one by Baron, Werner, and Chiong, and then the other one of Jordan and Shurarik. And finally, he uses the credit registry in Spain from 1995 to 2020 to complement and understand better the mechanisms. So there are two main findings in the paper. The first one, and this is probably like the key picture that one can take in the paper, and this fact is very robust to different specifications that he does in the paper, is that basically every time we see a banking crisis, so this is in period 0, before like between 7 years up to 4 years before, we see a decline in rates, in interest rates. And then around 3 years before the crisis, we see an increase in interest rate. And this, according to the evidence that Jose Luis showed us, this is key for understanding the crisis. And in particular, this reduction in the interest rate triggers the red zone. And then the increase in interest rate is the one that pushes the banking crisis. So the mechanism is that this low interest rate pushes you to the red zone, and finally the hike pushes you to increase the probability of a banking crisis. So one can think, okay, maybe this is a pattern that is not only particular of banking crisis, but this is something that happens in usual recessions. And what Jose Luis showed us is that this is particularly important for banking crisis. So once you control for this U-shape, this doesn't have any significant impact on business cycle recession. So this is something more particular of banking crisis. And something that Jose Luis didn't show up, and I will discuss a bit later, is that once we look to other variables, so if we look into the dynamics of inflation or the real interest rate, that probably are the key variables that one will look at, we don't see such significant patterns as we are seeing in the nominal interest rate. The second fact that Jose Luis didn't have time to cover is that loans issued after a period of low interest rates in Spain are more likely to default in the following 3 years, and this probability is also higher if you hike the interest rate. So this is consistent with the macro findings, the historical findings that he was showing in the presentation. So this is a very interesting paper, which tackles a crucial question. I think it's an important contribution towards understanding how monetary policy can affect financial stability. It's a careful implementation. It's very well written. It has several robust analyses, as Jose was explaining, and I enjoy reading it. I think I learned a lot from the paper. And my discussion is based on 3 points. So the first one is the pattern of the real interest rate, which I think is something that Jose Luis didn't have so much time to discuss, that I found a bit difficult to understand in the paper. The second one is more from an open economy perspective. Can we think that these crises are related across countries, and if there is any role for capital flows in this crisis? And finally, I have some questions on the IB strategy that they are taking. So let me focus on the first comment. So if the real interest, so one would think of, if we take like a standard macro book, that what matters for decisions are real interest rate and not nominal ones. This is probably like more like the real interest rate is the appropriate variable to capture how stimulative is a monetary policy, and not the nominal interest rate per se. And there can be different explanations of why low nominal interest rates may move in the economy. As Jose Luis was pointing out, the first one is maybe the central bank just wants to keep the rate low for a long period, and that's a decision that one can think as discretionary decision from the central bank. And another reason why the central bank may be moving the nominal interest rate may be due to, for example, a positive TFP shock. So if we think a positive TFP shock, then this will put lower pressure on inflation, and then maybe the central bank wants to lower the interest rate because inflation is going down. This is consistent with the first part of the shape, and once the TFP shock vanishes, then inflation starts going up again, given to the push of demand, and then the interest rate, the central bank starts putting again back the interest rate. And this will be like some more systematic explanation of the movement in interest rate. These two, so the current results Jose Luis was showing us are a mixture of the two things, even if they, at some point, disentangle between the residual of the interest rate and the systematic part of the interest rate. And what they find, in fact, is that when you look at this, at the first figure that I was showing you, the one on the nominal interest rate, if you look at the real rate, what you will see is something flat. So you don't see any significant pattern in the real interest rate. And this may be due to the fact that they are mixing different reasons of why the interest rate is shifting. So and in particular, this may give us more hints on what is going on, what is happening. That I think is something that maybe the authors want to explore more in detail. So can these two reasons of why the central bank is moving nominal interest rate help us to understand this no pattern on the real interest rate? Are both explanations important? So is it more the systematic, or is it the discretionary explanation that the one that is important for triggering a banking crisis? I think this is key for shaping and giving like the final message of, in particular, the policy implications of the paper. Is it just the central bank leaving the interest rate too low for too long and then rising the rate, or is it something related with more fundamentals of the economy? I think it's something that can be done, like type of using sign restrictions, so you can try to disentangle the movement in the interest rate in different episodes and trying to see if the dynamic, as he was pointing out before, are robust or are just driven by one of these particular events. So my second comment is that, okay, we're focusing here on banking crisis, and there's a huge literature that has studied banking crisis internationally. And what the literature has shown is that sustained surges in capital flows can lead to banking crisis. And this is the paper of Reinhardt and Reinhardt. Is one of the book in particular is one of the papers and the book itself. And then there's a paper by Merosa and Terrones who show basically that credit boosts are synchronized internationally. And in the paper, most of the analysis is done as a closed economy. Basically, they are just considering single economies, and they are just focusing on how the banking crisis occurred. So what I did is basically I just took all the definitions of the crisis. Here I'm following the definition of Barron. And I'm counting in every year how many banking crises in his data set it appears. And what we see is that, different from what you see, in many events, not less than the half, but still many, we still see that there are more than one banking crisis every year. So this is counting the frequency of a banking crisis, so the number of countries that suffer a banking crisis per year. And what we see from here, well, of course, if you look at the recession of 28, you see that there were lots of banking crises around the world. But also if you see in other events, like for example in 1930s, you also see like in 1991, you see that it's not so rare to find many countries suffering a banking crisis at the same time. So the natural question that one can ask is, are there capital flows a significant driver or mechanism? Do they play some role in this banking crisis? Is it something important that has not been considered in the analysis? So what I did for this was just take their data set. I just managed to replicate first the results that they have in the paper for the nominal interest rate, and everything is super clear with the two definitions of the interest rate and everything. And instead of taking the interest rate, what I took is the current account to GDP of the country, and I saw how this variable was reacting in the window around the crisis, around the banking crisis. And what we see from here is that there's no significant pattern in the current account. So we don't see like something, they don't have a measure of capital flows. We can take the current account as a proxy. We don't see something related with the current account going on in the crisis. So it doesn't seem to be something that is finance or that is coming from abroad or some particular type of finance, as one could think as Spain in the previous of 2010, the crisis. It doesn't seem to be some systematic pattern in the current account. A second thing that one may worry, if we look at the previous figure, is that there can be some contagion across countries, and this can play a role in explaining the banking crisis. So what I did for this is to add some global factors and also to control for time fixed effect. And basically, once we control for these global variables, we still find the fact that Jose Luis was pointing out. So again, the result is robust to different controls and different stories that one can think if we consider an international dimension. Finally, as Jose Luis was explaining before, so they use different specifications of the interest rate. They just focus on the changes in the interest rate. They focus on the residuals on the interest rate, and they also focus on instrumenting changes in interest rate. And in particular, they use as an instrument for the change in interest rate, the change in the interest rate in a home country. So they are thinking just of a country that is following the monetary policy of another country. And this is particularly suitable for Bretton Woods, for example, where economies were just following up what the home economy was doing. So the assumption here is that the change in the foreign interest rate is affecting the probability of a banking crisis only through its effect on the nominal, on the domestic interest rate. So the exclusion restriction is telling you that this shift in the home country monetary policy should only affect the probability of a banking crisis through its effect on the interest rate. So this is the implicit assumption that is going on in this analysis. And I think it has two main problems, potential problems at least. The first one is that it can be that the home country is reacting to some global shock. So it can be like oil prices are going up or something is happening, and that's why the home economy is just shifting the monetary policy, and this is affecting both countries at the same time. They are controlling partially from this, controlling for world GDP and other measures, but still there can be some common and observed component that is the moving monetary policy in the two countries. And the second one is that we know from previous works, in particular the works by Ellen Ray, we know that monetary policy in central economies can affect financial conditions worldwide. And in particular, so if monetary policy affects the global financial conditions, it may be affecting banks directly through its effect on the financial markets. And in this case, the validity of the exclusion restriction may be a problem. So it may be hard to argue that this is a valid instrument if in fact it's affecting the probability of a banking crisis through another mechanism. So in particular, the main question that came to my mind is like, are the results robust? So if one can remove these big economies, I'm thinking about the US in particular, which is probably the main monetary policy that affects global financial conditions, are the results robust if one removes this interest rate from the AB? So to sum up, and to be just on time, I think this is a very interesting paper that tackles a crucial question. Again, the main message of the paper, I think, is pretty clear, and Jose Luis made it very clear through the presentation. It's not only a question of interest rate being low, it's not only a question of the interest rate, like it's not only a question of a bubble or some growth in asset prices, it's a combination of both, of the U-shape and the red zone, which trigger and which are important for understanding global financial crisis, banking crisis. This is consistent with the findings that they have for Spain using loan data, credit registry data. And the open question that Jose Luis was talking in the last minute, and probably is one of the most interesting given the audience in particular, is these two things, the U-shaped monetary policy and the red zone, is calling us probably for understanding like a synchronization between monetary policy and macroprudential policy. So which is the optimal monetary policy design that one can think for these two policies in order to counteract the potential banking crisis? So this is.
For a very nice discussion of the paper. We have time for questions from the floor, and then, Jose Luis, you will have time to answer the question and also the discussion. So it's a...
Hi, Jose Luis. This is Mariana. I want to thank you for the presentation, and I want to go further with one of the questions that Alejandro said about contagion. So how do you see your results affected when there's a neighboring country or like a big country already in a banking crisis or going through or getting there, I guess?
Please. Yeah.
Thank you for the analysis and the discussion. So I would like to bounce back on your last point in the discussion. So what's the implication for monetary policy and macroprudential policy? And I was curious if you had tried in your analysis to interact your result with some measure of macroprudential policy. I mean, we saw in the last hiking rate period that we were expecting some disaster that didn't happen. So I would be curious to see if the result change. Thank you.
Okay, José Luis.
Yeah. So first of all, many thanks, Alejandro, for all your comments. They are very well taken, and also for your suggestions. Let me start in reverse order. Let me start with the last thing. So the disaster. So it's true that there was no disaster, and we started this paper. As I said, the first presentation was in November 2022, and in fact, I was presenting this paper in the European Central Bank just 1 week before the Silicon Valley Bank. So, and the Silicon Valley Bank, one could argue that it was a kind of, not a disaster, but it was kind of a crisis, of a banking crisis. So there was important bank failures in the United States, one in Europe, and there, as I was saying before, there were other problems. I mean, not in the paper, but let me just say that if you look at monetary policy reactions, for instance, after what happened in the UK in September 2022 with the increase in rates, in long-term interest rates. So the central bank reacted in a sense more softening. So if you take the surprises, we're going towards softening as compared to the tightening. So in a sense, central banks reacted, I think, to some of the financial distress. This is my impression, but also based on some data, in the sense that as they saw some financial problems in the banking sector, but in the non-banks, for instance, pension funds and in the sovereign, and in the credit real estate markets, central banks reacted to soften a bit the increase in monetary policy, which will be consistent with our implications. Unfortunately, we cannot do the interaction of macroprudential policy and monetary policy. That is something that we would love to do and we wanted to do, but in the historical data, you don't have good measures of prudential policy over time and across countries. So that's the kind of interaction. We cannot do it, but I refer you to a paper which I have with Luke Levin, the Director General of Research at the European Central Bank, and Carlo Altavilla, the Head of Monetary Policy Analysis in the European Central Bank, analyzing the implications of monetary policy and macroprudential policy. In reverse, the question on contagion, I will tackle with some of the points of Alejandro very briefly. On the first one, on real rates, this is a finding that we have in the paper, as Alejandro said, that our real rates are not so strong. But the way we treat it, the way we write it now is to say that real rates, truly speaking, you would like to have expectations of inflation. And we have realized inflation as all the papers in historical data. So it's not well measured, neither inflation, therefore, and neither real rates. And if you take nominal is the sum of the two, so you don't have this problem. And we see some of the problems in the banking sector, like NPLs affected by nominal, but real estate prices affected by real rates. And therefore, a nominal rate is tackling the two. Moreover, our results are much stronger, as you said, with over and above the systematic part, and the systematic part includes the realized inflation. On the productivity issue versus, we agree. So part of the lower rates are because potentially there is positive productivity to the non-financial firms. This brings down inflation. But if that was driving our results, what we should see is that the stock prices of non-financial firms should increase at least equal or even more than bank stocks, and we don't find that in the data. Moreover, we see disappointing ex-post outcomes. So that wouldn't be so consistent. On the second point, as you said, it's wonderful that you replicated all these things, and you said that our results are robust, and the current account and the global factors are not. And as you said, we control for the global factors and the current account. We think the capital flows is important, despite that in your case, you didn't find this part on the current account, but I think it's very important, which links to your third point. I think the exclusion restriction, remember, the exclusion restriction is over and above the stuff that we control for the base country, which is the global GDP, inflation, global credit, even capital flows from the base country. So it's over and above all these things. That's the econometrics, that's the exclusion restriction. And so we find over and above these things, which goes to the question on the contagion. As also as you said, the result is robust to time fixed effects, which will be the question on the contagion. So it's over and above what happens in a particular year. So thanks a lot for all your comments. Thanks, Alejandro, a lot for reading the paper and giving these comments. And thanks a lot for the invitation to this conference. Thank you.
Thanks, Alejandro, for a very nice discussion and presentation. So we move to the next.
So thank you very much. Thank you, Luis Felipe, José Luis, and Alejandro. And we now have our first keynote speaker. And to present him, we welcome Gloria Peña, our Director of the Statistics and Data Division of the Central Bank of Chile.
To introduce Ricardo Reis. He will present from trends in interest rate to inflation and back. Ricardo Reis is the Arthur Williams Phillips Professor of Economics at the London School of Economics. He was elected a Fellow of the British Academy, the Academia de Ciencias de Lisboa, and the Econometric Society. Recent honors include the 2022 Carl Menger Prize, the 2021 Irjo Jansson Medal, the 2017 BDF TSE Junior Prize, and the 2016 Bernasser Prize. Professor Reis is an academic consultant at the Bank of England, the Swiss Bank, the Federal Reserve Bank of Richmond, and the European Stability Mechanism. He directs the Center for Macroeconomics at LSE, and he serves on the council as an advisor of multiple organizations. He has published widely on macroeconomics, including monetary policy, fiscal policy, inflation, and business cycles. His work has appeared in top academic journals, including the American Economic Review, Econometrica, Quarterly Journal of Economics, Review of Economic Studies, and Journal of Monetary Economics. Professor Reis received his PhD from Harvard University and was previously on the faculties at Columbia University and Princeton University. Wow, very remarkable background. Okay, the floor is yours, please.
Well, thank you very much, above all, for the invitation to the organizers. It's really a pleasure to be here with you, and especially to be sharing some thoughts with you on a topic where there are many, many very good papers in this program. And in some ways, it's a keynote where I think by the end of this conference, I will have changed my mind on some of the things from what I expect to learn during the next 2 days. But at the same time, I think a very fortunate thing about this keynote is that looking at my title and at the other keynote's title tomorrow, at TIEF's one, I think there will be I think we're starting from a similar starting point, and I think it will be interesting for the audience to see how we think about it differently and how they will complement each other, as I'm sure they will. So, with that in mind, with that introduction in mind, a crucial question today for a central bank, and this is a central bank conference, is where is the policy interest rate converging to? On the right-hand side there, I have for you, from a very recent speech by an ECB monetary policymaker, I believe Philip Lane just last week, a comparison of the projections for where the deposit rate of the ECB is going to end up, taken at different points over the last few years. Focus on the right intercept of that graph and see how, starting from certainly earlier on until to the more recent period, you have very different projected paths for where the interest rate is going to end up. Notably, as months have gone by, financial markets, which are the ones reflected in these perspectives, but certainly very influenced by speeches and the analysis of central banks, have significantly upgraded where they think that the interest rate, the policy rate is going to be. Likewise, on the graph on the left-hand side, you have the most recent survey of economic projections by the members of the FOMC in the US. And note, again, looking at the right-hand side, at the right limit of the left-hand side. Never mind. There. Oh, I managed. Note how wide the dispersion is today among the policymakers who will be choosing these rates of where they think things are going to be in the long run as a resting point. So a crucial question for monetary policy is, right now, when to stop easing, how many cuts to make in terms of what that resting point will be. This is not just a question for central banks, though. If you think about this terminal rate, this long-run interest rate, this steady-state rate, this resting neutral, many names have been given to it, this is absolutely the crucial question for fiscal policy. If this interest rate turns out to be sustainably at a much larger level than it was before, especially in comparison with the growth rate of the economy, then this will imply that the way in which deficits have been sustained for the last 20 plus years through low interest rates relative to discount rates and or growth rates, what some have called the debt revenue, I have called the debt revenue term, may no longer be persistent. And therefore, the strategy of the last 20 plus years of running persistent primary deficits in most of the G7 countries may no longer be one that is affordable or feasible. Finally, for academic economists, if you want, whether this interest rate and where that terminal point is going to be affects or determines one of the key questions that we study in macroeconomics, which is to what extent does the savings investment balance change in the economy? And that is going to be an input into most macro analysis, whether they are of long-run growth or of short-run trade-offs. Now, if one looks at the literature, this question of what is this terminal rate will often go into the heading of what is R star. And again, I have many of the experts in the literature here in the front two rows, but let me speak to the other rows here. There are at least, if one looks at the empirical measurement literature, 3 R stars. 1 R star is defined, coherently defined as some steady state or some long-run value component of what realized returns are. And if you define it that way, if you think this is what the long-run value is going to be, very natural to use time series models to separate trends from cycles and extract the trends. This is, for instance, the work of Catherine over there and many others who have tried to come up with simpler, more sophisticated time series models, try and back out what the long-run component is. Instead, another branch of work says, no, no, no. The R star is the counterfactual interest rate where we think that investment equals savings. This is now a theoretical concept because you have to define investment and savings in the economy. That is, you need a model of capital markets and investment, and especially a model in which frictions will make the currently observed interest rate not be the one that will clear the market in a frictionless scenario. For that, you need models. You need models of capital markets and investment that can go from simple models like the neoclassical growth model to complicated, sophisticated, involved DSG models with multiple frictions with which to define that counterfactual. A third definition of the R star is that it is, and one that is very common certainly in the language of central banks, is that it's a neutral rate. It's the rate over which if the policy rate is above it, then there will be pressure for inflation to fall, whether if it's below it, there will be pressure for inflation to rise. For that, the natural way to go and measure is to combine time series or economic models of the effects of monetary policy and of the transmission with especially what are expectations and financial conditions indicators. And that has led to an enormous number of measures of financial conditions indicators trying to ascertain precisely if relative to those is interest rate above it or not. To be clear, and what makes these 3 concepts, which as I have presented them here are conceptually very different, is the fact that economic theory says that in principle they are also very connected to each other. If the long run is the frictionless, which will often be the case in many of the models we write, not all, but many, then 1 is equal to 2. If monetary policy only works through frictions, then 2 is equal to 3, which is true in many models, but not in all. And so one ends up with often people defining measure 1 and using strategy 2 to measure measure 1, and so on in all kinds of combinations of the 3, even if conceptually they are very different and call for somewhat different tools. So what am I going to do today? Or no, let me also give you a second conceptual problem before telling you what I have today, which is, what is R star when ultimately if R is the return on an asset, there are many, 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 many assets. Let me index them by I there, where I can, especially from the perspective, especially once you realize that we can build derivative assets, I is really very close to infinity in many ways. Which of these RIs is the R star referring to? There is one tempting strategy that is very common. I myself have followed it many times, but which I've eventually concluded is ultimately flawed or hopeless, which is to say, no, no, no. Every interest rate of any asset is going to be equal to some R star plus a premium. R star is the one for which the premium is 0. So measure the interest rates on all of your 3 billion assets in the economy. The one for which the premium is 0 is the one that identifies the true R star. This is when people say, well, R star is the one that's the safe. It's the liquid one. Since the premium has to be 0, and all premiums are relative to it, it's the safest. It's the liquidest. And then you'll go and try to measure measures of the safe rate in the economy, potentially using mean returns. But if you really, really, really go and follow this logically to its conclusion, the safest and most liquid is, of course, the policy rate. But hold on, we're trying to figure out where the policy rate is going to end up. If our best measure of it is where the policy rate is today, because that is a safe and liquid, we've kind of ended up in a just logical contradiction. That is, we've gone nowhere. Okay? So, what will I do in this talk, having highlighted these problems of many different R's, whether conceptually as well as in a measuring? In some ways, I will complicate it, take one step back to try and make some progress forward, 2 steps forward, by looking at different R's that are not the perspective of these 2 slides. I'm going to use some theory to conceptualize 4 different R stars, but where the 4 different R stars are going to answer different questions that speak to the 3 questions that I started this introduction with. I'm going to give you a conceptual framework based on figures. I'm going to go to an old tradition in economics that's getting lost of using some graphs and diagrams. Yes, there is math behind it, behind the math labs there, but I won't show them to you on purpose. They'll be in the appendix of the published version. But I'll try to define these 4 different markets, 4 different interest rates in a conceptual way using diagrams, and then use that framework to make sense of the past and look into the future. First, let's start with the facts so that I introduce you to my 4 R's, and therefore my 4 R stars. First one that I, a few years ago, spent quite a bit of time measuring, so this is the least interesting of them in some ways, which is let's go and try to measure the return on investment. Ultimately, as a macroeconomist, if you tell me about R star, that's the one that is more natural to me, which is you invest in the capital stock, you get a return on it. Yes, in finance, there'll be all kinds of RIs or combinations of it, but once you close the whole model, there's only really one R, which is what's the return on saving on, if you want, the capital stock, going back, if you want, to the macro neoclassical growth model perspective. Now, measuring the marginal part of capital, therefore I'm going to call this M, is what I would go after. Of course, measuring marginals is very, very hard. So here's a measure instead of the average part of capital, which is quite easy. You really look at the returns paid to capitalists, if you want 1 minus the labor share, and divide by the capital stock. Measure the capital stock, measure capital payments, that is the average return to capital in an economy. Now, there are complications, so much so that 3 years ago I had to write a whole paper on how to measure the capital stock and returns, and you have to kind of be a little careful because there's trends in lots of variables. But here's and then finally you need to subtract some, because that's a nominal return, some measure of expected inflation, which here in this picture I'm just going to use, I'm going to use the Survey of Professional Forecasters' expected inflation looking forward. You look at that, and this is for the US, but I also put there the actual return for this period of 95 to 2019 because inflation was pretty close to expectations. And what you see is that M This measure of R star, the returns on investment, has been pretty flat. If you look much further to the 1930s or to the 1850s for the US and the UK, and now you can only use the actual inflation, the realized ones, not the expected ones, but you can at least put some filters through them. These are, the thick areas are 10-year moving averages using the Mueller-Watson method. Again, relatively flat, or certainly the last 20 years look fairly flat. Other countries in the G7, Chile as well, all of them look fairly flat as it comes to. So I'm going to take as a fact in the last, from 95 to 2019, that M, this particular R star, was reasonably flat. The second one is one that the literature is often very much focused on, and that is the 10-year yield on treasuries minus expected inflation. I'm going to call that Y for yield. Why yield? Because it's what you expect to get by investing in a safe bond. If the previous one is what you expected to get by investing in the capital stock, this is what you expect to get by buying instead of a safe bond. This one, of course, again, I don't need to spend a lot of time on it because this has been measured and plotted in many talks, and this is the one that converges clearly downwards over this 25-year period, whether one looks at the US or in the G7 in a very uniform way over these 25 years. Note that if one looks at trends in output and inflation, as in the Holston, Laubach, Williams, or the Lubick-Mathis attempts at bringing output inflation data to the filter, you end up with a slightly, with a shallower, more modest fall, but still the conclusion that the fall is there once you put a trend into it, ends up being also consistent there. So, M constant, Y falling. Here's a third one though, and I think the third one is the one that Francesco was showing us earlier this morning. Let's not look at the expected returns, but let's look at the holding period returns on a long-term bond. Let's look at the 1-year return on a bond minus the realized inflation. Okay? That's a real interest rate. I think that's what Francesco's calling it. And if you look at that one, over the 2015-2020 period, you get indeed a fall, but note that between 2015 and 2020, it's actually reverted, it actually went up a little bit. This again matches, I think this was also true in Francesco's plots. He used slightly different measures, but relatively similar. So we had a significant fall in realized returns. I'm going to call this rho, often in finance for holding period returns, followed by a little bit of reversal in 2015. That's the third one. Finally, a fourth one, the short-term policy rate. That's the José Luis Pedro one. Let's look at just a 1-year rate or a 3-month rate like a federal funds rate. Now, real nominal, there was already discussion here about what to do with the real. And the hard thing is going to be, well, especially if you look at the short-term policy rate, if it's a 1-week rate, if it's an overnight rate like the federal funds rate, it's real because the daily inflation is 0. So to some extent, it is real and nominal at the same time. It's only when you look at larger holding periods that you want. Here, I just subtracted 2% from it, thinking of, again, it's effectively real, so nominal real, but since all the other three are real, we're essentially fine. And this one, again, falls till 2015, and then reverts afterwards, again, mimicking what we've seen already, okay? Right away, let me do just a brief comparison between the short-term rate and a long-term rate, how the two linked. Just to note, because this will play some role later, that consistent with that, the term premium was increasing throughout, and then it fell post-2015. So, the 4 R stars, M, the expected return on product investment was roughly stable throughout. Rosanna mentioned this as well in her initial speech. And this is the R star that matches a long-run macro model saving investment. Why? The real yield on government bonds, yield, expected return, declined throughout. And this is what matches a finance model of what you think being where you store assets, where you store your wealth. Rho, the realized return on government bonds, mirrored yields until 2015, and then there's a slight reversal in the last 5 years. And this is the R star that captures, and again, Francesco already did the work for me, captures the effect of unexpected inflation. In this case, the unexpected inflation was linked to the unbacked fiscal shocks in the business cycle. And fourth, I, is the policy rate that fell even faster until 2010-15, but then rose even as yields kept falling, and does that change in the term premium? And that's the one that captures the role of monetary policy in inflation. So these are the facts. I showed you some pictures. I hope the facts are uncontroversial, even though maybe putting them together may, especially because all of these are called the real interest rate. And notice that the real interest rate didn't fall or rise. It depends. Which real interest rate do you mean? And again, even already in this conference between the introduction, Francesco and Jose Luis Pedro, and the two discussants, real interest rate has been used to refer to these four different concepts at different times in some ways, and the trends are not exactly the same. So let me be, hopefully not be annoying by being accurate about these four. Let me show you just a couple of other indicators because they'll play a role. Number one, wait, I've been speaking for more than 5 minutes, no? Oh, I lost track. How long have I been speaking for? It says there that I have 40 minutes to go, and that cannot be right. Oh, that's the total amount. That started at 60. Ah, okay. Makes more sense. First, throughout this period, output has been mostly below potential, especially in the 2010-15 period in the US. Second, investment in GDP has been approximately constant, although again between 2010 and 15 depressed, so depressed over a significant period of this time. Third, unproductive savings. If savings go to either the productive capital stock or housing plus government debt, think about them as storage technologies, unproductive assets. Let me look there at government debt over the capital stock, or again, government debt plus housing over the capital stock. You get that it's been, for the most part, increasing throughout this period, although there's a lot of issues with measuring the wealth, the last one. And finally, that external finance, the ratio of non-financial corporate sector interest payments to the non-financial corporate sector income, has been somewhat falling throughout this period. These are going to play a role as I go along. But as I promised, let me give you a framework to think about these four, and especially one that's going to link this to inflation as promised in the title. I'm going to call this an extended IS framework, investment and savings, because that's what ultimately we're about. Let me start with the most familiar of the curves, which is the investment curve. The higher is the capital stock, then the lower is going to be the marginal product of capital. Declining link here. This will shift left when the TFP growth and population growth falls. Or when price of capital goods falls, or when there's less public investment, subtractive investment, or when depreciation rises. And a fairly familiar concept, just the marginal part of capital relation, saying that there's less investment as you associated with just a lower marginal part of capital because of diminishing returns. That's my first relation. Second one. Wait, how did 7? I know, I'm going to stop looking at that because you're playing tricks on me. You keep on changing that. Now you went to the 45, I see. Second, the savings curve. In the new cost of growth model, this would be equal just to the discount rate or the discount factor. However, in any model of incomplete markets, this is going to be an upward sloping relation. The higher the return on savings, the more you're going to want to save. When does this shift right or down? When we have more savings in total, namely because of demographic population aging, or because of an increase in inequality, or because of a fall in TFP. It's also going to shift down, by the way, if we have changes in competition, regulation, and taxes, all of which saying that I want to invest more for any given return. But we're crucially note that this is the savings in productive investment, is in K. It's not total savings that we're talking about here. Because to derive this equation, once we realize that there's both productive and unproductive savings in an economy, you want to go and do a second diagram, which plots on the horizontal axis the productive return, and on the horizontal axis, the unproductive return, what I called earlier the Y, the yield on the government bonds. For that, there's going to be a condition, which is a portfolio allocation or an arbitrage condition, that says that if it was a no arbitrage condition, it would say it has to be the 45-degree line. The return on these two types of investments has to be the same. Otherwise, you'd go for one or the other.
Now, once you had financial frictions, say they lead you to want safe assets, liquid assets, even if they're unproductive, relative to the productive ones, then instead of being the 45-degree line, all of a sudden, that's going to start tilting, and potentially, given a downward demand for safety and liquidity, it's not just going to rotate down, but also become concave, which is roughly what I tried to draw there. That is, that the more tilted that is to the right, it tells you how much more you demand of an M relative to a Y return. Why? Because you really like the unproductive safe assets for their safety, liquidity, the convenience that they give to you. This is, of course, then going to shift further or rotate more if the productive investment are perceived as riskier or less liquid, or, by the way, if there are global imbalances and you have a lot of foreign investors that to invest in the productive capital realize they're very much subject to asymmetric information problems that they don't face when buying, say, a government bond. On the other side, the other equation is the Ramsey-Euler equation. The Ramsey-Euler equation says, as derived first by Frank Ramsey, although usually we derive it now as part of an Euler equation, is that the total return on savings in the economy is going to be equal to the discount rate plus the growth of the economy times the inverse IES. This is the way Ramsey stated it. Nowadays, we tend to write the growth rate is equal to 1 over, one growth equal to the interval substitution times the interest rate, or the return on capital minus rho. Crucially, in the Ramsey equation, what you have is the total return. And the total return of all savings is a weighted average of the return on productive and unproductive investments. So you end up with a natural negative downward sloping relation, because for a fixed growth rate and impatience, you're going to have fixed the total return, and so depending on whether you go more towards the productive or the unproductive, you end up with a downward relation to keep that growth rate constant. This is going to shift as the growth or demography changes. It's going to shift up. If the economy is growing faster, you have higher returns on both. And it's also going to shift if there's an increase in financial frictions insofar as they lead to an M being preferred to the Y. But the important one is certainly the growth and the demography that shifted. This equilibrium relation is going to tell us how does the gap between M and R, as well as the total level of M and R, both through the total amount of savings, as well as through the arbitrage, the portfolio condition between the two. In fact, the savings condition I had earlier is nothing but the combination of these two. You derive savings condition from this. Usually we ignore the unproductive investment. You get the 45-degree line. And so the savings on the right plot is the Ramsey-Euler condition. And that's simply because with a higher increase in capital, you're going to end up with, and the no arbitrage is another form of incomplete markets, that's going to lead to the upward sloping line. So I now have a model for M and Y as a function of capital and subject to demographics, global interest rates, and others. I've improved a little bit over, I think, what some of you certainly are familiar with. But I also want to go to inflation. I want to talk about rho, like Francesco did. I want to talk about output. So let me introduce two more. First, let me think about the realized returns and output. Think about an economy having a given productive capacity, given the capital, the investment that I derived just a couple of slides ago. That potential output is going to shift. For instance, it's going to be lower when there's lower productivity, when there's higher markups, or, when there's higher markups, let me skip that third point, or when capital payments are higher, meaning given a K, we're going to have a certain amount of potential output. The lower is that K, which of course comes out with an M, then the lower is going to be that potential output in the economy. But say also that aside from capital investment, we have variable inputs. Labor going to be the most obvious relevant one, since the other one was capital. To employ labor, the variable input, there's going to be, given a return, those who supply the variable input, the workers with their wage, they have a certain expectation of the return that they want from supplying the other inputs, namely their labor. They're going to contract based on that expected return, on that expected compensation, on that expected remuneration. Let me call that expectation the norm that I have for the remuneration. Well, when inflation is lower than the norm, and if people supply and contract based on that norm, what you have is that a too low inflation and inflation below the norm means that the realized returns are high, but it also means that for the firms hiring this variable input, they're going to, because they're paying them above really what their real remuneration is, it means that output is going to be below potential. In case I lost some of you, this is downward nominal wage rigidity. If you end up with too low inflation, real wages are too high, you employ too little labor, the variable input falls. And that is the upward sloping AS relation here, dating back all the way to Milton Friedman and his misperceptions wage theories of nominal rigidities. On the other side, there is a policy target trade-off. Monetary and fiscal policy trade off how much inflation versus output they want, given targets for both. And again, high inflation is nothing but low realized returns. So this is a trade-off between realized returns being offered as well as the output that's being offered, that's being achieved, I'm sorry, okay? This is the conventional targeting rule for optimal policy, the one you derive from a quadratic where you're trading off inflation versus output. This shows up as an upward sloping line, and in an ideal world where target inflation equals the inflation norm set by people in contracts, and target output equals potential output, then the intersection there will be exactly at the kink, will deliver price stability and full employment. Note that if you underestimate potential, or overestimate what the inflation norm is, then what will happen is that your PT curve is going to be below. The intersection will be on the vertical side. We'll end up with an economy that's a potential, but which delivers too high inflation. And this is the inflation bias type result. Fourth and finally, for my fourth, the policy rate. Let me start with the easier standard relation. Let me draw for you the combination of a Phillips curve and an IS curve, because I want to do it in policy space versus inflation as opposed to output. That's just a downward sloping relation, because a lower policy interest rate means higher demand, which pushes inflation above the expected value by price setting firms. All good so far. Note, though, that in linking the policy rate to the realized returns, or to the R or to the rho, those were long-term expected rates, where these are short-term. So I need to take into account the fact that there's now a term premium there. The Y from before, that was the Vixelian rate, if you want, in the context of this work. Oops. Then, also easy, there's a Taylor rule. The higher is inflation, the higher is the interest rate. Unless you're in the horizontal segment and you are the zero lower bound. When target inflation by the central bank equals expected inflation, equals actual inflation, that is when the Taylor rule and the Phillips curve intersect at that exact point that delivers inflation and expectation, output and potential, and the long-term rate is equal to the policy rate is equal to the long-term real rate times inflation divided by the term premium. So I started with a framework to think about at least two R stars, M and Y, and I've now included to have two more R stars, the ones that are linked to output and inflation. Let me use, altogether, I have the four of them. Note driven by exogenous forces, the ones that have been typical in the R-star literature: growth, demographics, productivity, competition, inequality, global imbalance, price of investment goods. I forgot their depreciation. Those all, I, maybe a little too fast, shifted the plots on the first two. But also, perceptions in the taste for safety and liquidity had an impact on the portfolio arbitrage Ramsey-Euler that is on the spread. Perceptions on the norms on compensations had an impact on the AS curve there, and therefore the economy, whether the economy is in underemployment or not. And perceptions of term premium expected inflation determined the extent to which the central bank was able to deliver an inflation on target. Moreover, policy targets, namely estimates of potential output, inflation targets, hawkishness of the central bank, determined what the ultimate inflation turned out to be. And finally, because I'm a macroeconomist and I love general equilibrium, even though I presented it from the top left to the bottom right, note that of course the inflation you end up with is the one that's going to determine the realized returns on the bottom left. If you end up with underemployment, that's going to reduce the effective remuneration to capital, so that's going to shift the Ramsey-Euler equation, which is going to shift the savings and the investment curves as well. So you can also go in the other direction from inflation if you want, more towards the amount of real activity. So that's my framework. Let me use it to account for the trends of 15 years that I documented. First, and let me use here the summary by the work of Lucas Rachel, a fall in the relative price of capital over these 25 years, yes. Lower economic and population growth rate, yes. A decline in public investment, yes, that's the future of those 25 years. And I would add higher depreciation as we move from tangible to intangible capital. Has been almost an increase of 50% on the depreciation rate in the US economy, according to the BA estimates. And higher markups, as in the work of Yen Ackhout and others, all imply that the investment curve has shifted to the left, and thus explaining some of the contraction, if you want, in investment. At the same time, M didn't change very much, which could be true if the savings curve is very flat, turns out to be the case in the calibration I make a particular model, or if it shifted slightly to the left. Why could it have shifted to the left? For that, we need to go to the next picture. Again, let me start with the factors documented in the literature on our star so far. If we have aging of the population, there is a shift left of the Ramsey-Euler equation. The total growth rate of the economy, once discounted for population, falls. Aging means that people are wanting to save more for retirement. Productivity and population growth shift the RE to the left. Rising inequality, as in Atif's work, means a shifting of the RE to the left. Maybe also some of the portfolio balance to the left, insofar as inequality means that the rich are more willing to invest in the productive assets. They're more risk tolerant than, say, the poor. And finally, the global imbalances. What that means is that, again, we have a lot of Southeast Asians wanting to save on account of the current account imbalances, but they see that investing in the productive capital stock of the US is a very risky proposition for them. Why? They're not American. They may be expropriated. They can't distinguish good projects. They have a particular preference for safe, liquid, i.e. treasuries. That is, again, a shift of the RE to the left. All of these will lead to M falling as much or more than Y. But that global imbalance story also means that PB shifts to the right because it's an increase in the saving desire. The global financial crisis means that an increase in effective risk aversion and financial regulation again lead to a big increase in the desire for safety. And there's also an increase in the supply of these storage and productive assets as government bonds increase quite dramatically during this period. At the same time, but let me skip, I'll leave that to the discussion, there's some reasons to expect that the Ramsey-Euler equation didn't shift quite as much. All combined, we have that this big shift in the PB, the blue curve to the right, explains why is it that we had a big, strong fall in Y, the yield, with M not changing very much, and therefore explaining why the spread increased so much. Then let's go to the policy challenge of a low Y, low yield, sorry, I shouldn't have written R there. What happens when Y falls? Well, on the one hand, the less investment means less productive capacity, higher markets, higher depreciation, they all mean that the AS shifts to the left. The potential output has fallen. As or more important, though, is that when Y falls, the kink here becomes significantly lower, which means that unchanged policy will lead to underemployment. This is 2015, not realizing, if you are not adjusting so much for the interest rate result, for the fact that the interest rates had fallen, safe rates, if you want, would have fallen, policymakers will have been, and not responding enough, partly by misestimate, but more likely because of zero lower bound and austerity, will end up with an economy that has insufficient aggregate demand, that has insufficient employment as a result. Eventually, though, either because of persistently low returns, lower inflation norms, note here also the loss of union power, the Chinese deflation forces when it comes to globalization, mean that ultimately the PT curve is going to end up shifting to the right. On top of it, we had fiscal policy pushing up aggregate demand and monetary policy pushing for higher inflation. And this would account for why Roe realized returns increased in 2015-20 as the policymaker is able to push inflation up, exit the ZLB or the liquidity trap if you want. Finally here, to complete it precisely, with a lower yield, what you had is that there was a shift down of the PC curve in my notation. You now have intersection with the Taylor rule at 0. you're supplying insufficient stimulus. That's what leads to inflation being below expected inflation, which is, of course, what led to the low realized returns, that is the PT curve to the left before. So the lack of the PT curve shift is as much a mistake as it is simply because policy was constrained. What happens after 2015? Unconventional monetary policy is nothing but lowering term premium, and lowering term premium is a way to shift the red line back up, and in doing so to escape the ZLB. That's what QE tends to do, and therefore getting us out of there, back to inflation expected, and the PT curve back. So I get to the end of this with, I think, a framework based on other people's work, certainly, that I think it makes sense of the trends in my four different R stars. So with that framework, and with 7 minutes left, it's 6, but I'm going to pretend it's 7, let me use that framework to think about the future. First of all, what is the data since 2021? If you look at the Y has been increasing since 2021. Rho has been falling. That's the fiscal inflation Francesco showed you. Rho has been falling because inflation, realized inflation, has been well above yields. But Y has been increasing a lot because long-term expected inflation has been pretty flat at 2%, and we've had a big increase in the 10-year interest rates. What's happened to M? M is trickier because you need good measure of the capital stock, which often come with a delay. But here is the measures for the US of 21, 22, and 23 at the annual level, relative to the Y here. M, in the same way as Y has increased, M has actually fallen a little bit. That is, the gap between M and Y has fallen quite significantly, at least over these last 3 years. That's what the data shows for now. I'm going to take as given that these will persist. I don't really know, but you know, I tricked you. I said I was going to talk about the future. It's really the recent past. I'm an adaptive expectations guy. Y increase higher, M minus Y smaller. Can I make sense of this and extrapolate going forward? Why would you have Y rising and a slight fall in M? Well, I go back to my determinants before. What I need for that is really a big shift right in the PB curve. That is, I want investors, savers, to move not like government bonds so much and start liking productive investment a lot more than they did before. Well, if I go back to why the PB, in some ways this would be the PB curve shifting back to normal, to the pre-95. Well, why did it shift so much to the left before? Let me do the exact same factors in reverse. Government bonds are no longer perceived as being all that safe, remember Liz Truss events, or all that liquid. Remember the inflation risk that you suffer. Again, the Liz Truss UK event that Jose Luis talked about. Global imbalances have in partly started reverting, namely as the appetite for treasuries from Southeast Asia has declined quite significantly. Again, it's not that the global imbalance in terms of current accounts, it's in terms of whether you have a strong taste for treasuries as opposed to other forms of investment. And this I revert back partly to Francesco's talk, with the elections and the fiscal monetary mix going forward, again, the safety of these bonds is severely into question. Let me skip the RE, I could discuss whether shifts or not. But with a big shift back of PB, I can get that gap falling. Moreover, this will imply a shift right of the savings curve, leading to a fall in the M. And we could even argue that maybe there's been a shift right in investment as a result of optimism about AI and the rise in public investment. For now, these are small, but you can certainly see them picking up and leading to an increase in investment and a gradual drive down that's further of M. Now let's talk about inflation and go back to inflation. With a persistently higher Y, then the vertical kink has moved up. So if you want, the AS curve has shifted vertically without much of a big change in potential output, at least for now. It may shift to the right with AI, let's see, but for now it shifts upwards. Imagine that policy is happy with higher inflation. Let me pursue that. Let me pursue a scenario, and then I'll give you an opposite scenario. But for now, let me pursue a scenario. If you want, call it the Bianchi scenario, because it matches a little bit what Francesco was talking about at the beginning today. Say policy says, let's have some higher inflation. We want to avoid underemployment. We're really worried that if we're stuck with if we try to shift the PT up, we're going to end up overdoing it and will lead to underemployment. So let's stick with the lower PT, the old PT. Moreover, there's some pressure to inflate the debt or to deliver low returns. Let's deliver the low returns here. Instead of giving usual returns, here's the low return. It's Francesco point. Pressure to deliver low returns. Also pressure not to shift because we may shift too much. And finally, think about other temporary supply shocks as meaning that tariffs, immigration, reshoring, all of which will shocks to push up inflation, to push the road down. PT stays in the same place, we deliver low returns. Eventually, norms adjust to higher inflation. Paul's returns inflation target, that was my question for Francesco earlier, the PT ends up shifting left as the expectations catch up. Unless you do some repression, the returns, the row have to catch up to the Y, to the natural, to the Wixelian rate. How does the central bank do this? One scenario is, effectively, we're having a higher inflation target, we allow higher inflation by, that means setting interest rates too low, the I has to be low for that, and then eventually inflation expectations will adjust and policy will settle for a persistently higher interest rate. That is, combining all the scenario, this is a scenario in which moving forward, we will have, let me go backwards from inflation now to the other one, as I promised in the title. Policymakers allow inflation to be high, resources are fully used, and what happens to the R stars? M is lower as investment picks up, we see a trend down in M. Y is significantly higher, and once you add inflation, since this is real, much higher, so the 10-year treasury stabilizes at 4.5, 5%. Rho, again, this is the Francesco paper, is low for a while you're inflating the debt, and eventually, of course, it has to go back to the Y, goes back to normal, and whether that is very long or very short was the discussion we had. I, the policy rate, at first is too low, that's why you generate inflation. You cut too much, you ease too much now, but eventually you realize that as you generate inflation, you end up by the Fisherian principle at a high policy rate later on. So that's one scenario. Consistent at least with how we start the day today. Not one that central bankers, I think, will be very happy with, because it involves essentially defaulting on the inflation target. But let me give you another scenario in my 0 seconds left. What if instead policy, the central bankers, understand that Y is now higher, the 10-year treasury is higher. They therefore do not overcut now, they keep policy rates high, they disappoint markets, they only do 2 or 3 more cuts, and therefore bring inflation to target instead of tolerating inflation at 3, 4% and the low returns. Along the way, they face challenges, absolutely, because as investments picking up and potential is rising, they risk creating a little bit of temporary underemployment and being accused of that, and rightly so. Maybe even some temporary undershoot of inflation relative to target. Maybe inflation even goes down 1.5 instead of, say, a 2% target. Those are the challenges along the way of pursuing that path. But what does that imply, though? Imagine, though, that, very plausibly, that the term premium rises. Because remember, this is a path in which I is converging to back to a low level of inflation, but Y is forever higher. At the same time, central banks are unwinding QE, pushing up term premium, and as, or perhaps the most importantly, is a combination of having been burned by the inflation, the low returns, and seeing financial repression coming, means that inflation risk premium, and generally risk premium for government bonds, becomes much higher. The term premium rises. Well, when the term premium rises, when the term premium rises, you end up risking that this shift, the red line shifts left, and you end up back in the liquidity trap. That is, in terms of the PT diagram, you end up with the PT shifting persistently up. The liquidity trap, that's not only a liquidity trap, but with a higher Y and a liquidity trap, you don't just have the ZLB in the modern literature, but you also have the secular stagnation Alvin Hansen resulted before. Why can't we fix this? Well, monetary policy is at the ZLB. Aha, but what about fiscal policy, the thing that partly got us out of it? But this is a scenario when the short-term rate is stuck at the ZLB, but the long-term rate is much higher. Remember, the Y is much higher. You therefore have a lot less fiscal space. You find yourself not wanting to do the fiscal stimulus. I think someone mentioned Woodford saying you have to use fiscal, but in a world in which the Y is very high, you don't have, you're afraid of sovereign default if you want, okay? In that case, we may end up in a double trap. There is no fiscal space and no monetary space. As the yield curve steepens a lot, central banks find themselves in the zero lower bound, while at the same time, fiscal authorities find themselves in Alvin Hansen stagnation trap. let me conclude. Where's R star going? Forecasting is very hard. I don't know. So which of the two alternatives is true? I don't know. I generally don't know, nor do I want to pretend that I know. At the same time, I think when forecasting is hard, it's also irresponsible or foolish to ignore the question. This is the crucial question for monetary and fiscal policy over the next 3 to 5 years. Which of these two scenarios is going to be there? Now, of course, sorry, I should have said there's a third scenario where the two balance each other out, and it's beautiful. We end up with inflation, and we pay for the debt, and we just settle into a new equilibrium. I should have said that. I'm an economist, so everything is always gloomy. That's why people don't like economists. Okay? But these are two bad scenarios, if you want. What I try to give in this talk is by distinguishing between 4 R stars, or 4 real interest rates, I proposed a framework to make sense of them. I calibrated it to the past data, and with it, I used it to look at the future. A scenario where I took as plausible forecast that Y is going to rise, long-term treasuries end up at a higher rate, while at the same time, M falls some. And I thought that the factors that would contribute to that all made sense for me that they would persist. In that scenario, there were 2 scenarios for the rho and the I via the pi, the realized returns, the policy rates, and the inflation. One, we end up with persistent high inflation, low and then high policy rates, and low and then normal returns. Again, I think call it the Francesco scenario roughly, because I think it matches, it matches a little bit the scenario. Another scenario, we end up instead with persistent low inflation and stagnation with underemployment, where the ZLB comes back with a vengeance. It's a ZLB with stagnation. And then we have high returns instead on the fiscal debt. Again, which one of these it is, I don't know, but I hope if nothing else, thinking through the factors and what affects them will provide some guidance. Thank you.
Thank you, Ricardo, for the proposal you made us, your framework, your scenarios, very, very relevant and also very comprehensive presentation and very inspiring too. Thank you very much. Now we have some time for a few questions. Please, go ahead.
Thank you very much for the presentation. I mean, it was very welcome. I like it a lot, especially the point that the questions should not be ignored. But I had one question that I didn't understand. It's just clarifying. In the last scenario with the high returns but the secular stagnation, why is not possible to engage in QE in order to reduce the term premium?
So, in principle, you want to look. So, in that scenario, Yes. Yes, in principle, you would want to lower the term premium. The question is, can you lower the term premium? What we learned, I think, over the last 20 years of QE is that it takes not thousands, not millions, but billions to lower the term premium by a few tens of basis points. I was thinking about the scenario where that term premium is increased by a lot more than you can do with a few billion purchases on account of the inflation risk premium increases that come associated with the higher riskiness of holding the debt, not to mention the increase in liquidity premium consistent with my YRM NSM. So in principle, you could do QE. At some point also, Gallo, given the size of the balance sheets that are now, if you now say we need to triple the size of the balance sheet of the central bank in order to now recover the term premium and keep on keeping it low, one might think, although as you know well, research on this is still very much open, that there are diminishing returns to QE, that our ability to shrink term premium with buying more and more would be extremely limited. So I thought that that would be unlikely that we would have either the firepower, space, or even the effectiveness to be able to do it with QE in the face of that trap, unlike what happened a few years ago when the change was potentially much smaller. Yeah.
Thanks, Ricardo. Very illuminating as always. I have two questions. The first actually is follow-up, very much related to the earlier, I think. There appears to be an inconsistency in saying you're stuck at the zero lower bound and you don't have fiscal space. And I'm trying to understand that. I think it's because, I mean, the government could try to shorten the maturity of its debt all the way down to, but then the interest rate is not zero. That effectively means the lower bound is not zero. Perhaps you have some effective lower bound in mind. So I think that's but then it's no longer a steep. So there seems to be an internal consistency question there. My other question is more empirical, which is about M that you started off with. If I understood how you're calculating it, you're dividing it by the book value of the capital stock. And the question is, why should we not divide it by the market value of capital? So, so earning over price, like if I were to use a finance term, why should I not use earning over price as opposed to earning over the book value? So you can obviously imagine that that can look different. It also has a lot of risk in it and so on. So just like, just the measurement question on M. Thank you.
So, on the first question, I think if this doomsday scenario happens, I think this is exactly the question you pose is going to be the #1 question for researchers like you and me. So in terms of the consistency of what I spoke was I saw the government borrowing at Y, whereas the central bank setting a policy rate at I. There was a gap between Y and I, which is essentially the term premium plus an inflation. And given that gap is how you could have a zero lower bound in one while having the low fiscal space in the other. As you say, starting from that point, well, why can't the government in some way try to engage in, I might even call it unconventional fiscal policy, if the central bank can't, in answer to the first question, to try and itself borrow at I and gain the fiscal space that way? I think that's a fantastic question. If we end up in this scenario, you and I will, and many people in this room will be trying to write those papers and understanding to what extent can you do that? Is there a free lunch there? Is it not? It's harder, I think. I cannot answer that question. One really needs to write the theory of, essentially, one needs to write a theory of what that term premium is, which admittedly here was just a variable that I moved, which I think was very useful here to understand that. But to go further and think about conventional fiscal policy, you really need to start thinking about whether the government's issuance of maturity choice in some way affects the perception of risk of the government debt and in some way shifts the other one. But that will be the paper that I think you and I will be writing if that happens. So as of now, there's no inconsistency with what I wrote, but also I can't really answer that question, or I need smart people here to write those papers for me to be able to think it through. On the measurement question, I mean, let me start with, the measurement came from NEPA accounts. So the capital stock is built with a perpetual inventory method. The M is built using the returns to investment. You want to follow? Yeah.
That's what I'm saying. NEPA is not.
Yes, exactly. So that was the K, and that is the other one. So now, of course, in that assumption, if you want, there's a Q equals 1, a standard Tobin's Q, as in the neoclassical growth model. And so what happens if the Q is moved, and so the market value of capital? I'm just translating your question from a macro perspective as opposed to book market, it's more finance. True, what's happened to Tobin's Q and how much has it changed? That's a hard calculation to make, just in terms of, because I really want to focus on the aggregate capital stock. The challenge that I thought was true when I was doing this measurement a couple of years ago was that in trying to do the market value, you can go and try to look at different accounts of asset market value, but those are going to be hard because you never have an overall capital stock in the economy, and there's a big change in the risk premium in some ways. So one way, whereas measuring the Q at the macro level, I found different people in the literature estimating that Q has been flat, in which case the way that I'm doing it is completely correct. And some people arguing that it has fallen, which way, yes, or it has increased somewhat, which would mean that there will be a large fall. What I tried to do was put some bounds, and I never got the M to fall as much as the R. So in my old paper, which has been under revision for a while, I think the M minus R gap has increased. Whether the M has fallen or stayed the same, as I said here, I think is much more arguable, and I think that it's pretty robust that the gap M minus R has increased. Whether M is flat or fallen a little bit hard to say for some reason to say. And I could speak a lot more about this, but other attempts at measuring the return, you look at one that I like from recent work by Kilian Uber and others, is to look at the expected return on investment of firms. That again matches very well what M is in the allocation, and that has been extremely flat, as Kilian shows, over the last 25 years. So that's consistent with this. But on the other hand, if you look at return on corporate bonds, then it depends a little bit on whether you look at, I don't want to look at AAA because those will be closer to the safe ones, but if you look at
triple B or AAB, then it seems like it's fallen a little bit. So it goes back to your Q question. So to conclude, and sorry for the longish answer, as M stayed stable, I think it's defensible. You can't reject that null, but probably also it's fallen a little bit. The much more robust fact, and maybe the way I should have said it, is M minus R has gone up. That is very hard to revert. I mean, every time that I've tried to measure, put any bounds, M minus R does fall, even as R was falling. So M doesn't fall as much as R. I find very hard to get M to fall, or at least I've never managed, but again, I'm happy to, again, it's a measurement question. I'm happy to have people tell me that there's one measure, but I've done this in like 20 ways, and M minus R always goes up. Whether M stays constant or falls, issues like the one you raised. I'm sorry if I was too exhausted, but yeah, but that's roughly my sense of it.
I think we have time for one last question.
So this was a great keynote speech. You already brought a lot to the table. So I'm going to push you to see if you want to bring one more element here. So you mentioned a little bit the role of growth, I mean, when you were talking about potential output and so on. So now, recently there's been a little literature that tries to close the gap between business cycle fluctuations and long-term growth. Gianluca actually has contributed to these, and I have an older paper on these. And I mean, and all the analysis, including myself, is always done with this clear separation between trend growth and the business cycle fluctuation. So all of this is to say, so what is your take about the possibility that if we are able to escape the ZLB and possibly to restart the engine of growth, perhaps maybe these doom scenarios might self-correct themselves in the sense maybe the US will grow out of high debt. It's a bit more delicate when you look at other countries, but.
Well, I see it more again on the gloomy side, which is that if we are stuck in this double trap that I was talking about, the stagnation and ZLB, then the problem is that potential output starts being negatively affected. And I think that fits very well into Benigno-Fornaro type models. You'll have the shift, and then, yes, eventually you end up with no underemployment, but that's because you have much lower output. And so you exit the trap, but in a much worse scenario. And I won't make here an assessment of that literature, but I find many of its points quite persuasive and interesting. I'm not quite ready to abandon the long-run vertical Phillips curve for a bunch of false reasons, but I think that argument is very plausible. I think those arguments, what they say is between the two scenarios, let's err on the side of a little bit too high inflation towards my scenario A, I guess I call it the Francesco scenario, that may be, if you put a lot of weight on that asymmetry, you're better off that way. Insofar as, again, my interpretation of the slumps literature and the long-run Phillips curve is consistent with what I wrote there, which is below potential, you can push potential lower if you're stuck there too long, but actually overheating the economy above ends up being that vertical line, that it ends up being this very convex. I made it kink and vertical, that is running an economy hot in itself is not going to push higher growth. What you really want to be worried is running an economy too cold. In that case, err on the side of being a little hot. That would be what my framework, I see, would say. Even if you end up with a little bit of overinflation, better off that way than risk the other one. That's the way I would phrase it.
Well, I think we are on time. I would like to thank Ricardo and all of you for the question and for your participation. And now I invite you to the breakfast, the lunch, and I will ask for an applause to our keynote speaker.
Okay, thank you. So we will have lunch now in the next room, and then we're going to resume in 1 hour for the second session of the day. So hello, please. Could you all take a seat? We're going to continue with the conference.
¿Nos sentamos?
Okay. Okay, we will continue with our second session, titled Theories of Natural Interest Rates. The chair of this session will be Alberto Naudon, board member of the Central Bank of Chile. So we invite Alberto, and as well as the author and discussant of the first paper, Gianluca Benigno and Alonso Villacorta, to come to the stage.
Hello, everybody, and welcome back to the seminar. I have the pleasure to be the chair of this session number 2 about theories of natural interest rates. We have 2 wonderful papers. The first one, the financial instability of real interest rates by Gianluca Benigno. Thank you very much. Gianluca is a professor of economics at the University of Lausanne. He has been head of the International Studies Department at the Federal Reserve Bank of New York and senior professor at the London School of Economics. He holds a PhD in economics from the University of California, Berkeley. His work has appeared in top academic journals, including the American Economic Review, Review of Economic Studies, Journal of International Economics, and the Journal of Monetary Economics. He had visiting scholar positions at the Banque de France, Inter-American Development Bank, and the IMF. Thank you very much, Gianluca, for being here. The discussant, I will present him immediately, will be Alonso Villacorta. Alonso Villacorta is an assistant professor at the University of California, Santa Cruz. He gained his PhD at Stanford University. He has published in the Journal of Financial Economics, the Review of Financial Studies, and the Journal of Economic Theory. Gianluca, you have 45 minutes for your presentation, and then we will have a... no, sorry. You have 45, yeah, and then 15 minutes for discussion.
Okay, thanks a lot for the invitation. It's a pleasure to be here back in Santiago and in this always very interesting and stimulating conference. This is a joint work with my former colleagues at the New York Fed, Oscar Kinchi and Marco Del Negro, and a colleague at the board, Albert Keralto. And I want to stress, of course, that the views and what I'm going to say, especially, does not reflect the views or the opinion of the Federal Reserve Bank of New York or the Federal Reserve System. And what do we do in this paper is we talk and we want to introduce a new concept that we believe is relevant for monetary policy purposes. And the concept that we are going to introduce and we are going to talk about and discuss is the concept of the financial stability real interest rate. We call these interest rate R double star to make it clear that is different from what we have mainly discussed, I think, in the morning in different ways as R star. So why do we need another star? This is the first question. I'm going to start asking 2 questions. The first one is, why do we need another star? And we are all familiar, and we spoke a lot about the natural rate of interest. And what is important when we think about the natural rate of interest is that we think about a concept that is associated with macroeconomic stability. And we think about that concept as something that is or goes jointly with price stability and the closure of output gap. So there's an extensive literature on that, and we cite here just a few key contributors. What we do in the paper is that we want to talk about another real interest rate, which is associated with a different policy issue, which is financial stability. And for this reason, we talk about R double star, the financial instability real interest rate. And the idea is that there is a real interest rate out there in the economy beyond which there might be a region of financial stress. And our way of thinking is to try to understand what is this threshold, how to think about this threshold, and how to conceptualize this threshold. So why do we do that? One basic point that we do in the paper is that, of course, when you think about the financial sphere of the economy, there are a lot of complexity there. And also there is a lot of monitoring that is done by regulators. But from a monetary policy perspective, the idea of R double star is to try to map the vulnerabilities that we might identify in different pockets of the financial system into a space, which is the interest rate space, that is the one upon which monetary policy operates. Okay? So that's the idea of R double star. And the way we thought about it is to think about this concept as a concept that is complement to R star. And I'm going to discuss also the links a bit between the two. But the second question that I have is actually coming from a presentation, a very nice presentation that a Bloomberg journalist, Valerie Tyler, did when we first came out with the paper. And basically she said in her presentation, it's R double star, not R star we should worry about. And the second question I want to address here is the question, which is why we should worry actually more about R double star than R star. And I've been thinking more about this dimension of the problem, and I'll try to convey now my thinking about this. So why that is maybe more interesting in some ways to think about R double star than R star. And I want to stress one aspect and suggest some narrative about why that is the case. The first aspect that I want to stress is the fact that maybe the nature of the economic cycle is different. What do I mean by that? I mean that most of the time when we think about economic cycle, we think in terms of business cycle. But maybe what shape the economic cycles are factors that are mainly financial in their origin. And what we want to understand here is what is the link between the transmission of monetary policy and the nature of the economic cycle may be affected by more financial aspects. Okay? So this is the first reason. Why that is the case? For example, in the current environment in the United States, we have seen, according to some, less sensitivity of the economy to interest rates. So interest rates have risen a lot. Despite that, the economy has been developing in a way that has been healthy. Why that has happened? Of course, there are many things that happen, but what I want to stress here is that maybe we should look more carefully at the structural feature of each individual economy in trying to understand what is the transmission of monetary policy. So, for example, here I highlight the fact that the structure of the mortgage market that allow for long contracts is a structural feature that diminish the sensitivity of households to interest rate movements. So that is an important aspect. So the other aspect that is relevant here is if you look at recession in the United States, and I have a graph in the next one, you see here, I plot two things. The spread that we use in our analysis, so that comes from a work of Gilchrist and Zabrajek. And then there are two bars, red bars and gray bars. The gray ones are the NBR, identified recessions, and the red ones are our heuristic way of identifying periods of financial stress. Of course, we can debate on that, but that's not the point. What I'm trying to say here is that if you look at recession more recently, it's hard to find recession that have not been driven by something that has started from the financial sector. And I'm thinking about the 2001 recession, the global recession, the global financial crisis, and of course COVID has been different in many ways, so it's an exogenous type of shock. So, but the point, if you go back to the quote by Volcker that is reported in the latest book by Blinder, is that maybe monetary policy works, and how it works, by breaking things. And in particular, he say, by creating bankruptcies. That's what he says. Now, going back to this concept here that we are putting forward, the idea is that maybe when we think about what is more relevant when we move interest rate, we might want to look more carefully at this concept of R double star rather than R star. Because, as I said, the nature of the economic cycle might be mainly driven by financial factor, and the way this is happening, it happens actually through strong nonlinearities, which is what we are stressing here. So, what do we do in the paper is that I'm going to illustrate this concept. And I'm going to illustrate this concept in a particular framework, of course, acknowledging that when we talk about the financial side of an economy, there are a lot of complexity that our simple framework cannot capture. So we chose one. What did we choose? We choose a macrofinance model, pretty much standard, on which we don't do that many modifications. And the key feature of this macrofinancial model is that there is a nonlinearity captured by the presence of occasionally binding constraint. Why we use this approach? Because in our view, was the most natural way of thinking about a crisis period when constraint binds and there is amplification, and the non-crisis period in which things behave normally. Okay? So there is this two-state type of situation that is very natural in this class of model, and also there is this nonlinear type of behavior that is very typical when we observe financial stress events. So, as I said, this might not be the only way in which you think about R double star. Why? Because there are other aspects of the financial sector that might be conducive of financial stress that we do not model here. For example, we do not capture bubbles. We don't have those kind of events in our model, but those also could be a way in which you can frame R double star, but using another type of financial vulnerability that we do not address. So what we do is that we are going to discuss within our framework what are the drivers of this R double star. And one aspect that I think is interesting, and I want to stress here, and I'll try to show in our analysis, is this concept of financial dominance. Basically, what we are trying to also frame here is the idea that when we have a very low real interest rate for long, what is going to happen is that this low interest rate for long will generate financial vulnerabilities over time. And these financial vulnerabilities will dynamically lower this R double star. So as interest rate becomes low or stay low, R double star becomes lower. So in some ways, these impose a constraint on what you can do in terms of monetary policy down the road. So another way of rephrasing it is that monetary policy now might impose constraint later in terms of its capacity of what they can do. So there is, in this sense, this idea of financial dominance because financial factors tend to limit the ability of monetary policy to stabilize the economy. Later in the paper, we take our analysis to a different level in the sense that we try to quantify and measure R double star. So this is, of course, a simple model. and has many limitations. But our effort is to try to provide something that is quantitatively sound, in the sense that provides some sort of indication on the behavior of R double star and what has happened in the way we measure R double star. And from our analysis, we show that the Fed effectively track R double star in period of financial stress. But of course, there is a lot that needs to be done and addressed, especially in the measurement part and on the quantitative part, because as I said, our framework is super simple. Before I start going more in the detail of it, let me say something about the relationship between R star and R double star and the way we think about it, at least from the perspective of the current analysis. What is R double star? Basically, as I said, is this threshold level beyond which we enter a region of financial instability. So if the interest rate, the real interest rate, is above R double star, what happens is that we have financial stress. Conversely, if the interest rate is below R double star, we are in a region of financial stability. So what I want to stress here with these slides is the possible policy trade-off that you may face when you combine this concept of financial stability, real interest rate, with the traditional macroeconomic stability interest rate, which is R star. So in principle, what you have, that if R double star is above R star, then you have a situation in which macroeconomic stability is compatible with financial stability. But conversely, if R double star is below R star, in that case, you might face a trade-off. Because, for example, you want to achieve stability in terms of inflation, but raising interest rate too high might trigger financial instability, stress, or problem. Okay? So that's just to give a flavor on how these two concepts might be linked or related. Of course, things are more complicated than what I'm sketching out here. And this is also the subject of our current investigation, because as we will see in a bit, we are kind of abstract in our first pass approach to this question from some of the details that I lay out here. So let me go now into the model. And as I said, the model is a relatively standard model of financial friction. And we took a model as much as we can, close to what was the original draft that was done by Gertle, Karadi, and Kiyotaki. So that's the kind of approach we use. Here I provide a very simple characterization of the model before going into the more general version. But the key aspect of the model is the banking sector and the friction that arises between banking sector and the household sector. So that's where there is the key financial friction that is at the core of our way of thinking about R double star. So in our economy, the banking sector is slightly different from the original Gertle, Karadi, Kiyotaki, and we do a small modification. And the only modification that we do here is from the asset side point of view, we allow for a portfolio choice. So we have the possibility of holding risky asset and also safe asset that we denote with BT. Okay? The presence of safe asset is actually crucial in our framework for thinking about what are the determinants of this R double star. The household sector is pretty much standard. They consume, they supply labor, and they save in deposits to the banking sector. And then we model monetary policy here in a very crude way, in the sense that this model is a real model. So there are no nominal friction. There's nothing that requires macroeconomic stabilization in terms of inflation. And we just think about a situation in which there is this interest rate that is exogenously moved by the policy authority. So in this sense here, we abstract from a lot of things that are related to monetary policy, and we just focus on the financial side of the economy by studying the interaction between this real interest rate and vulnerabilities that in our context arise at the level of the banking sector. Okay? So let me give you a little bit of what happens at the banking sector, because that's the core of our framework. And as I said, the banking sector is simple. We do have a small extension relative to the traditional model of Gertel, Karadi, and Kiyotaki. And what happens on the asset side, you can hold a risky asset or safe asset. On the liability side, we have deposit and then, of course, equity net worth. Now, what is interesting here, and the way I want you to think about this component, the risky asset, one way to think about that, Q is the price associated with this risky asset that is sensitive to interest rate movements. So we can think about this as interest rate sensitive asset. Okay? You can think about this also if you go back to the SVB case as a long-term treasury. Okay? Now, we have the evolution of net worth that depends on the excess return that you get on the safe asset and the risky asset. And there is a key friction, which is parallel to the one that we're going to have in the more articulated model. And the key friction is that we have a leverage constraint. So this is the leverage expressed in terms of total asset over equity. And the leverage cannot exceed a value that, importantly, in our framework, depends on the share of risky asset over total asset. Okay? So that's a key assumption that we do. So, and this is a departure, another departure from the Gertel, Karadi, Kiyotaki. Basically, we are saying that the more safe asset you have, the less severe is the financial friction, okay? Or you can leverage more. So what you can do here, in the next slide, I just take a very simple functional form for that leverage constraint, the functional form that I have on the right-hand side of the of that constraint. I just take a linear form and I re-express the expression in a way that is a little bit more, it's maybe easier actually to look at. So we see what are the things that actually matter in this equation and how they play a role. And the first thing that we do here, using something a little bit richer than that expression, is to construct R double star. So what is R double star? How do we construct it? Basically, if you go back to the previous slide, what we have, you have an inequality constraint. And R double star is the interest rate that will make the constraint being holding with an equality sign. Okay? So how do we do that? Of course, we need to, for a given state variable, we kind of find the jump in the interest rate that will make the constraint just binding, exploiting the relationship that these variables, and in particular here the risky asset, have with the interest rate. Okay? So what are the determinants of R double star? We can see what is going to happen here already. Of course, R double star is positively related with the share of safe asset. The bigger is the amount of safe asset, the higher is R double star. R double star is also positively related to the value of interest rate sensitive assets. So the bigger also is Q, the higher is R double star. So the way it plays is actually very intuitively and nice in the sense that they will tell us that the valuation effect, for example, coming from bigger, higher prices on the risky asset tends to push up R double star. Now, we cannot show it here from this very simple static equation, But what is going to happen here, and this we show through simulation, is that when you have a prolonged low period of interest rate, then eventually the economy is going to move towards a region which is more distressed. Why? Because eventually what is going to happen is that from financial intermediary point of view, when interest rates are very low, you tend to shift towards a risky asset and increase leverage. And by increasing leverage, you become more exposed to financial vulnerability, and that tends to lower R double star, okay? So that's what is going to happen. So leverage increases, and that will reduce the policy space down the road if you keep real interest rates low for long. Now, the model that we use is a little bit richer than what I just described, because it has a couple of more details on top of what I said. So, of course, it's a dynamic problem, and that's what the intermediary problem is about. You maximize the value of this franchise, the banking sector, and there is this sigma, which is the probability of exiting every period. But the key modification that we add relative to the Gertler-Karadi, Kiyotaki, so the key modification is that we add, so one modification is not so key, but we add also a preference for holding risky asset. And we do that because we want to have shocks captured by the XXVII over there that are associated with variation in credit spreads also during normal period. Okay, so we want to have some variability of some volatility of credit spreads also during normal period. The evolution of net worth is exactly the same as the one we had before, and the leverage constraint is slightly more articulated because it actually takes the form of what Gertler-Karadi-Kiyotaki label as incentive compatibility constraint. So you might want to default on your debt obligation, in this case, the deposit from the perspective of the banking sector, when the value of the franchise is less than what you can escape with. And what you can escape with is a fraction of your asset. The key change here is that the fraction, this fee function here, depends on the share of safe asset. That's what I was saying before. Instead, in the case of Gertler-Karadi and Kiyotaki, that is just a parameter theta. Okay? So we make this endogenous, and this is at the core of our way of adjustment of the leverage through the cycle when we change interest rates. Okay. So that is the function, which also has a particular shape, this key function. It's a convex function. And why it is convex and what does it mean, which is more important? Basically, this financial friction becomes more severe as the share of safe asset is lower. Okay? And that is what helps us in generating the behavior of leverage through the business cycle, as I said, through the cycle generated by low interest rate. So as you move towards less safe asset, because interest rates are low in your portfolio over time, then the share of safe asset decrease. But as you can see here, this decrease tends to worsen the financial friction, and in some ways make R double star become lower, because of course you tend to be closer to a more vulnerable region, to the more vulnerable region. Now, what happens in this economy? As I said, one of the virtues of this approach, the occasionally binding constraint approach, is that you can distinguish these two states. The state in which the economy is in normal situation, everything works pretty much fine, and the state in which there is financial stress. And the state in which there is financial stress is the situation in which the constraint is binding. If the constraint is not binding, then what happens is that the spread that we observe are just generated by the exogenous shock XI that I mentioned before. Okay? That's what we need in order to have a little bit of volatility during normal times. On the other hand, when the constraint binds, then we enter a region of financial instability. Then, in that case here, we have the standard financial accelerator mechanism. And as the constraint binds and net worth decline, this lowers Q, which is the price of a risky asset that tends to feed back into lower equity and amplify itself by creating the financial stress episodes that in this model is also associated with the decline in investment and the contraction in consumption and output. More interestingly, what happens in this situation is that the spread becomes large and volatile. Okay, so they're no longer depending on the exogenous component, but also generated by this endogenous amplification mechanism. So what do we do here is, as I said before, we basically construct R double star, exploiting this occasionally binding framework. We move for a given state. So imagine the economy is at a given state. So what we do is that we just create a shock to the interest rate, and the size of the shock of the interest rate is such that the constraint becomes binding. So in this sense, our R double star is a threshold, and it's the threshold above which the economy enters a financial stress period. So as I said, and I want to stress, of course, this gap, this financial stability gap that we construct, R double star minus R, depends also on the evolution of other state variable. And in this, our context, the evolution is driven by the leverage, and also the other state variable is the share of risky asset in the bank portfolio. So what do? We take the model then to the quantitative part. We calibrate it, and we try to study the properties of the model, both in terms of mimicking key aspects of the US economy, and also in terms of understanding the behavior of R double star, which is the focus of our analysis. The first thing that I want to show here, which is not that surprising, is that, of course, what is going to happen in this model, we're going to have state-dependent impulse responses. Here, the idea of these state-dependent impulse responses is captured by considering a quite sizable shock to the real interest rate of 300 basis points, which is relatively persistent, and then look at how the economy reacts to the shock, depending and conditional on the state in which the economy is. And what we see here, if you are close to the vulnerable situation, what you observe this strong nonlinearity. So here we have a big contraction in terms of output driven by a decline in investment, and the economy enters this stress situation in which the R double star is lower than the interest rate. So in this period, in this region here, we are in the situation in which we are above the threshold. So the gap is negative, and there is financial stress. And as you can see on the second panel to the right on top, we also observe big credit spread. Okay? So it's just to show that the same shock, of course, depending on where you are, can generate very different dynamic. And this is also another well-established result in terms of the power of this occasional binding constraint economy. Now, what is interesting here is also we simulate the economy many times to try to describe the general properties of the economy in what we label as average financial crisis type of period. And we can see here that on average, in our model, of course, so this is important, I want to stress that it's our model, that the financial crisis period is usually preceded by relatively low real interest rate and then rises a lot. And we see here the share of safe assets tend to decline. And then at some point, which of course, our characterization of this episode, this is the 0 point in our axis, we are going to see the spread rising, the drop in GDP, and the financial stability gap becoming negative when the crisis occur. So that's our characterization according to the model of a financial stress episode. The other thing that I want to show in terms of the property here of the model is that the concept of financial dominance that I was illustrating in words before. And now we can see a little bit how it operates, at least from an impulse responses point of view in our quantitative model. What we see here, that we see the response of the economy to, again, a persistent shock to the real interest rate. It drops quite significantly here and then takes time before going back to the initial risky steady state. But what is interesting here is the following. What happens to the financial stability gap over this adjustment? And there are two things that happens. Initially, the drop in interest rate is actually beneficial in terms of rising R double star. So R double star becomes higher and the R becomes low. So the gap opens. And why that is the case? That is the case because the drop in interest rate at the beginning generates positive valuation effect. So increase basically Q in my characterization, simple characterization that I had before. But over time, what happens, as you can see here, the share of safe asset tend to decline. This is the portfolio channel that I was emphasizing earlier. And the leverage tend to increase. And as the leverage tend to increase, we can see it here, then we have a decline in this gap. And over time, as you can see, the interesting result of this very simple exercise is that down the line there, above 15 quarters, we started seeing the financial stability gap being lower than where we started originally. So basically, low interest rate tend to reduce the policy space expressed in terms of this financial stability gap down the road. Okay? So that's the idea of financial dominance. Now, there I just show you quantitative, the response to variables that are not output and the credit spread, as you can see here, is basically an extension of that figure that show something that also people are familiar with, the nonlinearity associated with the growth at risk literature. And what we see here is that the adjustment of GDP through all the distribution. Before I just show you the impulse response, so there was just the shock to the interest rate. In this figure here, there is the shock to the interest rate at the beginning, and then there are other shocks that hit the economy down the road. So we have the distribution of possible outcomes of GDP and credit spread. What is interesting here? What is interesting is that as we enter or we get close to the financial stability, we see these asymmetries in the distribution that arise. So we see that, this is the upper quintile, and we don't see much, right? But here, of course, we see bigger contraction in terms of GDP. So this, again, comes from the nonlinearity of our framework. Now, what we do is that we also study the properties, of course, of this R double star. And here, and also in the measurement part, we use a machine learning approach to try to uncover the properties of this latent object, which is R double star. So unfortunately, R double star is another object that is out there that we need to measure somehow, like R star. So in this sense, we need to come up with ways about understanding how that works. And here, what we do is we use machine learning regression to try to understand what is the link between interest rate and R double star. And in particular here, we focus on interest rate, a different lag, and how different lag here can predict, can generate good R square in terms of out of sample R double star. So there are two lines here. One is for all legs. So of course, more legs you put, the better is the out of sample regression in terms of R square. But what is interesting here is the blue one, in the sense that this blue one just select the lag that is on the horizontal axis. So when we choose, for example, here, we reach the peak in terms of R square when we have the 8 lag, okay? So in some ways, it tells us that there is a complex relationship between lags and R double star. And this is also something that is mimicked in terms of the other graph, in which we look at the actual R double star generated by the model and the fitted one using by contemporary value of R, the interest rate, and the lag coming from 8 period before. So there is value coming in terms of explanatory power coming from lag values of the interest rate. This one is another fascinating picture because it's very colored and all design, but it says something very simple. It said something that I already kind of highlighted before. Basically, here we look at the gap on current interest rate. We see a negative relationship. So the color are associated with other state. And when we look at the gap over 8 quarters interest rate, we see a positive relationship, which is exactly the point that I was trying to stress before. The fact that the way interest rate operate on R double star varies over time, depends on the horizon at which we are looking at, okay? So there is a dynamic adjustment of R double star that happens as interest rate moves. Now, how do we measure R double star? And let me first stress a bit the approach that we do here. So, of course, as I said, this is a simple model, as you could tell from the characterization that we provide and I provided here. But at the same time, it's also complex because of these nonlinearities. What we do in terms of measuring R double star is that we take the model seriously, which is a limit, of course, of the analysis. So we provide a structural measurement of R double star. So how do we take the model seriously? We say basically that the relationship that holds in the model are the same relationship that holds in reality, okay? And what we do is the following. We say, let's take the model seriously. We know how R double star is measured in the model, right? We can measure it. What we don't know is what is the relationship between R double star and the other variables, because the model is highly nonlinear. So we use machine learning algorithm to uncover this relationship from the model point of view. And we want to uncover this relationship from a model point of view in terms of variables that we can observe in reality. And then we use this relationship from the model side and apply it to data as if the data behave like the model. So there is a lot of faith that, of course, we put in the model, but this is one way in which we can approach the problem. And also exploit fully this nonlinearity in a way that we can control. So, or we can measure it in the best way possible. So here we do it using 2 variables. We basically, in this draft, we are measuring this financial stability gap between R double star and R on 2 variables. The first one is leverage and safe asset ratio. So we get a very high R square. So this is the relationship of a leverage, and you can see the nonlinearity. And this is the relationship with the safe asset ratio for different leverage values. And then we use also the machine learning to tell us what is the link between this financial stability gap and the real interest rate and the spreads, which are also something that we can measure in reality. Now, the best one is the first one. The R square is 0.997. The second best is 0.992, so it's still good. And actually, we use the second one because we have a longer time series, and it's easier to measure because with leverage and safe asset ratio, of course, there is a little bit more limitation in terms of measuring leverage and also the definition of safe asset. But we do that in the paper too, and we provide a comparison between the two. Now, let me show you a bit what happens when we do that and when we measure it. So I'll show you exactly our measurement of R double star and the real rate in the data coming from this exercise. And as you can see here, there is, and I'll show you in the next graph as well, there is quite a lot of movements of our measured R double star. And at times we see that there is a perfect tracking, as you can see here, during the global financial crisis. And also earlier on, I think this was the LTCM crisis, period in which the real interest rate, which here we interpret in terms of a proxy of the policy rate, tracks our R double star. Now, one thing that I want to stress here in this measurement exercise is that we are just providing this is not a forecast, okay? This is some sort of, maybe it's not precise word to say, we are just saying what's happening today. It's some sort of nowcast assessment of where the economy is relatively to this financial stability concept that we have constructed, okay? So you can see here how it varies over time. This is the period post-COVID. What is interesting, though, it looks like they track each other, but it's not the case if you look at it carefully, because sometimes the gap open and the interest rate, which is measures as a post-policy Fed fund rate here, real terms, goes in the opposite direction. So that's tell us that there is information in this simple exercise that we are doing. This is a little bit more of a zoom picture in which you can see a little bit more what happens more recently. Here, of course, March 2020 period, we see that the two lines overlap, and the Fed fund rate track the decline in R double star that we see on the red line going lower. I don't have much time. Let me show you something that I prepared for this presentation, and just to show a bit, this is a little bit of an arbitrary graph in the following sense, because in our model, as you could tell, we don't have R star. We don't have the standard monetary policy framework here. So I just take the measures of, one measures of R star. I choose the Lubick-Mattes one because it's the highest value of R star. But you can see here what is interesting is, of course, what has happened more recently in terms of looking at these two. And I don't have much time here. I'm borrowing time from the discussant. But we need to go back. One way to think about this, as I said, this is a little bit arbitrary, because ideally what we would like to do is we would like to construct R star from our model 2 and compare it. No? But the idea here is to say, go back in time and try to think at that graph I showed you earlier in terms of the recession, financial stress period, and how these variables move one versus the other. Okay? And what is it that is driving maybe the economic cycle, as I said at the beginning. And I conclude here. So this is a closer look. Just conclude. So what do we do here? 1 minute. Introduce this concept of R double star as a way to think about how financial stability consideration affect the policy decision. We try to translate vulnerabilities from financial sector point of view using a macrofinance model, a simple one that has its own limitation, into interest rate space. Last thing I want to say, of course, the underlying idea is that I want to stress the importance of financial channel of monetary policy. And going back to what I said before, maybe this concept of R double star in terms of thinking about how the economy changes or evolves, or it has changed, suggests that possibly we might want to look at this R double star more carefully than R star. So thank you for your time. I appreciate letting me finish it.
Thank you very much, Gianluca.
Sorry.
Now we have Alonso Villacorta. He will discuss this paper. You have, Alonso, 15 minutes, and then we are going to have 15 minutes for a question from the floor.
Well, first of all, let me thank the organizer for inviting me to this great conference. Very happy to be here discussing this great paper. And as Gianluca explained very clearly, this paper is proposing this new concept of a natural rate of financial stability, which they call R2 star. And the motivation I see behind having this concept is the following. We have a large literature highlighting the importance of the health of banks' balance sheets. We know they matter for credit supply and the real economy. And we also have ample evidence in favor of a bank lending channel, meaning that movements in monetary policy are going to affect banks' balance sheets. Then this natural question arises. How much of an interest rate increase can banks' balance sheets handle before going into a crisis? So this paper proposed this measure to think about this question. It's a novel measure of financial stability capturing the health of banks' balance sheets expressed in terms of movements in the interest rate. If the interest rate increases below R2 star, then the economy lives in this financial stability environment with a strong bank balance sheets. If instead the interest rate goes above R2 star, then the economy lives in this financial instability environment with weak balance sheets. So how can we measure now this concept that divides the economy between financial stability versus financial instability? Well, the paper's going to propose this model-based approach. So they're going to follow a standard model with financial constraints and define R2 star as the interest rate at which the constraint is just binding. And then they're going to quantify R2 star by calibrating the model and looking at some financial data. So in this discussion, I first going to very briefly describe the model and the definition, and then I'm going to do a few comments about why I think this measure is useful, and then I'm going to do some comments about identification in the data. So the model, as in any model with borrowing constraints, the size of the balance sheet is limited by the net worth of the bank. Okay? That's because the bank has a limit on how much leverage it can take. Then movements in net worth become key. It's going to determine the asset demand or credit supply and total investment in the economy. Now, moreover, in these models, the net worth dynamic is endogenous, so it's going to depend, net worth today, on the investment that the bank did in previous periods. So the main mechanism in the model is a valuation effect. If you increase the rate, that is going to reduce the price of all long-term assets. And so those losses are going to be absorbed by the net worth of the bank. Then a drop in the net worth of the bank is going to have an implication in the economy depending on the binding status of the constraint. So without borrowing constraints, or if the net worth is so large that we are far from the constraint, changes in net worth play no role. You can always change the net worth for additional debt. And instead, investment in the economy will be determined by the usual Euler equation, and any spread will be capturing just compensation for risk, given as some stochastic discount factor for the investors. With borrowing constraints instead, financial accelerator kicks in. Dropping net worth means that banks need to reduce their balance sheets. That reduces their demand for assets, reduces investment, reduces even more the capital price, affecting even more net worth, so leading to these fire-sale dynamics and a deeper recession. In this case, instead, total investment in the economy is going to be determined by the constraint, determined by the level of net worth after the shock. And instead, risk premium in the economy are going to depend on the Lagrange multiplier on the constraint. So in this case, higher spreads are not signaling compensation for risk, but are signaling that banks are constrained, so they cannot take advantage of that spread. So given this model, then the authors defined R2 star as the rate at which a constraint is just binding. And of course, R2 star is going to be a function of state variables, right? So if the net worth of the bank is very large, then they have a lot of loss absorption capacity, then R2 star is going to be higher. Of course, R2 star is going to be a function of the endogenous states in the economy and the exogenous shocks. Then the authors are going to solve the model allowing for occasionally binding constraints, and they are going to find for every state in the economy the distance to the constraint, measure as the increase in the rate that will reduce the net worth of the bank at the point in which the constraint becomes binding. So this distance between R to star relative to the interest rate today is measuring these resiliences of the banking sector. So given this definition of R to star, now let me do a few comments on why I think this is useful. Because for instance, I mean, regulators already monitor financial vulnerabilities, right? So this picture is just taken from the Fed website. We can see here the different risks that they are monitoring and different financial variables. But well, R to star is going to summarize these vulnerabilities into one simple indicator expressed in terms of movements in the interest rate. So I think that is going to be very useful for a central bank. Then I thought, okay, but regulators already perform stress testing. For instance, they ask how much bank capital or net worth is going to be depleted under adverse scenarios that include high rates. Well, then I thought, okay, no, but that result is very useful because first we're going to focus exclusively on movements in the interest rate. Then given the author's estimation method, they're going to be able to provide us with a function such that once we have the last financial data, we can apply the function and find immediately this R to star measure. So it's going to be very useful. And of course, this R to star accounts for general equilibrium effects, while some of these stress testing methods do not. Then I want to just remark that R to star is a useful benchmark to think about the trade-off, but not about efficiency. So if the interest rate is above R to star, that means we need to worry about banks' balance sheets. If it's below, we don't need to worry much about balance sheet, but maybe we should worry about excessive risk taking and future balance sheets conditions. But the paper is silent about what is optimal. Of course, that would depend on the shocks affecting the economy, the objective of the social planner, but that's not the objective of the paper. And last, I want to just mention that there could be other mechanisms that could affect banks' balance sheet that are not considered in the model. So very quickly, we could think of credit risk. Increases in the rate could affect income of borrowers, increasing the probability of repayment of loans. That would affect negatively banks' balance sheet. That's not in the model. Or also a franchise value effect. Environment with high interest rates sometimes is good for certain banks if they don't have to pass that increases in rate to the deposits. That's not in the model. Okay? Now, I don't think that the authors need to have all the channels incorporated in the model, but I just wanted to remark that then this R to star is measuring mainly market or valuation risk of the bank's balance sheets. Okay? So given these comments about why I think R to star is useful, now let me make a few comments about identification in the data. So how can we measure R to star in the data? The authors can solve the model and find R to star as a function of the state variable. So they know the function f. What is unknown when we go to the data is what is the state of the economy today and the shocks that are hitting the economy. So those we need to estimate them. So a possible approach would be let's use data to estimate these latent variables and then apply our function f. The authors don't pursue this method. I thought that maybe this is too computationally challenging. I mean, it's a nonlinear model, so it requires a nonlinear filter to apply expectations and write the likelihood. But instead, the authors are going to follow a different approach, which I found very, very interesting. They're going to simulate shocks in the model. In particular, the simulation is based on two main shocks, TFP shocks and monetary policy shocks. For each path of simulations, of shocks, they can compute their R to star function for every simulated point, and also other equilibrium variables, like leverage, spread, the interest rate, etc. So with the simulated data, they're going to try to find this relationship between R to star and the equilibrium variables in the economy. And in order to do that, they're going to use machine learning techniques. So the algorithm will tell them which of the equilibrium variables is giving more information about this R to star. Once we find this association, that's nice, because we have data counterpart of these equilibrium variables. Then they're going to just extrapolate this function g directly to the data, they get R to star. Okay? I think this is great, a great method. If we're confident about our g function, then we actually can keep updating our indicator with new financial data without the need of re-estimating the model and find the new latent variables. Okay? So I think this is great. Now, what would be a concern, and this is my second comment, it would be about the robustness of this g function to, for instance, other specification of shocks that may not be included in the simulation, which is where we learn this g function. So for instance, the author showed that this R to star function G is very accurate in their simulated data. In the first specification, they show that just with leverage and the safe asset ratio, they can explain basically perfectly the R to star in the simulated data. Or equivalently, in a different specification, if we just use spreads and the interest rate, we also can have a perfect fit of R to star. Okay? Some intuition is like the model is signaling that when we observe high leverage, that's indicating that the constraint is binding. R to star is close to R. Or when we observe high spreads in the model, that's also indicating that the constraint is binding. But then the question is, what if there were other shocks hitting the economy? For example, we could think of shocks to leverage limits or collateral limits. Then suddenly, banks could increase their leverage thanks to a shock. And that's exogenous reason. That's not because of we're close to the constraints. So it's going to affect the relationship of leverage with R to star. It's going to affect that G function. Another example would be risk or uncertainty shocks. So in that case, spreads could change because investors want a higher compensation for risk given the higher uncertainty. And that's not related to the binding nature of the constraint. So that's going to affect, again, the relationship. Now, of course, this concern would be relevant if we think that these shocks could happen in the economy. But actually, there are some papers that find that these type of shocks are actually the most important shocks to explain business cycle fluctuations in the US in their estimation exercises. I think also this concern of this robustness of the G function to other shocks, gains relevance once we was looking at this result. This showed the estimated R to star from the authors. So the green line is the estimated R to star. The blue line is the real rate. So whenever these two solid lines touch each other, R to star equals the interest rate. That means the constraint is binding. And this happened mainly during the recession of 2001 and 2008. Okay? Then I was thinking, okay, what kind of shocks in the model would generate these drops in R to star? So the real rate is going down. According to the model, that's helping banks' balance sheets. So there has to be another shock in the model that is destroying bank balance sheets, right? Because R to star is going down. In the model, the only other shock that can generate that is the TFP shock. So this would be generated, but very bad TFP shocks, which when we go to the data, we don't see TFP dropping as much in 2008. And that's why we have these other papers that need other shocks in order to be able to explain business cycles, right? Okay, and so as a final comment, I just was wondering if we could enhance the identification or estimation of R to star with another piece of data. I was thinking of looking about firm versus bank net worth data in particular. So the idea is that the authors find that 2001 and 2008 recession are two recessions in which the constraint is binding. That's because mainly they're looking at higher spreads. So this G function is a function of spreads. So we see in 2001, spreads were large. 2008, spreads were large. So that identifies that the constraint is binding according to the model. But were banks' balance sheet weak in these recessions? So now I'm looking here at data in bank net worth, measured as the market value of their equity. So in the 2008 recession, of course, banks were destroyed. The 2001 recession, banks were not very much affected, but still spreads were high, where firm balance sheets actually was affected. So now this blue line is showing the net worth, but of firms, non-financial firms. So in 2001, actually, firms were destroyed as well. So with a bit of shame, I'm going to use the opportunity to cite myself. So I have a paper in which I estimate the differential importance of bank constraints versus firm constraints. And actually, I find that in 2001, it's actually firm constraints which are affected, it's like weak firm balance sheet, and that can explain the increasing spreads. Well, in 2008, it's actually weak bank balance sheets which are affected, and that's generating higher spreads. Then I'm wondering then if using net worth data both from banks and firms can help then identifying what we want to identify, which is actually weak bank balance sheets, not firms. Right? So with this, I conclude. I think this is a very useful indicator of financial stability. I'm sure this will become a reference used by academics, central banks, regulators in the future. I raised some concerns about the identification of where to start, but I think the authors can easily extend the model, for instance, to allow for more shocks, and in which case then the machine learning method will probably require additional observables to disentangle what are shocks to banks' borrowing capacity versus other shocks. And in that case, I wonder if then the machine learning method will then favor looking at bank and firm network data to disentangle these shocks. But with this, I finish. Thank you.
Thank you, Alonso, for your excuse. Now, we have 15 minutes for questions from the public, and then we will let some time for Gianluca to answer. So there, please.
Hi. So this was super interesting, I think very, very topical. So I have a relatively simple question that's partially related to the discussion. If I understood correctly, so the direction of causality is always like there is something happening in the banking sector and then that affects the macroeconomy, if I understood correctly. But we know, of course, that these spreads are also forward-looking, so it could be the other way around in the sense we become more concerned about the macroeconomy and then spreads go up. Maybe I simply missed this in the presentation, but if you kind of want to elaborate, yeah.
Thank you. So very interesting paper, Gianluca. One question, it seems like if you think in terms of policy, that you can use another instrument, no? You can think about macro-pru immediately. You have a target that is R, W star minus R, and you try to calibrate countercyclical buffer or whatever the name you want to put there in order to try to keep the probability of the financial constraint become binding at a certain level, no? Independent of, so therefore you can manage or you can conduct monetary policy and financial policy independently. So it looks like that could be a solution in your model for the conduction of macro policy in general.
Gianluca, just a clarifying question. There's one issue I didn't fully understand. So when we typically write down these models of where banks face constraints, it's also true, obviously, like banks are special, right? Which means they earn a higher rate of return on the risky assets that they're able to generate, but they're constrained by how much the size of their balance sheet. Now, I would have guessed that implies in your framework that they always bump endogenously against a constraint so that R double star goes to R, or whatever the relevant sort of borrowing rate is for the banks. That does not seem to be, so I'm just trying to understand why R double star doesn't always endogenously go down to whatever the benchmark interest rate in the economy is.
Okay, I think this is a lot of questions for you, Gianluca. So you have a microphone if you want.
Well, thanks a lot for the nice discussion. And let me say a few things. I think everything you said is very relevant, and I tend to agree with some of the criticism you raised or qualification that you added, so especially on the part in which we do the identification. And so let me say a couple of things there that I think are relevant that we should keep into account. And the first one is the extent to which I think what you were saying is that this relationship, for other reasons, are stable over time. And this is important, of course, because it goes back also to what I was saying earlier, the fact that also the financial side of the economy changes over time. So we might need to keep that into account, and to the extent we look at a very large time window, we might not capture this structural shift that might occur because, as you suggest, there are other shock or something else that happens to the economy itself, especially on the financial side. So, for example, in relation to that, one thing that you might note, if you look at the paper, is that in the period of the Volcker disinflation, our heuristic approach to identify financial stress doesn't pick up anything there, even though we see an increase in credit spread. But as a byproduct of that aggressive monetary policy action, there were problems in the savings and loan side of the financial sector. So why we don't capture that? Of course, because as I hinted earlier, our approach to measure financial stress is very heuristic, very basic, but also, we kind of define a movement in the spread based on historical data, but maybe back then those movements were relevant, and when we look back from the perspective of today, they are less relevant, so we don't pick them up. And there is this cut associated with the idea that financial vulnerabilities are now amplified relative to what they were before, or the things are different, basically. That's, I think, to summarize a bit what you're saying. And it is true that also, our framework is pretty basic in terms of the shock. I don't like that much the fact that we have to rely on TFP shock, personally, but it was, a starting point in terms of using something that is out there on the shelf of which people tend to agree, as opposed to try to come up with something that people will say, oh, why you did this. But there is, as you pointed out, a literature that do discuss and emphasize other type of shocks that are relevant, especially in those financial stress episodes that we might want to bring back. And also want to understand more about your work on the firm net worth and the possibility of including other indicators from the financial side that can be useful. One constraint that unfortunately we do have when we look at some of this data, and then also we have when we were looking at the leverage, is the time series available. So that's unfortunately could be a problem. The other issue that you raise is that is correct. Also, our framework is just a positive description of this concept. We don't have associated anything here in terms of what is the optimal interest rate and how the evolution of the interest rate is connected with this double star concept. So our double star concept is just a threshold value that determines when the economy hits this financial stability region. But in principle here, the type of exercise that you would need to do, I guess, to answer to your question would be to say, let's write down an optimal policy problem in which we set the real interest rate optimally. And I guess it would amount to say, in our simple framework, to the extent to which we want a time to eat, or we tolerate the economy eating, maybe at times, subject to the distributional shocks that we have, that constraints. So, but in principle, this is a super simple model, so you would like to avoid the constraints from being binding. So you might just conditional on the shock, be always below these double stars. So in principle, as I said, we need to think about this more as a threshold. And that's going back also, I want to address the question that is related to this by Luis, which was saying, maybe you can use macroprudential policy. And that's perfectly fine, and that's what our framework actually would suggest. The idea would be to say, for example, to think in terms of, yes, now we have these measures out there. We can translate and map all these vulnerabilities that you also raise in terms of interest rate space somehow. And then we say, well, we can move interest rate in a way, and then we need to understand how macroprudential policy can adjust in such a way that we might not create a conflict that I emphasized before, which is essentially not in this framework, but in a framework that is a little bit richer. We will have a situation in which there is a tension between macro and financial stability. So if you have more tools, you might want to use them accordingly. What our framework here, or this paper is saying, there is a way in which you can think everything in terms of this interest rate. That's the idea. And then maybe we can think in terms of macroprudential policy, keeping in mind this concept out there. Now, there were other questions. I think more or less I addressed what you were saying. Now, there was a question by Francesco, if I understand correctly. You were saying, you know, the way maybe I phrase it, it's everything comes through the spread, if I understood correctly. And then we have these effects on economic activity. But what you're saying is, in reality, this spread have information that is forward-looking. My understanding, the model here, the way this model works is actually the spread are just reflecting, of course, the current state in terms of capturing that situation in which the constraint is endogenously binding. So I'm not sure we will have that other dimension that you were saying, but maybe if you want to expand on that.
Just to clarify, so I was trying to figure out to what extent, maybe this is also part of the way you started the talk, and it's totally fine, and say, okay, we see spreads going up, and this takes a toll on the macroeconomy, and that's totally reasonable. I was trying to figure out, okay, to what extent we could write a model in which simply spreads go up because banks expect some losses on loans and so on, and the direction of causality is completely the opposite direction. I'm not saying that's a realistic model, but probably both mechanisms are at work. So I was trying to figure out how much the direction of causality is we expect losses, spreads go up, as opposed to spreads go up, the economy enters a recession.
Well, in this model, from my understanding, there is that channel too, but you wouldn't see the big increase in spread. The big increase in spread comes from the amplification. Now, ex ante, so before the constraint binds, and when you are close to it, you start seeing that, because there is the expectation that the constraint might binding, and that expectation, as conditional on the state, can be driving the spread to be can have, you can see the spreads rising, but you wouldn't see spikes. You would see a bit coming in, yes. So you see that. I think in the graph in which I was showing the average financial crisis, you start seeing a bit before the zero, in which we had the identification of the crisis. And a deep question: why, if I understand correctly, we are not always on the binding situation there? Is that way to rephrase what you were asking?
For profit maximizing banks, they would want to do two things, I think. They would always want to use all of their borrowing constraint, number one. Number two, within the way you specified the borrowing constraint, they want to maximize the risky asset, because that's where all the returns are.
Yeah.
And the second piece in particular will push down our double star in your framework, again, if I'm understanding correctly. So it feels to me that the combination of those two should, in equilibrium, imply that banks always push our double star down to whatever the relevant policy rate is. Obviously, that's not happening. So I'm trying to understand what is it that does not make that an equilibrium phenomena.
Yeah, I mean, this is what happens actually in what I was explaining before, in the sense that in the adjustment, this is what is happening, because you would observe these R double star lower by the behavior of the banking sector that is actually shifting out of the safe asset. But yes, in the characterization of the equilibrium, we don't have the constraint binding. You wouldn't, I guess it's the combination of the shock that will result in a portfolio allocation that would not trigger the constraint being binding. But the constraint, you can exploit, so when, in principle, when you are in the situation in which the constraint is not binding, you are exploiting the arbitrage opportunity because you're not constrained. When you have the constraint binding, the spread arises because you cannot exploit those arbitrage opportunities, indeed, so because you are constrained. So it's just an equilibrium that conditional on the shock and what happens to the economy. You're doing actually the best when the constraint is not binding, but you cannot arbitrage and choose what you would when the constraint binds, because that is actually imposing a limit on the way you can arbitrage between different asset returns.
Okay, thank you very much, Gianluca, and also Alonso. A final applause. And now we're going to move to the second paper of this session. Well, the paper that we are going to present now is 3 Theories of Natural Rate Dynamics by Galo Nuño. Galo is the head of Division of Monetary Policy and Capital Markets at the Bank of Spain. Previously, he was working at the European Central Bank and at the BBVA. He holds a PhD in electrical engineering at University Politécnica de Madrid and an MSc in management science from Stanford University. He has published in leading international journals such as Econometrica, Journal of Finance, and the Journal of Monetary Economics. He has been visiting professor at the University of Calgary, Lewis, and summer school professor at CEMFI. Galo, you have 45 minutes for your presentation.
Thank you very much. Thank you very much for the invitation. I'm very happy to be here. This is probably the closest that I've ever going to be giving a TED Talk, so it's very cool. So essentially, this is a combination of 3 different works that I've been working over the last few years. And in a way, I think that they are a good complement to several of the papers that have been presented today and to the talk by Ricardo. So let's start following a little bit Ricardo's approach with a definition of the natural rate. So we are going to take this kind, what Ricardo would call the why. So we are going to focus on the short-term interest rate that would hold in the long run. So the concept is equivalent to what would hold in the stochastic steady state of the model. So what we want to see is which is the short rate that would prevail in the long run in the model once that the different shocks are washed away, peter out, okay? I will not get into the discussions between the neutral rate and natural rate, whether this is kind of the boot for period by period tracking. So that is going to be outside of the talk. Then again, why do we care about that? As central bankers, as investors care about this, because essentially you need to have an idea about which are going to be the long term, the long segment of the yield curve. So, and incidentally, that is also giving you an idea about the monetary policy stance. Is your monetary policy tight? Is your monetary policy loose? I mean, saying that real interest rates are 4% per se conveys no information. If there is no a concept against which, I mean, you need a hardstick to test, to check the level of real interest rates. So this is why, I mean, this concept of natural rates, it's essential for central banking. And then finally, kind of the standard view about the natural rate, again, to summarize, is this kind of structural kind of Wickselian approach, in which essentially what determines natural rate is a function of structural factors. In fact, I mean, just to convey a very simple way to put it is in a very simple kind of Blanchard-Jarry model. With paper and pencil, you can see that the deterministic steady state real interest rate in that economy depends on the beta, that is the subjective discount factor of households. That would be the simple in the simplest New Keynesian model. So R in the steady state would be 1 over beta. If you also have growth and you also have death, then that modifies a little bit those results. But this is in a way the kind of, I mean, you can have an overlapping generation model, whatever, but in a way, the basic thought of central bankers, at least for the last 10, 15 years, has been very much into this point that the natural rate is something that is given to us by God. I mean, it's something that comes from the structural factors of the economy, and that then we as central bankers need to try to read the rest of the coffee in the cup and try to distill how these long-term trends are evolving. The point of my talk is to challenge this view. The point of this talk is to say that fiscal policy affects natural rate, and that connects with Francesco's presentation this morning, in a different way to the one that Francesco was presenting, but also that monetary policy and also even effects other than monetary policy, so even things that in normal circumstances would qualify as business cycle effects, such as supply shocks, temporary supply shocks, affect the natural rate. So essentially, this is why I call it 3 theories, because I'm gonna try to discuss about 3 different points. One about fiscal policy, second about monetary policy, and third about short-term fluctuations, the long-term impact of short-term fluctuations. And then I will try to talk a little bit about which are the implications for monetary policy design, which I think that are quite relevant. So then what can happen, so the good thing of my presentation is that I've tried to remove, I mean, 90% of the equation, so this is not going to be about, I'm not going to be presenting the Euler equation of the household, thing like that, so I will try to present everything at a higher level. It can be easier for all of you, or it can be a total failure. So I'm really open to see which is going to be the outcome, honestly. So first, I'm going to start with this fiscal theory of the natural rate. In a sense, this is the less challenging or more standard view. So most of the things that I'm going to say here are not kind of mind-blowing, because other people have already made similar points. So there is already a certain, I mean, a number of papers that have discussed how fiscal policy interacts with the natural rate. Not, again, through the channels that Francesco was commenting, so not through the point of, I mean, let's put about the fiscal theory of the price level, because in a sense, working at a central bank, I've always felt very much against this approach, because, I mean, after many years, I mean, being present in many of the discussions of the Governing Council, I've never seen any governor saying, let's tolerate a little bit of inflation in order to let, I mean, because the fiscal authority is becoming very much expansionary. Especially in Europe. I mean, this kind of talk in Europe would be totally anathema. I mean, probably the rest of the governors would kick out this person out of the room if ever suggested something like that. However, there are a number of different theories Lucas Rachel and Larry Summers and many different authors that essentially are simpler in a way. They are not about fiscal policy per se, are about debt, are about long-term debt. And essentially the point is that in the infinite horizon, when you have households who are infinitely live, the demand for debt typically is totally elastic. So then this is where you get the kind of equation that I was presented before. But once that you relax that and you move to overlapping generation or kind of incomplete markets model a la Yagari, you get this kind of downward sloping demand. And then in that case, the total amount of debt determines the long-term real interest rate in a similar way to the one that Ricardo was presenting this morning. So essentially, what you have is that if you want people to hold more debt, you have to increase the real rate of remuneration for that. I mean, it's as simple as that. You can get it through different mechanisms, but the whole idea is that one. And typically, the key mechanisms that those models need in order to generate this kind of downward sloping demand curve is some sort of precautionary savings. You can, hardwire it as a convenience motive for holding debt, but the simplest way is that this convenience motive comes from precautionary savings. So people want the debt because this is the way that people in those models use in order to smooth consumption. So that is the idea. So then we have this, in this paper with Jesus Fernández Villaverde, Peter Paz, and Rodolfo Campos, what we do is we take a standard Hank model, and then we play a little bit with the fiscal block. But there is nothing particular, so this is why I'm not going to start discussing the different parts. For those of you who know this kind of heterogeneous significant literature, this is going to be literally a standard. For those of you who don't, this is not probably the venue to start presenting that. And essentially, these figures summarizes the point that I was making in those models. So since the original paper of Ayagari, you got this kind of demand schedule. Now the demand, instead of talking about prices, we are talking about real rates. So this is why it is inverted. And then essentially, there is this point in which this is the total amount of debt. So if in the long run you have this amount of debt, then you have this real interest rate, this long-term real interest rate. If you reduce the amount of debt, you reduce the real interest rate. But then now we start talking about how does interact with the nominal elements. And this is, again, similar to one of the panels that Ricardo had this morning, which is, if now I consider different interest rates, then this different level of inflation, then in terms of nominal interest rate, that is shifted or not. But then there is one particular point, which is the problem is that the nominal interest rate cannot be below zero, assuming that monetary policy is constrained by the zero lower bound. So then, whereas when you take that into account, then you find that kink. And then there is a level of debt below which you would hit the zero lower bound in the long run. So let's think for a second, what does it mean? That means that, most of us have been educated to think that there is a big danger of having very high levels of debt. But what this is telling you, and again, the number of assumptions, the model will have a particular set of assumptions, but in order to deliver this kind of thing, it is quite model independent. So I can get this in a very large number of different models. What this is telling you is that there is also a risk of having a low level of public debt. Because if the level of public debt, if you believe that, again, that the demand for debt is not perfectly elastic, that naturally implies that there is a level of debt, in principle, that can be so low that would be dragging down the natural rate. And by dragging down the natural rate can make that in the long run, you hit the zero lower bound. But then the problem is that if in the long run you hit the zero lower bound, if you think about the long-term Fisher equation, the long-term nominal rate equal the long-term real rate plus long-term inflation. So if your long-term real rate would be below 0, and your long-term nominal rate is at 0, the only way that this is possible is with an inflation level that is above your target. So then, essentially, you get what we call this attainable inflation objective region. So you obtain a minimum level. So essentially, you have that for every level of inflation target, you have a minimum level of debt. For any debt level above that, or for any inflation target above that, the economy can operate. But what you cannot operate is with very low levels of inflation target and very low level of debt. This region cannot be visited. I mean, in the long run, this is totally unsustainable. So that is just kind of a cautionary tale. And again, I mean, the number of assumptions is very reduced. So that is kind of exhibit 1. I will revisit the point about monetary fiscal interaction at the end of the talk. Then now I abandon the fiscal part because I mean, in a way I find it less original, and now I move to the monetary part. I mean, most economists have been trained in the assumption that even if money can be non-neutral in the short run, it is neutral in the long run. So the level of inflation, in principle, should have, this is not exactly true, not even in the New Keynesian model, but let's leave that apart for a second. So here what I'm gonna discuss is a different channel. This is a channel through which monetary policy per se can affect the natural rate. That is, the design, the monetary policy framework can affect natural rates, can affect long-term real rates. The channel essentially is again through a precautionary savings motive. But the precautionary savings motive in this case is related to the zero lower bound occurrences. This is something that already happens in model with representative agent, but that is amplified in model with heterogeneous agents. So the point, the idea in a nutshell is the following. During zero lower bound episodes, the central bank cannot provide the adequate degree of monetary policy accommodation. That is why, central banks have introduced this kind of unconventional monetary policy measures in order to try to compensate for this limitation of monetary policy at the zero lower bound. That means that zero lower bound episodes are typically deflationary and recessionary. If you think also in terms of heterogeneity, that has important redistributive implications because, that has been discussed very much, for instance, by my colleagues at the ECB. So there are winners and losers of this kind of deflationary pressures. And typically, wealth poor people, people who depend more on their wages, suffer more this kind of deflationary episodes at wealth-rich people who's in fact, if there is an increase in the real rate, vis-a-vis the counterfactual case without the zero lower bound can benefit. But leaving that aside, if that is the situation, so if the zero lower bound has negative effect for people, especially for poor people, what these kind of models would tell you is that people are going to try to precautionary save against those zero lower bound episodes. And especially, wealth poor people are trying to precautionary save even more than wealth rich people. So essentially, the more often these kind of zero lower bound episodes happen, the higher is going to be the demand for savings for people in order to protect themselves against this kind of recession. So essentially, what you don't want is to be a poor person in an economy that is hitting the zero lower bound often, and essentially, you are losing the kind of macro insurance provided by monetary policy. So that is the idea in a nutshell. Again, if the total amount of safe assets that people can use to a smoother consumption in these situations does not increase, this is going to increase the demand. So essentially here, what you would observe is an increase in the demand for debt, and that is going to reduce the natural rate. But then the problem here is that introduces this kind of feedback mechanisms. So this is what we analyze in another paper with Jesus Fernández Villaverde, Joel Marbet, and Omar Rakedi. Again, it's a Hank model. In this case, the particularity of the Hank model is not the fiscal block, it's the fact that it has an occasionally binding zero lower bound. We have to solve that using global methods. In this paper, we do it using the neural networks. And what we do is we analyze the ergodic distribution, and in particular, the stochastic steady state. The stochastic steady state is the steady state, let's say, the long-term situation of the economy, on this economy in which there is this aggregate risk, and people are aware that there is this aggregate risk. And then, coming back to what I was saying, the problem in the setting that I was describing before is that there is this kind of circularity. This circularity is related to the fact that if you hit the zero lower bound often, then people are going to demand these bonds. And then as they demand these bonds, natural rates are going to decrease. But then if natural rates decrease, then nominal rates on average will decrease, and then given the business cycle, you will hit the zero lower bound more often. And then you get this positive feedback in which the more often you hit the zero lower bound, the strongest the demand for precautionary savings, and the strongest then the decline in the natural rate, and the more often that you hit the zero lower bound. And there is this paper by Francesco Leonardo and Matthias Rodner, in which you can even fall into this kind of deflationary spirals. So you can even get in a situation in which this mechanism, gets totally out of control. Even if you are not in this kind of situation, here you can observe these kind of things based on, and now I retake my point, based on in that particular case, based on the inflation target of the central bank. So I remember during the previous strategy review of 2021 that in the euro area the problem was that we were systematically below our 2% target, that there were some central bank governors who suggested, if we don't reach 2%, why don't we make, and we are at 1.5% inflation, why don't we make 1.5 our inflation target? And then we will deliver on our target without having to do anything. What that would be telling you is that if you fail to deliver on your 2% target and you announce 1% target as your new inflation, then you probably move to a 0.8 average inflation. So it would be, your inflation would be moving with your target down and down in a nonlinear way through this mechanism. So essentially, here, what we are showing is for a continuum of inflation targets, so what we plot here is, imagine, creating this kind of alternative worlds. This is the long-term analysis so that is the ergodic mean in each of these worlds for different inflation target. And then in the normal Fisher equation that you will have is that the inflation target would map one-to-one to the average inflation, but this is not the case once that you get this kind of nonlinearities that bends. And then the nominal rate would just be the sum of the real rate, which would be totally independent of the inflation target, because again, would be something given by nature. This plus this is giving you that. In reality, what happens is that the inflation target per se is affecting the natural rate, the long-term real rate to be precise, through this kind of precautionary savings motive, and then this is increasing the frequency of occurrences of the zero lower bound. So then, the lower your inflation target, the more often you hit your zero lower bound. The more often you hit the zero lower bound, the more this long-term real rate bends downwards because of this precautionary mechanism, and hence, the more often that you hit the zero lower bound in the first case. That can be a theoretical curiosity. So that has not been tested. But there is something that to me was very interesting, and again, that was something that was mentioned by Francesco in his presentation this morning, which is after the announcement by the Fed of the ECB of their strategy review, and their strategy reviews in 2021 essentially had this kind of expansionary bias, so they were essentially telling the markets, look, we are not willing to systematically tolerate inflation below target due to the zero-hour bound, so we are willing to engage in this kind of asymmetric monetary policy response to combat that. Immediately after those announcements, long-term inflation expectations, like five-year inflation-linked swaps, started to lift off. And that was, that was before everything else. So it's true that it happened, many things happened, there was this huge increase in inflation, so it's not that easy to isolate that. But to me, that was something that was very characteristic because, it happened really at a relatively high frequency. So that at least gives me a certain grain of credibility to this mechanism. Then, just to say that, as I was saying, this mechanism is present in models with representative agent, but this is much amplified in models with heterogeneity, because that increases the motive for precautionary savings on behalf of the households. And then finally, the last part goes, not the last part, the third part, and there is a fourth part. We move again, now we abandon fiscal policy, now we abandon monetary policy, and now we are going to talk about shocks. So precisely by the definition that I was making at the beginning, this kind of natural rate concept, even in models, is something that is once a shock peter out. So how can temporary shocks affect the natural rate? But this is something that I was thinking a lot, especially since 2021, when there have been this apparent increase in long-term real rates. Why have long-term real rates increased? There has been a structural change in the economy. Maybe is that the case? So essentially, this is based on a recent paper with, I think we are, so this is based on a recent paper with Simon Scheidegger and Philip Renner. And the idea, again, is about precautionary savings. So what these three papers have in common is this precautionary savings. The savings, essentially, again, in Ricardo's presentation, this movement of savings does not need to come from structural reasons. It may come from policies, or it might come even from shocks. So essentially, the idea here is, 99% of the papers consider that shocks are autoregressive. But if you open the Bible, in the paper we start with that, if you open Genesis, I think it's Genesis 41, when Joseph was in Egypt, and he had to interpret the dream of the Pharaoh. The dream of the Pharaoh was that there would be 7 years of fat cows and 7 years of slim cows. The dream was not, there will be a year of fat cows that will decrease autoregressively with a ratio of 0.9 and will reconverge to 0. And then there will be again weak cows that they will reconverge. No, there were 7 years, and we don't know if the first year the cows were fatter or slimmer than the 7th year. But on average, we assume that cows were fat for the 7 years. And this is a limitation in general of the way that macroeconomists have been modeling shocks, because it is prevalent, this assumption, that shocks are autoregressive. So essentially here, the only thing that we did in this paper was to say, look, what if we engage in a war? We don't know how long it's going to be this war. Maybe it's 3 years, maybe it's 5 years. But this is not autoregressive. So how would the prescription of the standard New Keynesian model change in the presence of persistent, not of permanent? This is not a perfect foresight. This is not a war that is going to last forever. This is not an end of globalization that is going to last forever. This is not a pandemic that is going to last forever. This is something that is a shock, is unexpected, happen with a certain probability, it lasts for a number of years, but it's not autoregressive. It's just the only deviation. And then what it turns out is that in this case, that affects the natural rate, defined in the particular way. So the problem in this, with a figure, is very simple to show. So what happens here, just focus, for instance, in the blue and orange lines. Those are the ergodic distribution of the standard New Keynesian model, in which you assume that in addition to the standard autoregressive shock, you have that cost-push shock, that supply shock, come in two flavors. We call them normal times and bad times. And essentially, in bad times, costs are higher on average. And then they last for, on average, it's a Markov chain, and lasts on average for 3 years. And then it reverts back. This is a very complicated, even if it's a standard New Keynesian model, it's very complicated to solve, because then you need to use global methods in order to deal with that, and you can easily have to deal with 6, 7, 8 state variables. That is just an nerdy comment for those who like these kind of things. And then what happens in this kind of model is that then you get this kind of double ham-shaped distribution, because essentially, depending on which regime you are, all the macro variables shift. So you get the distribution, this kind of distribution associated to the AR1 shocks, but then you have this regime situation. And then in this regime situation, affects, and I will talk later about inflation, but affects the real interest rate. So essentially, you have different regimes for long-term real rates. So if you analyze the stochastic steady state of this model, there is no stochastic steady state. There are two stochastic steady states. And in each stochastic steady state, you have different real rates. So if you look at the yield curve in this model, in one regime, you have this yield curve. So if this is the yield curve in the deterministic steady state, now in normal time, you have this yield curve, and in the other regime, you have this yield curve. So every time that a bad thing happens or that a good thing happens, you have big jumps in the yield curve. And why? Because of precautionary savings. Because during good times, people know that bad times can happen. And then they try to precautionary save against those bad times. When those bad times happen, then people try to, they save less and they try to consume more in order to smooth consumption, because they know that those bad times are not going to last forever, and that eventually the war will be done and they would be able to save again. So that introduces huge shifts in the demand for savings that explain huge shifts in the long-term real rates, even if those shocks are temporary. And they don't need to last 20 years. They can just last, on average, 2 years. But then people don't know if they are going to last 4 or they are going to last 6 months. That is, and then that is the point that I was making. Just look at the blue line, which is the economy under a standard Taylor rule. When you get this kind of event, then you get these dynamics. This is with a Taylor rule, in which inflation can jump, but in particular, real interest rate can jump on impact. And then this is without temporary shocks. Then with temporary shocks, you have the standard pattern of autoregressive disturbances around that, okay? And then taking all this together, and in each of these papers, what we discuss is about which are the implications for monetary policy design. And we have, in a way, we have two. One that is shared by, but the first one is about the peril of Taylor rules. And that, in a way, connects for our American colleagues with any time that there is this proposal that central bank should be given by a fixed monetary policy rule, for instance, a Taylor rule. What these papers are telling you is that it is utterly impossible. Because the problem is that with one exception that I will discuss later, a standard Taylor rule includes implicitly, no matter what you have about deviation of inflation for target, deviation of output for target, but if you define the monetary policy rule in terms of nominal rates, then you have your inflation target, and you need here to have what is the long-term real rate that you target as a central bank. In the simplest case, the long-term real rate that the central bank targets coincides with the natural rate. So then, in a steady state, if I plug here the Fisher equation, the long-term Fisher equation, the long-term nominal interest rate is the natural rate plus the steady state inflation. And if R star equal R bar, this cancels with this. And then if the steady state inflation equal pi bar, this cancels with this, and everything is solved. The problem is that under each of the cases that I've been mentioning, if fiscal policy affects, if monetary policy affects, if shocks affect, then the intercept of the Taylor rule should be tracking the long-term rate. I mean, should be tracking the natural rate that becomes a dynamical object. If the central bank fails to do that, then essentially you get this kind of equation in which the long-term inflation level does not coincide with the inflation target. It gets an additional term that is proportional to what we call the policy gap. That is the difference between the long-term real rate that the central bank is targeting and the natural rate. That is, I mean, that is not the one. If you are used to think in terms of model, the first time that you see these kind of things is a little bit strange because you are always used to see those two objects as identical. But now we will see that markets don't seem to share that view that we can have as modelers. And then the problem is that if the long-term interest rate that the central bank is targeting does not coincide with the natural rate that, again, is a dynamical object, then the central bank fails to deliver on its, not only on the short-run inflation, but even long-term inflation expectations deviate from the target. Not because inflation expectations are an anchor due to any kind of fiscal consideration. I mean, fiscal consideration matters, but also monetary consideration of shocks. It's just because people understand that the central bank is not targeting the right long-term rate. So then, in one of the papers, in the first paper, in the fiscal paper, we tried to check somehow whether that was a plausible theory or not. And then, how did we try to do that? Essentially, what we do is we go to market data, and then we try to proxy the long-term. So we try to proxy each of these elements. We said, okay, which are? We know what is the pi bar. So we know which is the inflation for the Fed. I mean, we have done it also for the ECB. What is the pi bar? Is 2%. So the objective of the Fed is to have 2% inflation over the long run. Then, how can we measure long-term inflation expectation? We could do it with surveys. We do it using inflation-linked swap. Then someone smart from the room says, yeah, but inflation-linked swap are contaminated by term premium, whatever. Okay, we have, I think I'm not presenting it here, but in the paper we also repeat this whole issue, try to clean in every series from risk premia using these kind of standard models that people in finance have in order to clean series from term premia. And results are, I mean, they look smoother, less noisy, but are exactly the same that I'm presenting here. So then here you have the long-term nominal rates that can be taken from the forward rates, from the OIS, from the swap curve. Then you have the long-term inflation expectation, and then based on them, you can construct. It is possible to based on them, it is possible to construct this R star as the difference between the nominal and between the long-term nominal and the long-term inflation and the long-term inflation rates. And then using this equation, I can turn this. So I know this, and I know this, let's say that I know this, and then I can try to back up this based on that. If I know what is the slope of the Phillips, of the Taylor rule. That slope in the model can be computed using this kind of Sharpe's beta approach based on covariances, or you can just plug values, standard values in the literature. Surprisingly, this is very similar. And then what we obtain is that if you look here at long-term inflation expectations in the US, again, this is with premia, but without premia is similar, they have only been close to 2% in particular period of time. So long-term inflation expectations in the US, market-based, seem to have deviated from the Fed target. And you may wonder, but why? I mean, that doesn't make any sense. If the Fed is credible, long-term inflation expectation should be at 2%. Again, you can tell me, no, it's because of the risk premia, but you can do that without the premia. Then you can tell me, no, I don't believe these risk premia models. Okay, fine. Then we need to talk about other kind of things. But one way to rationalize that is that using this theory, it is possible to analyze this kind of policy gap. So that would be a measure of how the market perceives whether the central bank is targeting the right long-term, the natural rate, let's put it like that, whether the long-term rate implicit that the market expects the central bank is going to deliver coincides with the natural rate. And what we observe is that before 2012, this is the date in which Bernanke officially announced the 2% target. So before, the 2% target was something implicit but was not explicit. So after that, there seems to have been a period in which the difference between that is closer. So but again, especially since the COVID, seems to have been, again, an increase. So that could be evidence that since COVID, markets perceive that central banks are not adequately taking the pulse of the economy in terms of where do long-term real rates are going to be in the future. Maybe this is totally crazy. So I'm not going to try to push it at absolute truth at all. But to me, that was just a way to try to think about this kind of concept. So the bottom line, and with that I conclude, the bottom line of the presentation is, if again, I don't know how the real world works, but if you believe this kind of models, which essentially are workhorses models in monetary economics, so if you believe in the new Keynesian model, a small deviation from this model, such as introducing incomplete markets or persistent shocks or the zero lower bound, always open the door to this kind of precautionary savings motive. And those precautionary savings motive create this kind of links between, kind of short-term dynamics related to fiscal, monetary, or shocks that affect these long-term real rates. And if that is true, then the central bank faces the problem that either under optimal policy, it should be systematically adjusting its long-term, its degree of monetary accommodation perceived in the long term according to this kind of short-term policies, or otherwise it risks getting perceived by economic agents as not being able to deliver on its long-term inflation target because of this gap. And that's all. Thank you very much.
Thank you, Galo, very much for interesting presentation. Now we have Álvaro Aguirre. He will discuss this paper. Álvaro is senior economist at the Central Bank of Chile. He earned his PhD at the University of Pennsylvania. He has published in the Review of Economics Dynamics and the European Journal of Political Economy. You have 15 minutes, Álvaro.
Thank you. Thank you to the organizers for inviting me to comment this paper, or these papers, because there are three. So I'm from the Central Bank of Chile, so the usual disclaimer applies. My views not necessarily represent those of the Central Bank or its board members. So these are very interesting papers. I really enjoy reading them. They have a very sophisticated solution, numerical solution. I'm not going to talk about that, but just to mention it. Of course, my comment will be like add this and add that, but it will be very difficult given that the models are already very complicated. So the issue is how demand and supply for funds affect the equilibrium interest rate and how the central bank should adapt to those changes in the interest rate to achieve the target. What I like the most of the papers is the central role that they put on precautionary savings. And there's also a very relevant, like this, the existence of the zero lower bound is very central in the three papers, and it nicely, there is this loop with precautionary savings that I found very nice. So I will have only very general comments. There will be two comments that are related mostly to the quantitative results. And then if I have time, I will highlight another channel that I think is important when talking about precautionary savings. So Gallo showed this graph, and I think the three papers can be summarized using only this graph, and that's what I'm going to do. But again, I just trying to focus on the quantitative results and the different mechanisms that are behind the results. So in the first paper, basically, debt goes up by 10% of GDP, and the natural interest or the equilibrium interest rate goes from 1% to 16%. This is a Hank model, so there is a supply of funds with a positive slope, and the demand for funds is inelastic. It's just the level of debt, the public debt. And here they analyze then how the central bank should move, right, the intercept of Taylor rule to achieve the target. And also, they show how a very small level of debt will take the economy to the zone of the zero interest rate. The second paper emphasized much more precautionary savings. They start with a rank economy calibrated to have a equilibrium interest rate of 1.69%, and then they move to a Hank economy, so we can see what the effect of precautionary saving is on the interest rate. It goes from 1.69 to 1.5. Then they add aggregate shocks and the zero lower bound. And that shifts the supply of funds because of precautionary savings, okay? Together, aggregate shocks and the probability of hitting the zero lower bound increase precautionary savings of agents, and that will reduce even more the interest rate. So most of that reduction comes from the zero lower bound risk, not too much about from aggregate risk by itself. And this is the effect that Gallo was emphasizing, where the likelihood of hitting the zero lower bound increase precautionary savings, and that, on the other hand, increase the likelihood of hitting the zero lower bound. In this paper, they show how these effects depend on two two variables, the inflation target that of the central bank, and inequality, okay? So starting from the result that I just shown, which assume a 2% inflation target, if you increase the inflation target to 4%, then hitting the zero lower bound is less likely, there are less precautionary savings, and then interest rate, the equilibrium interest rate go up to 1.45. The opposite effect happens when they increase inequality. What happened here is that to obtain more inequality, they change the idiosyncratic shocks, right? And that generate more precautionary savings. And that, again, interact with the chances of hitting the zero lower bound, and precautionary savings goes up because of that. And we end up with an equilibrium interest rate close to 1.25%. This effect is, I think, is large because this is just the change in inequality, I think, for 4 or 5 years. And we know that inequality has been growing from the 80s, and so the effect of precautionary savings due to that should be much larger. Then the third paper is a rank economy. So, and this is related to one of my comments. There is not too much of precautionary savings here, as in the other papers. They start calibrating the economy to have a 1% interest rate on average. And they say there are two states, very persistent. One, bad times, good times. And the thing here is that in good times, you expect that it's like expecting a very big shock. So you want to save for the future. You want to smooth consumption, you save a lot, and that they take the interest rate to 0 in this case with the calibration they have on average. And in bad times, you expect the opposite. You want to smooth consumption, you reduce savings, and the interest rate goes up. So, and again, here they discuss what happens if the central bank doesn't follow this and uses like an average target for the intercept of the Taylor rule. And also they discuss differences between monetary policy under commitment and discretion. So as I said, my comments are very general. And the first one, maybe you notice, there is an inelastic supply of funds. Okay, so there is no substitution, and the suspect will be capital. Okay, so we know from some estimations that in this case, in this paper they estimate the effect of a shock on idiosyncratic risk, and they showed that liquidity goes up, but investment goes down. Okay, so that means that any change that generated by precautionary saving will have an effect on capital, and then we should observe some slope on the demand of funds in the graph I just showed. So that will not affect the mechanisms, but it will have different quantitative effects. And the second one is the strength of precautionary savings. So something that is missing is the correlation between idiosyncratic risk and aggregate risk. Okay, we know that it is countercyclical, so we should expect that an increase in precautionary savings when bad shocks hit the economy. This is especially important in the third paper, I think, because in the bad state, you are saving, your savings are very low because you are expecting good times, okay? But if we interpret these shocks as wars or something like that, I think that the risk on those times is very high. So I will expect to have much more precautionary savings. Again, the third paper is a rank economy, so that risk is not there, but I guess it will be even larger if we introduce this interaction. So with the help of the graph, my two comments will say that there will be a downward sloping demand for, and the precautionary savings should increase during bad times. I don't know what will happen in good times, because that will depend on all of the calibration. And again, if something like, I think a big shock like COVID will affect the saving decisions in good time as well. But but at the end, my two comments will have, again, will close that gap partially, and the quantitative effect will be different. So I think I have time, so I will take this claim from the authors. They say that any factor that changes precautionary savings will affect real rates and the effectiveness of monetary policy, to highlight another mechanism that links inequality and precautionary savings. Okay, and this is more like an political economy channel, where high inequality should lead to dispersion of preferences, and that translates into divergence of policies by different governments that will generate uncertainty and precautionary savings. So here you can see the relationship between inequality and dispersion of preferences using the World Value Survey. And you can see this cross-section variation, but this is true in the panel as well with fixed effect. It is nicer to show the graph. So more inequality leads to more dispersion of preference for redistribution. Then in this regression, I have as a dependent variable, this is a panel estimation with a fixed effect. As a dependent variable, there are fiscal variables. On the left, I have public transfers. On the right, tax revenues as percentage of GDP. And you can see that if you try to include the party in power, the identity of the party doesn't have any effect. It's not significant. So there is no significant divergence between policies that different parties implement. But if you interact this with the inequality, and here the Gini is normalized from 0 to 1, if inequality is high, so let's say it's 1, its maximum value, then they differ, and parties implement different policies, okay? So in times of high inequality, then it depends a lot of who is in power to explain the policies that are applied. Okay, so I claim that this mechanism should generate precautionary savings, and I can use elections as triggers of uncertainty and see what happened around elections. And so here, liquidity on the left goes up before an election. This is only in times of high inequality, and on the right, consumption goes down. Okay, so this is, again, these are, I think, periods in which this uncertainty is higher than on average, but this uncertainty should be persistent not only during elections, but also in different periods. So, what we have discussed in the conference, right, are the risk. Well, this is a figure for the US, but there are many countries that are experiencing something similar. So we have discussed the risk of, and in these papers in particular, high inequality lead to more precautionary savings, interest rates very low, and that should make monetary policy more complicated. What I try to show is something that goes in the same direction, but with a political economy flavor, which is high inequality also will lead to even more, maybe because of policy uncertainty, more precautionary savings, and that will be very relevant now that given those high level of public debt and the low level of the interest rate. And that's my discussion. Thank you.
Thank you very much, Alvaro, for your comments. Now we have time for questions from the public. Ricardo.
So let me make 2 points and lead to a question. So point number 1 is that the difficulty always with precautionary savings stories like yours is that we really struggle to quantify how large precautionary savings affects. We don't have great micro data on direct evidence, and it's just been very hard to pin it down. Point number 2, though, which is that models have helped us say that the big drive of precautionary savings in models tends to be really bad idiosyncratic outcomes, meaning it's much more driven by left tail shocks than really by variance per se. And this has to do essentially just with the concavity or the third derivative, really, of how we measure utility functions. Given these 2 points, it seems like a much more powerful way to drive precautionary savings, and again, subject to not knowing exactly their quantitative impact, is the fiscal policy safety net in some ways. It's really what will drive precautionary savings is me telling you, don't worry if we end up in a ZLB stagnation, I'll take care of your family, I'll take care of your very large tail risks in the case of unemployment or not. Given that, I'd want you to comment on why, I mean, raising the inflation target from 2 to 3%, 4%, wouldn't I quantitatively just get a lot more bang for my buck just by saying, let's just expand the safety net somehow? I mean, and it seems like, you know, we're in a conference of central bankers who are trying to get as much as we can from central banking, monetary policy, and inflation targets. It seems like a much more powerful lever here would be just to talk about how to remove very bad outcomes for people at the idiosyncratic level. And so we would see the extent to which we extend the safety net. 1, empirically, do we see changes in the safety net having massive impacts on natural rates? Question. 2, suggestion, should we really be focusing on fiscal policy as opposed to monetary policy when thinking about the problems you're highlighting, or maybe another channel of interaction, fiscal and monetary?
Gal, really a terrific presentation. I think you did a marvelous job. My question is maybe a bit blasphemous in a crowd full of people who do central bank research, but it's about precautionary saving related to what Ricardo said. But perhaps also implicitly a comment on Hank models in general, where it's typical that a lot of the precautionary savings just play a very important role in those models. And what I wondered about is, it doesn't, when you look at the data, I don't think, I'll go a little further than what Ricardo said. I don't think the data actually shouts at us that precautionary saving is extremely important. For example, if you look at sort of this longer history of what has happened to savings and interest rates coming down and so on, it's not that we are seeing those individuals who are at the highest risk by whatever measure, that they are the ones raising saving and that's pushing. No, it's the richest people in the world who are raising saving, who have every tool in the world to insure themselves against risk. So I think everything you said is, I believe in all of the results you're saying, but I'm questioning the channel because of, I think the channels are different, perhaps. The data, I totally agree, very much is suggesting non-neutrality of monetary policy. It also suggests that debt feeds directly into the interest rate and all of that. So I'm very much with, but I think it's the precautionary saving channel that, when you look at the data, to me, it suggests that this is not too important, but obviously, perhaps I'm missing something on the empirical side.
So thank you for the discussion, and thank you for the question. Let me go in order. So I mean, essentially, I mean, the summary of my response is that I agree with all the points, but let me develop it a little bit more. So about the point of the elasticity of the supply is a very important one. As you were saying, and leaving the point of the demand of the precautionary savings, one limitation of all these points that I were making is about how elastic is supply. And here, the paper by Christian Bayer and co-authors in the JME is a good example. I mean, making this taxonomy, because essentially in these models, if you assume that capital and bonds are perfect substitutes, all these things go away. If instead you assume that they are totally, I mean, unsubstitutable, then you maximize. So apparently the truth, or at least the consensus, seems to be in a middle point between them. So certain, I mean, there is this liquid assets in which these, I mean, capital liquid assets are not perfectly substitute. And then in that world, even if you don't have this perfectly inelastic supply, you get, I mean, it becomes relatively inelastic. But again, this is a quantitative point, and I think that not that much research has been made on the micro portfolios of people to see how really substitutable are those 2 points in order to see that point. But that in a way connects with Ricardo's point this morning about, or with a previous word that Ricardo has on this misallocation. I mean, on how much, I mean, what is the substitutability between debt and private investment? That seems to be low, and that explains also the gap between the returns. But this is an open question. In the new version that we have of the fiscal paper, we are addressing that more. I mean, trying to go a little bit more to the data. Then coming back to the 2 questions, I totally agree with them. And as you were saying, that goes much. So essentially, those papers, especially the second paper, is just kind of the corollary of the Hank literature. So the whole Hank literature is built on the foundation of precautionary savings. But I think that, as you were saying, I am the first one who have strong doubts. So I think that it's time to revisit how important precautionary savings are, because if they are not, I mean, you have spent 15 years developing a very refined theoretical framework that maybe has kind of clay feet. So that is a critical point. For the fiscal point, that is a little bit more general, as I was saying. But in general, I mean, I think that everyone agrees that the demand for debt is not perfectly elastic. So the mechanism can be different. But for the other 2, I mean, and the last one, even if it has complete mark, I mean, it has a standard New Keynesian model. Yeah, again, even in that kind of, so you don't need to go to incomplete markets. So even in that case, precautionary savings can also play, which is a point that sometimes gets lost in some of the discussion, especially in papers that I read from 20 years ago, that the point that even in the basic New Keynesian model, I mean, this precautionary motive can be strong, even if you don't, I mean, even if you don't have this kind of incomplete market at the micro level. But I agree. I mean, you can see them. I mean, or at least I see them as kind of games that I have played, given the current tools, in order to rationalize things that we observe in the real world and that to me were kind of puzzling and that I didn't buy. I mean, to me it was difficult to believe, for instance, that the increase on long-term real rates observed from 2020 to 2022 was due to the fact that people is now discounting huge growth out of artificial intelligence or green inflation, that suddenly climate change isn't. I mean, those stories to me are very hard to believe. So I can try to come up with things that go closer to the world I know, and that could be probably more possible. But I agree that the central macro foundations of this and of many papers nowadays are far from perfect. So I'm totally on that. Thank you very much.
Thank you very much, Galo and Alvaro. And
final applause. And now we have a 15-minute break, and then we come back for the last paper of this session. Thank you. But don't worry, this is the last paper, and then you could rest a little bit, and then we are going to have a very good dinner. So the third paper is the impact of climate change and geopolitical tensions on long-term interest rates. It will be presented by Elias Alvaglis. He is the director of Central Bank of Chile's Monetary Policy Division. Previously, he was director of Central Bank of Chile Research Division, manager of the Modeling and Economic Analysis Unit at the bank, and assistant professor of economics and finance at the University of Southern California. He received his PhD in economics from Harvard University. His work has been published in leading journals such as the American Economic Review, the Journal of Finance, Journal of Financial Economics, and the Journal of Economic Theory. Elias, the floor is yours.
So, thank you for staying. But I promise to keep your interest up for a couple more minutes. So, what do we do in this paper? This is joint work, by the way, with Sofia, Guillermo, Luis González, and Juan Blasiuk, all of which are here. So I'll let them answer all the questions, especially the hard ones. And let me tell you briefly what we do in this paper. So we're in a context where interest rates have been rising. The whole yield curve has been rising. And this comes after a decades-long downward trend, which stimulated a very heated debate. We had some of the most prominent backers of that debate in this same conference a couple of years ago. And we were talking about, secular stagnation and what it implies for monetary policy, and also what it implies for fiscal policy. Maybe fiscal policy, we need to think it in a more structural role rather than a countercyclical role. So it is in this context where suddenly we're hit with this change in the trend. And I guess the main question is, well, are we just seeing something cyclical because we had higher inflation and central banks tightened their rate eventually, and then we're going to go back to this trend? Or are there reasons to think that maybe this trend is likely to change? In this paper, we're going to take a very different focus from previous ones. There's no model in this paper. We're just going to count money. We're going to count expenses that are coming from essentially two main sources of investment that are either necessary or likely unavoidable in the coming decades. And we're just going to argue that the levels, the magnitudes are just huge. And therefore, the answer to that question is probably yes. Probably we will not go back to previous trends of low interest rates. And yes, we will probably see an increase in the natural interest rate understood as the marginal product of capital. Okay? Then we'll discuss a little bit how to make the link with monetary policy rates, and we'll argue that that's much more complicated. But for now, let's just focus on this first idea. So what is our argument? Our argument is that there are two big expenses or investments, you can think of as investments, that are either unavoidable, that being climate change investments, and others that are avoidable, but it doesn't look like we're going to avoid them. That has to do with the fact that we're seeing an increase in geopolitical conflicts, and whether we see a big war or not, it's like kind of 50-50, I don't know at this point. But certainly countries are preparing for that. And it's the preparation part where you spend the money. Of course, if wars, we have a major war, then this is another order of magnitude. But I'll leave that conversation when we get to that part. But it's just that the rearmament part of it involves significant expenses. And it turns out that when we put these two things together, and here I'll just give the magnitudes right away so that you get an idea what we're talking about. The climate transition that is consistent with the current pledges of countries implies that towards 2030, that's just like 5 years from now, we should be spending 5 to 6 US trillion per year, okay? And in defense, this is consistent with pre-war patterns of rearmament. We would argue that actually a conservative estimation is in the order of $1 to $2 trillion per year. So if you put those two things together, of course there are a bunch of other things that are happening, like investments in AI. We're not going to even put that in the table. These are just two things that we seem to be either spending money or likely to spend money in the next couple of years. And these are like super big. They're huge. So if you add them together, and actually this is a lower bound of the estimation, and I'll be very precise on why this is a lower bound. We add up, that's the counting money part, we add up to between 6 to 8 trillion additional expenditures per year towards 2030. And that's roughly 30% of current world investment. Okay? So before you say anything, or think anything, because I guess you'll say something when we get to the questions, but I know what you're thinking already. You're thinking, well, but you know, most of that money is from climate change. And we know that's not going to happen, right? I mean, we're not spending that money. So I know. We should be, but we're not. And we're not going to. It's very unlikely. And it's unlikely because it's a lot of money. And people, I mean, we are unlikely to spend that money unless, you know, the world is falling apart. But that's the thing about climate change, you know. It doesn't fall apart until, you know, eventually it does. And when it does, it's kind of too late. So we're likely not going to spend that money. But the point we're going to make here is that that does not, it's not like a magical door that you can open and avoid the expenses. It says that you are changing the nature of the expenses and the timing. So the timing is kind of easy. I mean, we don't spend the money now, we'll spend it later. But the interesting part here there are two aspects here that are interesting to remark. The first one is that conceptually, these are two very different things. If you spend the money now, you're spending money in protecting your capital stock. And that has a cost, and we can dimension that cost approximately, and we'll try to do that. But then, of course, that's probably not what we're going to do, so we're going to delay it. So path 2 is more likely, right? We're going to delay this. And if we delay it, then the cost that we pay is of a different nature. Because here we're paying to rebuild the destroyed capital wave after wave of destruction. So like Valencia, but like on steroids, and very repeatedly so. And this is a lot more money, like a lot more money. Actually, here I'm going to show you estimates that put it at 2 or 3 times the other expense, the one that you would do to avoid it. But I'm going to argue that these are actually an underestimation, that the effects are probably much larger. Okay? So yeah, I mean, probably we're not going to do this now. So, you know, the bulk of the effects that we're highlighting here, maybe we're not going to feel them in the next couple of years, but we will feel them eventually, right? Because then it's going to be a lot more money. And that's going to be a poorer world also. But we'll get to that. The second element here is rearmament, right? Whether we get into a war or not, we don't know, but countries are certainly preparing for it. And surely this could be avoided. But this is the part that is unlikely to be avoided, right? Because if you think about previous wars, has any previous war, like the big ones, ever be avoided because it's economically costly? I mean, the economic costs were huge. Countries still go to war. So that's not really a consideration. I mean, there are other considerations, and we're certainly no experts to say whether they're going to materialize or not, we're going to get to a big war or not. But we'll show plenty of evidence that suggests that countries are preparing for that conflict anyway. Okay? And that's the part that gets you to spend money. So, in a very graphical, simple way, what are we doing exactly in this paper? So in this paper, we are basically quantifying this, right? So we are arguing that there's an investment shock coming in the next couple of decades. We don't know exactly when or how much, but it's a lot of money. It could be a lot more. but it's certainly a lot of money. Even the lower bound is very significant. And then there's a market clearing effect where interest rates start to increase, and that crowds out other investment. So for those of you who are thinking, well, if you invest more in defense and climate change, you're going to spend less in other things. And that is true, but that works through the market clearing mechanism. It's not like you have an automatic shock that kind of undoes this effect. It's basically through the increase in the interest rate that you crowd out the other investments so that we reach an equilibrium. So that logic is true, but it's not a logic that will allow you to walk out of this problem without an increase in the interest rate. Okay? Now, a more interesting question is, how large is the effect on the interest rate? So here, just to keep your expectations well anchored. So we are not going to provide any estimates of how large the increase in the interest rate is going to be, right? We're just going to argue that this is very large, okay? And maybe lead that for some other quantification later on, okay? All right, so there's a long related literature. I'm not going to get into details. Let me just say very, very brief words. There's, of course, a lot of documentation of what has happened to interest rates, this long downward trend. And there's many prominent papers and lines of research that try to explain why this trend has been so, right? So we have the demand for safe assets, demographics, low growth, productivity, and so on. And so there's a very large literature here, some of them pointing out to a possible reversal of some of these factors, okay? That'll be important for our argument, of course. And then there are, like a separate literature, trying to quantify these two key drivers of the action. One on, well, how costly are the climate investment needs, and there's different estimations of this, and how large are the macro effects of geopolitical conflicts. And basically, what we're going to do is we're going to do like a review of this literature and put these things together and add them up. That's it. That's the plan. Great. So I'll start with climate change, which is a very low estimate of this is in the order of 6 trillion per year. Then the pre-war rearmament, again, a conservative estimate is between 1 and 2 trillion per year. Then we'll discuss what we think are the most important issues here, which is timing considerations. Okay? We know that it is unlikely to happen right now, so I want to develop further the implications of what happens if we don't do these investments now and we delay them for the future. And finally, some words on how to link, or the difficulty of linking the marginal return of capital to actual monetary policy neutral rates. Those are completely different animals, and there's some considerations for there to take home. All right, let's start with climate change. So this is a little bit of the picture where we are. I don't know if you've seen this graph. There's many versions of this graph, but they all say the same thing. This is what we need to do to achieve Paris. Actually, Paris is like a range, right? It's between 1.5 and 2. This is what we're doing now. No, sorry. This is what we are promising to do, which is different. That's the current NDCs, the nationally defined contributions. And the red line is the business as usual. So that's probably what we're doing now, the business as usual. And the other are the promises, and as you can see, the promises are not even enough to meet the Paris Agreement anymore. And they're just promises. Still have to be delivered on. But anyway, those are the trajectories, possible trajectories of greenhouse gas emissions, and what they imply for temperature rise. So current NDCs imply an overshoot that a lot of research actually puts in the neighborhood of 3 degrees Celsius before we actually converge to, once we reach to net zero, whenever that is, we maybe can go back to something like this. But there's a temporary overshoot anyway. And what's on the right-hand side is a figure that maybe you've seen elsewhere. This comes from the Climate Policy Initiative, which is going to be one of a very important data source for us. And this is what they say. Look, here we are. This is the last survey that came out at the end of the last year. that basically sees the progress in 2021 and 2022 compared to previous years. And actually, you see a lot of more investment in the last 2 years in climate change, mitigation, adaptation, other aspects. But the point they make is that what's currently in the climate goals basically require countries to do like this jump. Okay, so go from 1.2 trillion per year to in the order of 9 or 10 trillion per year towards 2030. Okay? And what we're going to do here, that's why this is the lower bound, we're going to use literally the lower bound of this estimation, and we're going to compute our effects, or we're going to count the money that it's implied in the lower bound of these effects. And why is that? Different reasons. Maybe we want to be conservative, and also because we are going to try to redo these calculations with other sources. Okay? And other sources, we actually find that the effects are a little smaller and are closer to the lower bound here. Okay? So there are two reasons for using that lower bound. This is how we add up $5 trillion. Okay? So this is basically probably the main graph in the presentation. $1.7 trillion is what you need to invest to change the energy matrix, how you generate energy. This is the electricity generation, basically. Okay? It's a generation, and I'll show in the next couple of slides. It's a bit more than that, but it's essentially that. Okay? Then there's another, and very importantly, this is additionally from what we are today spending in general in energy systems in the world. Okay? Because we want to capture the additionality, right? Because if we spend less in fossil fuels and more on that, well, it's just money. So this is just the additionality part. Okay? And the 1.6 trillion, which is right next to it, is what you need to do in other sectors so that they become more electrified. So one thing is that you need to change how you produce electricity. The second is that you need to use electricity in a lot more things than before. And for that, you need to change systems in general. So you need to change how things are produced in industry, in transport, and in other sectors. Okay? So that's kind of an $1 promise as we get to 2030 in increasing your resilience. So this is basically what we call adaptation. Okay? And then next to it is just $0.5 trillion to rebuild destroyed capital, right? Because, well, climate change is already destroying capital. So how large is that effect? Well, according to the sources that we are citing here, not very large. So 0.5, this is like 0.5 of GDP, but then this is you need to compare it to the stock of capital. And stock of capital is what? At the world level, I don't know, it's like twice GDP more or less. So that's like 0.25% of GDP. So that's tiny. Okay, this is a small number. And I'll give more arguments of why we're pretty sure this is a tiny number. So basically, these two are well estimated, but these two are not. And they're not like, there's just uncertainty. Of course, there's uncertainty, but there's a bias. And the bias is clearly downward. And I'll give more elements of why we think that is the case. So a bit more detail on the key elements here. Renewable energy, that's the first, the $1.7 trillion that was in the figure, the previous figure. This basically comes from new sources of clean energy generation, but also augmenting grid resilience, okay? And also storage and transmission. So it's not only generating, it's also transmitting and storaging and so on. And essentially what we need to do is to double the investments, and that gets us close to tripling the capacity of renewables in, say, the next decade or so, okay? Let me just go to the second one, which is the transformation in industry. So what are the main expenses here? Essentially, there are like three categories that are the most important ones. The bulk of it is buildings, okay? Investing in buildings. This means retrofitting buildings, and of course that every new building that is built now has to do it with different standards so that it can be electrified more and doesn't use fossil fuels and so on. So that these scenarios assume that the share of deep retrofits is in the order of 2 to 3% per year of total buildings. so that's buildings. Then the second one is transport. Transport is also a big one. You need to basically change, once you change the energy matrix, you need to change the cars. You need to change the buses, how they operate. And essentially this assumes that electric vehicles are sales are gonna triple. Essentially 70% of new cars and more than half of buses and trucks sold are electric in the next, towards 2030. And this is also kind of consistent with the pledges the country have made and the plans and so on. So that's, I would say there's a fair understanding of how large this effort has to be so that most of the energy that we consume is actually electric, okay? Let me go to the third element here, which is adaptation. So what do we mean when we talk about adaptation? So climate change is the distribution in the realization of weather events that's multidimensional. So one of those dimensions is that the sea level is going to rise. And some countries are, have a pretty large coastline. So I don't know if you are familiar with one of those, but yeah, that's us. Basically, it's all sea, right? So you have to protect coastal zones. Basically, all the infrastructure, roads, right, irrigation systems, you name it. Then, infrastructure in general that could get destroyed by natural disasters, you have to protect. You have to take measures against river flooding. There's also adaptation to health and early social protection. There's adaptation in agriculture. So there's a long list of things that countries have pledged to do. Okay, so the numbers that we're showing here come from the nationally defined contributions that not only set up a target for emissions, there's a broader plan of how we're going to get there and how much we're going to spend in adaptation and so on. So let me tell you two things about those plans. The expenses in adaptation are tiny. Okay, then this is an issue that's been raised in basically all the COPs, and so the climate change COPs, the biodiversity COPs. I mean, this is like a very stylized fact. Okay, so there's not nearly enough promises in adaptation, because and we're seeing it now. Essentially, the damage from climate change is much larger. Actually, the next slide is on that, but so let me just jump directly into that. Because that's the fourth expense, right? These two are very linked. So how much money do you have to spend to rebuild the capital that gets destroyed? Well, that gives you an idea about climate damages. And if you want to avoid climate damages, you need to be doing more adaptation, right? So to protect your stock of capital and so on. So there's some elements in this slide to argue that the damages that we are assuming here, which are $500 billion per year in 2030, are actually very low. Okay, so it's way like an underestimation for sure. This is just the global reconstruction costs from natural disasters. Okay, so these are all disasters excluding earthquakes. And you can see that basically these things have been increasing, and I mean, depending on what year you take, you get a 7-fold, 10-fold increase in just the frequency, the severity, the cost of these damages. And then there's this very interesting paper by Eduardo Cavallo and co-authors from BID, from AIDB, that basically study the impacts on the public debt of Caribbean countries of natural disasters. So why are we using Caribbean countries? So Obama had this very nice saying that the countries in the Caribbean are like the canaries in the coal mines, right? Because those are the countries that are really feeling the damages that we're going to feel later on. So this is a very good lab experiment, if you want. And what they find is actually I don't know, surprising, or I don't know if surprising, but definitely large. They find that after a country, the average country in the Caribbean gets hit by a severe storm, 3 years afterwards, the increase in public debt is sort of 10% larger than without the shock. And this is for one storm. So imagine these storms that used to occur every 50 years now occur every couple of years. And they're more frequent, they're larger, And the other important thing about this is that when they happen, you cannot kick this can down the road. This is not a mitigation. This is like people on the streets throwing potatoes to the king, right? I don't know if they're throwing potatoes, but like people are angry, and you need to spend this money right now. And that's what countries do. They spend the money, and it's 10% of GDP in 3 years. So, you know, this basically, what this tells us, I think, is that thinking that the damage of climate change is going to be 0.25% of the stock of capital per year is just ridiculous. Okay, that's just an underestimation, a severe underestimation of the effect. Okay? And that's essentially what we're assuming here. But that's because we don't have a better estimation. That's just the only estimation that we found. And but there's a general awareness that these estimations are not realistic and you need to work on them. Okay, so let me briefly say a few words on pre-war rearmament. That's the second main driver of these larger expenses. So there's this interesting argument by Dubik, which describes what are the key elements, like systematic elements that you can pinpoint that have tended to produce large-scale conflicts in the world throughout history. And he points to technological change, so basically weaponry, right? Inequality, so there's angry people. Multiple global competitors, so it's not clear who's the boss, so that's not clear. Conflicts are more likely. And very important, when there's evidence of success in using force to achieve goals. Like say, a large country invades the neighbor and gets like mild support from other countries and they start winning the war, right, after a couple of years, like what's happening today. So it seems like we are in basically that situation. And we argue that by just showing these simple plots. Well, this is the broader argument, right? So this is an index of Navy concentration. I guess they use that because it goes back, it goes way back, right? The naval power. And you can see that you have this distinct episode of first Portuguese domination, then the Dutch, then the British, then British second episode, and then the USA. And you can see that before each of these major wars that are basically with the vertical lines here, you had a dwindling in this concentration of power, right? So basically, it's not clear who is the dominating force. There's some open, up for grabs, and that seems to be a very powerful incentive for conflict. There's just the same thing for a shorter time horizon with the U.S. Composite Index of National Capability. So this is basically U.S. expenditure in defense more broadly, not just naval, right? And then compared to the other countries, and you can see kind of the same thing, right? So the U.S., after being prominent right after the Second World War, has been considerably declining in terms of relative importance. And the last picture here actually shows what's happening at the margin with, well, I mean, how likely does it seem that we're going to end up in a conflict, or a country that at least do they have good reasons to fear one? And you can see that, for example, this yellow line, this is the GRI military buildup index, right? So basically, this is comes from compiling different data sources on military spending, but also news about it. So it's a kind of a comprehensive indicator, and you can see that's basically shooting up in the last couple of years. And it's not hard to imagine why. We have a bunch of other slides in the appendix. But basically, well, let me just show you. No, wait, no. I'll jump to this, and then I'll come back to this one. Countries are still not expending that much more. I mean, at least most countries are not. But you can already see in their plans that they are planning to do so, right? So there's a lot of discussion on countries not meeting the NATO spending target. And there's a lot of news coming out of what each of these countries and their parliaments are now deciding legislation for, rearmament in the next couple of years and so on. And you can see that basically we are entering a period of rearmament. And I think there's very little doubt about that. let me just go back to the previous slide and show you. This is our main calibration. That's where we get the 1 to 1.5 or 1 to 2% of GDP expenses in war. This comes from an event study that's made in-house. And basically, we go and study all wars between 1830 and 2007. And basically, we see what happens to defense spending in terms of, as a percentage of GDP, starting from 5 years before the war to 10 years after the war. Okay, so we do the whole event study. And what does it show? It shows that, around 5 years before a major conflict, countries start spending around, 1 to 2% more GDP in defense. And then if you actually get to a war, then that expenses, of course, naturally increases much more. And then that gets sort of built into a system, I don't know, the intelligence services are created, and there's a very large body of people that are now employed in the army, and that has inertia, right? So it doesn't stop immediately after the war. So you get like another 5 to 6 or even 10 years of higher expenditure in military. And here in this table shows you what happens to public debt, actually, around those episodes. So this is cumulative. So the year before the war, you already are like 4 or 5% higher debt to GDP. If you go to war, then it's when the war ends, you're going to end up at 15%. But then after 5 years after the war, that's the inertia part, you have accumulated 40% extra in debt to GDP. This is just the US, okay? And that's the numbers for the advanced and for the emerging countries. So essentially, this is where we get the number from. This is just from seeing what are the pre-war rearmament trends in terms of expenditure in defense. Okay, that's where we're getting the number. And this is also something that we did in-house, which is kind of interesting, I thought. So wars are like the essential risk-off episode, right? They have just one tweak, the traditional ones, that depending on where the war is, they can also increase the price of oil. But typically what risk-off episodes, and certainly risk-off episodes related to war, what they do in financial markets is that they depress stocks, right? They imply a retrenchment of capital flows from emerging markets, and then generally a flight to safety. So basically you see compressions in interest rates at the long end of the curve, okay? But what we show here is that, this is just from two ways of identifying this. So the event study, another event study. This is very discrete episodes of increased tensions in different wars. And you see that the 10-year rate in the US mostly declined. So it declined by a lot or by a little or didn't move much, okay? But then in the rightmost part of this figure, you can see the events of the last 3 years. So Russia, Ukraine, increasing rates. Israel, Iran, we have a couple of episodes here, and you see increases in US rates. So that's interesting. I mean, why are rates increasing if this is a typical, I mean, certainly a risk-off episode? And there's another way of doing this. This is a structural decomposition from structural VARs, or semi-structural decomposition, that uses very high-frequency financial variables. So basically, you use of course, the stock market. You use the treasuries, short-term rates, but also you use, for example, stocks of firms who provide defense for the US government, right? So with that, you can do a clean identification. And the identification also shows that since the invasion of Russia to Ukraine, you start seeing this little fire here. It's the red columns. That's basically the effect identified by this methodology of geopolitical conflict on interest rates. And you can see that it's actually positive. Okay, so basically what we find from the event study, which is rough, just sort of a way of motivating this, is actually also confirmed by this structural vector autoregression, which is kind of interesting because there's not a lot of talk about this, okay? But what is the interpretation behind this? I'll offer my interpretation, and we can talk about whether you agree with that or not. It seems that previous conflicts are, or were perhaps, taking as more isolated events. But the conflicts that we're seeing now are not really isolated events, right? They are basically events that are lining up in these increased geopolitical tensions between what are becoming to be two very distinct axes, if you want. So NATO and the West versus some loose confederation between China, Iran, North Korea, Russia, and also some countries in Africa, the Cook Belt and Venezuela. I don't know if they're going to get into it, but they're kind of in that neighborhood. So it's not like isolated events. And therefore, it's not crazy to think that once you get a particular event in the Middle East or in Ukraine or so on, like markets are saying, here we go. Like this is going to be a lot more money. So there's like these tiny signals that say we're going to spend more money on this, not isolated events anymore. So that's just one, of course, that's a hypothesis, no way of proving if that is the logic behind it. But at least the empirical evidence with two different methodologies seem to point in that direction. This third section is actually quite important. It's not very long, but it's important. Timing. Okay, we talked about timing already. This is a lot of money to spend in the next 5 years to we reach 2030. So we're not really saying that we're going to spend this money. I mean, it will be very unlikely, at least in the climate change part. But what we want to, the point we want to stress in this figure is that that's not good news. Okay, that's actually terrible news. It's terrible news because the damage, they're going to come a bit later, the costs, but the damage are just a lot higher. Okay. So basically, this is what comes from also the Climate Policy Initiative. And this is what they take to be the cost of the 1.5 scenario. So if we actually spend money protecting our current stock of capital, as we should, this is basically adaptation, mitigation, and we really do the job that we have promised under the Paris Agreement, then we limit ourselves to the 1.5 degree scenario. Of course, that's a lot more money than the 5 trillion that I told you about. This is like 10 trillion, because this is literally the better part of the climate agreement, okay? But you can see that although that's a lot of money, that's a lot less money than what they find would cost in not doing that. If we don't do that and we go to the business as usual, where the world warms between 3 and 4 degrees Celsius, that's the business as usual, basically, then after 2025, the costs start mounting, and when you reach the 2100, the costs are just massive. This is in trillion. So I thought that the axis was wrong, and Luis had to convince me that no, this is right. But it's just that we have to divide by the years. But still, you get like a massive number. It's like 30 trillion of cost per year. So this is like 30% of GDP already. Okay, so this is a big number. Now, this big number comes, to be fair, from taking the upper part of the simulations that are currently available. Okay, and the Climate Policy Initiative argues why they're doing that. Why they're not taking the central estimation of the damages, but taking like the upper limit of the estimation. And I think we agree with them. The reasons are the following. What is considered in this estimation? Okay? Impacts on productivity. Basically, it's hotter, so people don't work as hard. So effect 1. Damage to assets and physical capital. That's just a distraction, and you lose a little bit of potential output. Loss travel and tourism and health and well-being quantified in money terms, and that gives you these cost estimates. And there's different models, and some give like very little effects, and some get bigger effects, right? But what are the things that they don't include? And the Central Bank of Chile just participated in writing this report by the NGFS that came out last week, and you can download it from the NGFS website, that essentially makes a review of climate change models, right? And there's one, like we have a box in that chapter that essentially makes this point, right, with more evidence and references. There's a lot of things that current modeling do not include by construction because it's hard, okay? So all the losses that are due to stranded assets, all the losses to nature and biodiversity and the collapse of ecosystems. These are not, because this is a climate change conversation. So all those elements are, not taken into consideration. All the losses that are going to arise from conflict and migration. And I'll have a slide on migration next. And most importantly, they do not consider tipping points. Okay, so basically all these models are kind of linear. You get damages, but if you reduce emissions, which we assume that eventually, all these trajectories assume that eventually you go back to net zero, it doesn't matter that you overshoot the targets. Well, but in reality, it does matter. It matters because when you overshoot the targets, nature doesn't behave in this linear, kind of self-stabilizing way. I mean, if we know anything about nature, it's that it's the opposite, right? But we know that, but it's just too hard to model. So we model things with the tools that we have, not with the ones we wish we had, right? So that's like a very robust finding that comes from this literature. So I think they are right in using the upper bound of what the costs are. And actually, we still believe that this upper bound is not making justice to the costs that will arise. So let me just give you a brief motivation why we think that is the case, because this is the most important conversation of this session, I think, or at least this paper. Sorry, I mean this paper. Let me give you a little flavor of what is the feared tipping point scenario. Okay, it's like what you could call the deadly triad. Okay, this is basically the reinforcing collapse of three systems that have global implications. The first one is the Amazon. So basically what's modeled here is the transition of the Amazon from a tropical rainforest into a savanna, which is a fancy way of saying that the thing gets burned out. Okay, that's what basically we're saying. It's going to burn. Okay, the hectares that were not burning on purpose, they're going to burn by accident, because it just stops raining in the Amazon. And it stops raining because there's too few, the density of trees it goes below some critical threshold. And the Amazon gets burned. So that's one of the pillars of this triad. And that, of course, releases, they calculate maybe 90 gigatons of carbon. So that's like 2.5 years of global emissions at current levels. So basically you get I don't know how long it would take, but you get like an instant release of 2 years worth of CO2 to the atmosphere. So basically what that does is it dramatically accelerates the melting of ice sheets in general, in particular in the North Atlantic. So that's the second pillar. So basically you get a lot of water that is now, all these glaciers are melted, and basically you get this sweet water in the North Atlantic. And that gets you to the third part of the triad, which is if you dump these massive amounts of sweet water in the Atlantic, you're going to stop the thermohaline circulation, which relies on difference in salinity. Okay, so if you stop that, basically the water system in the North Atlantic stops working. And why is that important? Because this massive amount of water, what it does is it basically shares the heat from the equator with the cold of the North Atlantic. So it basically acts like an automatic stabilizer, or not stabilizer, but it reduces the extreme temperatures in these two latitudes that we would have otherwise. Okay? This Atlantic circulation has stopped in the past. Actually, when it did, that's when it started circulating again, that's when the Holocene started. That's the event that started the Holocene. It's that important. So it's not like a small thing. And basically, what this graph shows is how many people are going to migrate if that happens. Okay? And that comes from a calculation that we did in last year's conference, in the paper we presented last year. And it's in the order of 1 billion people, more or less. And the interesting bit is that people are now migrating from the equator, but actually a bunch of people are migrating from the rich countries, because the rich countries basically freeze. So you cannot live in Paris or in London or in New York anymore, okay? Because it's like 10 to 14 degrees Celsius less on average. That's the effect of this. So is this happening? I mean, there's a bunch of papers that actually show that the AMOC circulation is already slowing down significantly. And now they put a range of years that they could basically stop. And it's not after 2100, but it's actually starting in 2030. So between 2030 and 2080, that's the range that they give now. And this is a paper in Nature, so you might want to read it. It's like, this thing could happen already. Anyway, so it's big. Just one slide on this. So all these things seem unavoidable, but what's avoidable is how much money we're paying on fossil fuel subsidies. And that's, what do you know, 7 trillion per year. It's like almost the same, exactly the same. So, of course, this is very unlikely to get rid of, but if somehow the world got around doing it, then that would pay for the other thing. Okay? In the, oh, that went fast. Okay, so I have like nothing, 2 seconds. That's it. I don't have any more time. So let me just say very few words on other elements that might affect long-term rates that we are not considering here. So, of course, there are demographic trends that are very important. But if you read this recent literature, actually the effect is ambiguous. It's not clear that demographic is going to buy you lower interest rates anymore. It could very well be the case that it's the opposite, but it's at least ambiguous. Then you have the savings glut, especially in emerging market economies, and essentially this argument is that it's at the very, at the best, it's a lot weaker than before, and actually it could also be going in the other direction. And finally, there's the risk aversion. Of course, if all these bad things happen, well, there's the other papers that we've seen today, right? And people are probably going to save more. But we have a calibration. It's in the appendix. It's actually using a Gallo's paper that shows that you would need like a huge increase in idiosyncratic income risk to get people to save in order to be on the same level of order of magnitude as the other expenses that we're showing. Okay, so it's unlikely. I mean, it's probably going to help, but it's just peanuts, not large enough. And I'll finish with this slide. Basically, the point that we're trying to make here is that without having a macroeconomic calibration to tell you what the effect on the marginal product of capital is, these two sources of expenditures are very likely to increase that marginal product of capital. So basically, the risk-neutral rate more generally. How do we translate that into monetary policy rates? That's a lot more tricky, and we've seen some papers today that basically speak to that complication. So basically, what Ricardo was telling us about earlier, right? You first have to convert interest rates in the broader economy to the yield curve, and then you have to walk yourself from the long end to the yield curve to the short end of the yield curve, and those are not trivial exercises. So we're not saying that this implies like a very significant or immediate increase in the monetary policy neutral rate, okay? But we are certainly saying that the forces tend to be operating, at least from these arguments, into increasing the natural rate of interest more broadly. This is just a table that summarizes our current estimation of the neutral rate for the monetary policy effects, which we already increased, by the way. The board already increased this by 50 basis points cumulative, but in the latest revision, we just kept it constant. So to conclude, the climate transition will likely ramp up, and defense spending imply a lot of expenditures, roughly 30% of what we invest today. The climate change transition is probably not going to occur, not at the speed that it needs to, and therefore we're going to kick that cost down the road, but then that's going to imply a lot more money. One single policy could actually net out the bulk of these expenditures, which is removing fossil fuels, but that's also highly unlikely. There's a reason why they're there, right? It's politically very tricky. Other elements can also affect savings investment equilibrium, but we think that they're either ambiguous or smaller in magnitude. And this is a point that we didn't touch upon, but a large part of this spending is likely to be financed by public debt. So there you go. And there's another element to add to this fire. Anyway, I'll stop here. Thank you.
Thank you very much, Elias. Now we have Javier Garcia Chico discussing this paper. Javier is Associate Professor at Universidad de San Andrés. He holds a PhD in economics from Duke University. His work has been published in the American Economic Review, the Journal of International Economics, and the International Journal of Central Banking. You have 15 minutes, Javier.
Great.
Well, thank you very much for the possibility of discuss this paper. I used to work here at the Central Bank of Chile, and it's nice to be again here with all the friends. Actually, Elias used to be my boss, but he's not anymore, so let's see how this goes. Okay, so the paper in a nutshell is, makes this relevant point that if this large investment requires to achieve climate transition, plus the likely defense spending that might be triggered by a more conflicted world, is going to put upward pressure on interest rate, and this particularly R-star, this key relevant rate for monetary policy. So in a way, this puts a particular perspective on how these two issues should be relevant for monetary policy. And what they do is they survey the literature that attempts to quantify this cost, and they arrive to a staggering figure, and as Elias mentioned, this is kind of a lower bound of between 6 and 8 trillion dollars per year, around 25 or 30% of current global investment. So this is a lot, okay? So what I'm not expert on the climate part. It was really interesting for me to read these things, because I was able to see how people try to quantify the things, and eventually, and I think when the paper is out, it's going to be a nice compilation of these features, so let's go for that. The military spending is a different flavor, and they have done a bit more own exercise or in-house, as Elias mentioned. But as he says from the beginning, there is a lot of significant uncertainty on how much this spending and at what pace would materialize. So it's hard. I don't know, we have an election in the US tomorrow, and I haven't seen in the campaign too much discussion about climate change. Eating dogs and all things, I don't think they're related with climate change. But I want to play the game. I want to say, okay, let's consider the consequences of such a scenario. And my point is going to be that if I'm a central banker and I see these figures, kind of, okay, I understand that the real interest rates are going to increase, but probably those are not going to be my main concerns. So I want to explain what are the challenges that I think such an increase in investment, particularly if it's financed publicly, are going to put on monetary policy. So this is going to be my first part. Then I'm going to discuss some consequences for developing countries in particular, and then I'm going to throw a suggestion for some empirical estimates at the end if I have time. One thing about the energy transition is that I think it's going to put a lot of pressure on monetary policy, because transitioning from, say, brown to green energy is probably going to have direct effects on inflation. So Elias was pretty eager in the last, previous to last figure about saying we have all these subsidies that we can eliminate, okay, to finance all the other things. Well, that's going to be inflationary. So either because you impose taxes to try to discourage brown energy, or because you reduce the subsidies, that's going to have a direct impact on inflation. I'm going to talk about fiscal policy in a minute related to that, but this is going to have a direct impact. And this is our typical supply side shock, and it's not going to have a trivial consequences for activity, so this is going to be challenging for central banks is materialized. In a way, probably it's a larger version of what we saw a couple of years ago with the Ukraine event, okay? And there are some really nice DSG-based analysis, quite recent, work by Hasler, Crucero, Roslov, or Del Negro, and co-authors, Nakoram Thomas, and this paper by 3 people from Carlos III, Obriado, Papa, and Seoane. They try to establish what are going to be these trade-offs in the transition to a green energy-based steady state. And one thing that makes this more likely, and that's precisely what Elias was arguing, is that besides, of course, these taxes on brown energy or eliminating subsidies have climate-related benefits, they are a source of revenue. So this makes me think this is more likely to be implemented if eventually the transition is the climate-based transition is going to happen. So if I were a central bank, I would be worried about this a lot. And then let's say we pass that. I think there is a lot of uncertainty about green energy prices, which probably are going to be eventually a concern for central banks. Luckily, we're going to be in a much better world without all the climate damage, but still. So one thing that is at least not obvious to me is whether the marginal cost of producing green energy is actually smaller to the marginal cost of the energy we have now. I read some papers that argue they are going to be, the marginal cost is actually smaller to say like a solar plant relative to drilling oil. But then at the same time, this transformation requires a lot of initial investment. So if this is going to happen through the market, I think that for any company to try to take on this endeavor, you're going to have to give them a lot of monopoly power to justify this initial investment. It's not just, okay, price equal marginal cost in the future. So will markups for energy be larger than what we have now? And then the other thing with green energy is that, at least in my mind, all the applications that I have seen, they seem to be less tradable. So you have solar energy, you cannot take solar energy from say Texas and sell it to a country in the Caribbean. So it's going to be less tradable, and that's going to have an implication for prices. And it's not obvious to me how it's going to impact. Probably because if it's less tradable, it might be higher prices. I don't know, the marginal cost argument can help. But then there might be an issue of level of volatility. Because if it's tradable and I'm an importing country, I'm suffering all these fluctuations from all events all around the world for oil prices. I'm not going to be suffering that anymore. So maybe I'm paying higher prices on average, but I'm reducing the volatility. Again, this is not obvious to me how this is going to end up materializing, but again, I think it's going to change the game for monetary policy in a significant way. The other big concern, if I were a central banker and I see these numbers, and if there is a lot of argument that this is going to be publicly funded, is that my independence is going to be threatened, okay? And a couple of points about this. The first important point is, suppose Elias showed you these numbers, these are going to count as what we call in public finance the primary deficit. If this is financed with debt, this starts accruing interest, so the total deficit is going to be larger, and even more so if interest rates go up. Okay, so the amount of money that needs to be financed is quite significant if you look at these numbers. Okay, so in general, we know there are going to be trade-offs for monetary policy between inflation control and debt stabilization. And this all goes back to Francesco's presentation today. So if you increase interest rates, okay, you have money, you can control aggregate demand as the usual channel, but then you're also increasing the interest rate the fiscal policy have to pay. And there's a couple of nice recent papers on what I call like unpleasant New Keynesian arithmetics, that even if you're not going to take like Sergeant Wallace type of argument, and I'm from Argentina, so I know that we can print to finance deficit, and you're not going to take like fiscal theory argument, even in those cases. So suppose people think that in the future they're assigning a probability that monetary policy is going to change and is going to be more accommodative to try to help fiscal policy reduce the burden of all these increases in debt. So it's going to have like debt stability goals. The ability to control current inflation is limited because, okay, you have the aggregate demand channel, but at the same time, you increase the real rate. That increases debt, and that's going to make the need for inflation more likely in the future, okay? So, and inflation becomes endogenously more persistent. There is a nice paper by Saki, Vigio, and Carampa, and Silva, quite recent on that. And moreover, if this perceived probability that people start thinking is increasing in the stock of debt, because you say, okay, the higher is the debt, the more painful is to implement a tax reform to pay for that, you can have equilibrium multiplicity, so you suddenly can have like potential self-fulfilling rollover crisis. So this is not an auspicious scenario either. And these challenges are going to be even more relevant if I add the short-term inflation effect of the energy prices that I mentioned before. So this is kind of a grim scenario, I think. What happens if I'm a developing country? Of course, I'm going to face all these problems that I mentioned before, because those are kind of natural. But I think there's going to be spillovers for whatever happens in advanced economy. So let's say long-term rates in the US increase. That's going to put pressure for real exchange depreciation domestically through the interest rate parity channels, both direct effect, but also the premium in all these emerging countries is highly correlated with long rates in the US. So you're going to have to face that situation, and that generally imposes a significant trade-off for monetary policy in terms of activity and inflation. And those are going to be exacerbated by many of these countries feature liability dollarization, so every time you have a real depreciation, the effects are even worse in this case. And these increases in the premium that are going to be above and beyond whatever the long-term rate for the US is going to add to these debt sustainability problems. And then even without these spillovers, what we have is that these alternative ways to implement the climate transformation, say taxes on one hand, green subsidies on the other, or public investment, they have qualitatively different effects on inflation, output, and the real exchange rate. So they're not the same. And also country premium and debt dynamics, they go in the other direction. So if you have, say, let's say we do green subsidies instead of increasing brown taxes, so we don't have that much effect on inflation, well, someone has to finance those subsidies, so the debt problem is even larger. So there is this additional monetary fiscal interaction, and this paper by Ariado and co-authors is really nice about that. And finally, so there's going to be a different impact for small economies depending on whether they're energy importers or exporters. So I mentioned already about the tradability of the green energy. That's going to change the game a lot. But if the global prices are going to increase for all these reasons that I mentioned at the beginning, I think, of course, there's going to be heterogeneity. Exporters are going to be happy for a while. But then importers are going to suffer a lot, and in principle, they should be paying for this transition. So with the 40 seconds I have left, I have a suggestion to add to the paper. So the idea of the paper is to provide this orders of magnitude estimate of the amount of money. But maybe it would be nice to have like also an orders of magnitude estimate of the effect on relevant rates. So my suggestion is to mix two literatures. There have been recent papers that have introduced really long interest rate series, like Jordas, several papers, and this recent Rogov-Rossi paper. And you also have all this literature of identifying US fiscal shocks, so different types, taxes, expenditures, depending on whether this is government consumption or investment, and also military expenditures. So I think it will be nice to merge both and try to estimate the impact of these shocks in the US, that you can think them by themselves or as instruments for movements in global savings or investment, and then you can come up with an elasticity to interest rate that I think it would be nice to close the paper with, okay, not just saying this is going to go up. Well, let's try to give an idea about how much. Okay, and I finish there.
Thank you very much, Javier. Now we have time for a couple of questions from the public. I don't know. There, please.
So you made the parallel with, so first of all, this was super interesting. I felt like I learned a lot. So you made the parallel with measure military conflicts. If you look at the work of Hall and Sargent, they actually point out that large part of the way these wars get financed is actually through inflation. There are a few exceptions. Maybe the UK was the only, England was the only exception after the Napoleonic Wars, and that might be in part because the lords were owning the debt, and so they wanted to be repaid. So I think like that's something I would like you maybe to express your thoughts on this. We have some work with Robert Barrow in which, again, we make the point that similarly you can think about the pandemic as equivalent to a conflict in which we go with a massive fiscal spending and then it's socially acceptable, politically acceptable to inflate. And again, so here I think that the threat of high inflation going forward, I think it's real, and it was discussed. It's not clear what central banks can do to counteract it once markets become convinced that some inflation will be necessary.
Please.
Just one empirical question on one of the slides. So you showed the $7 trillion number for fossil fuel subsidies. I was wondering how it's distributed across countries. So is it primarily coming from the energy-rich countries like Saudi Arabia and so on, the fossil fuel subsidy? Because if you try to put it like it matters who's giving it.
Thank you. Elias.
Thank you very much for
the.
Thank you, Javier, and the other questions. So this is a great discussion, by the way. So you started with what happens with inflation in the transition. Francesco also alluded to that. So let me tell you a little bit about how this discussion is shaping up in the NGFS, because basically there are like a series of reports that are coming out that already came out this year in what's called the monetary policy workstream. Okay, so basically the first stage was figuring out sort of the macroeconomic context, the implications, but now the stage that we're starting, the mandate basically is to put more focus on the implications of monetary policy, okay? So some of the elements that you mentioned are in that discussion, basically what we could call transition impacts, transition being changing policies, for example. So, okay, so you get carbon taxes that are also kind of implicit in the promises of countries. And I would like to say that the outcome of that is that, people are finding that this is going to be more inflationary, because that's kind of what I think intuitively. But you will be surprised in the sense that people also come up with these other arguments that also, again, go through the risk aversion and precautionary savings once again. So basically the argument is that if, and this holds for inflation and also for the impact on interest rates, that basically if people in this more uncertain world are going to undo these larger expenses because the private expenditure part is going to be basically severely diminished. And therefore you don't necessarily get inflation and you don't necessarily get high inflation rate, high interest rates. I don't agree with that. I think that this discussion is just qualitatively anything could happen, but when you do the quantitative part, you kind of quickly see that the numbers don't add up. I mean, I should say they add up to a lot. but just the other ones don't subtract enough. So I agree with you. I mean, for me, yeah, definitely. I mean, this is the inflationary consequences are quite dire as well. Then, and it's not only taxes. I would say it's mainly, or not mainly, but at least as important is going to be the fact that the food system is going to be increasingly threatened. So it's not only shocks that have like this, one-off events, but you're going to see like a lot of difficulties in producing food in the major regions that are today producing food. Okay, so of course there's technology, and this could potentially make things a little better, but for sure that's a world in which we will face pressures on food prices. Maybe they'll start having a trend. There won't be like volatiles. Like today, we exclude them from the core CPI because they're volatile. But if they start getting a trend 10 years down the road, maybe we'll think twice, and maybe they'll part of the core. So it's not about only, so it's more volatility, but also probably trend. Then fiscal dominance. I mean, again, totally agree in the sense that if you're thinking about a world where we have a major war, and that we are in the middle of this climate crisis, we kind of are doing some expenses, but not enough, so we get hit with these huge shocks. Yeah, like central bank independence, I mean, would be nice, I mean, is that top of mind? Probably not. So I think that's, but I can tell you that is not part of the discussion in the things that we're talking with the NGFS, but it's good that you brought it up, because maybe we should. Then your suggestion on exploring the impacts on interest rates, that's what we want to do. So thank you for that. We definitely want to close. We tried to do like a preliminary calibration, but the effects were huge. So maybe the more serious one is going to show the same thing, but we wanted to be sure. So that's why we didn't bring it up, but that's definitely on the pipeline for this paper when we submitted the final version. And then the point that the question that Francesco was making, I mean, yeah, I agree that if we're in this situation, we will have to finance some of these deficits through inflation. But then, like trying to go back to the discussion we had in the morning with your paper, we talked a little bit over coffee as well. If markets sort of anticipate this, and this is not like a one-off thing, but it's like something that's going to last decades, it's going to be really hard to consistently achieve like a lower real interest rate, ex-ante interest rate, through inflationary surprises. So maybe that's, I don't know if I understood the paper, the keynote correctly, but maybe that's the world that Ricardo was suggesting, in which we have a very high, long interest rates, but the very short part of the curve is sort of compressed because there's less activity and so on. But I don't know. I think that's a very interesting aspect to explore as well. And finally, the question on the fossil fuel subsidies. Here, I was wondering if my co-authors could help me out a bit. I'm not sure how this opens up in. I know they're very important in emerging countries, but like the relative percentage, I'm not sure. My impression is that they are more important in emerging countries as a fraction of their, disposable income and so on. But I don't know if you guys have that figure, or how it opens up.
So, thank you. So, according to IEA, the rich gas countries has the major portion of GDP subsidized. So, for instance, Russia, Iran. I'm talking about especially on the crisis of 2022. So they are the highest one. But and in the figure we distinguish following the IMF the direct and the indirect fossil fuels. So this ranking is following the direct subsidies. And according to indirect, there is subsidies in the natural gas or electricity coming from fossil fuels that also remains very high in this country.
Okay, thank you very much. Elias and Javier, final applause. And okay, we have some final, I don't know.
Going to start at 7:45. For everybody, see you all tomorrow. We're starting at 9:45 a.m. with the second keynote address. So thank you.